pay tax on a pay-as-you-earn basis. We pay tax once in a year, and we have also a very stringent Data Privacy Act. The data we gather from our citizens from different sources cannot be used for this particular purpose.
More stimulus needed, and where and how?
Well, we are working very hard to roll out the stimulus package that we have outlined in the budget and 2 rounds of anti-epidemic fund. Wait till these measures are all rolled out before we decide the third one.
Well, first quarter GDP growth was down 8.9% year
Yes.
over year. I think the worst on record.
Yes.
Is that the worst for this year? And do you have any reason yet that you can give us that you might have to revise your full year forecast again? I think it's for a contraction of 4 to 7% for the full year, right?
We will be doing another update in August as part of our regular process.
What are the tea leaves telling you right now?
Well, very much depend on external virus situation and the economic recovery in Western countries. Yes, we suffer dearly in the first quarter, but globally, I think we are in a global deep recession because of the virus.
Are you seeing any indications of capital flight?
Well, facts and figures speak louder than words. Ever since the announcement of the intention to legislate national security law, the Hong Kong dollar to US dollar convertibility undertaking has all along been on the strong side. When I talk to the banks, when I talk to the private wealth management individuals, when I talk to Hong Kong MA, in fact, there is no obvious outflow of capital.
The local news, though, shows signs of people a little bit worried. I mean, local money exchanges running out of US dollars, or they're lining up to get US dollars or other currencies. That's happened in the past in times of crises. People seem to want to get hard currencies. Is that just a temporary phenomenon right now, or is that an indication that there are some deep-rooted concerns in society?
I do not believe this phenomenon is a reflection of any deep-rooted issues as such. I would say this is a short-term anxiety and sentiment. Last year, during the social turmoil, we saw similar phenomenon. And in fact, last year, when we went through those difficulties, our financial market had been operating very smoothly. And again, there was no obvious capital outflow. The total deposits in the banking system at the end of last year, compared to the beginning of last year, registered a very modest 1% growth. And so far, this in the past 4 months, in the past 10 days, we did not observe any obvious capital outflow.
As a Hong Kong Financial Secretary Paul Chan speaking to us earlier. And we'll have more on the outlook for Hong Kong. We're joined by the Hong Kong General Chamber of Commerce Economic Policy Committee member Peter Churchhouse, will be with us a little bit later on. But coming up next, we'll dissect Japan's final first quarter GDP figures with BFA Global Research Head of Japan Economics, Izumi Tavalia. This is Bloomberg.
Okay, so Kat, to confirm, one question. We're waiting for Japan's GDP figures and current account data due in just about a minute. Let's bring in Izumi Devalier, BofA Global Research Head of Japan Economics in the meantime. Now, we're expecting a revision upward in these numbers, but it doesn't mean that there will be a change in the bleak outlook for the Japanese economy. How do you see the second quarter faring?
Yeah, that's absolutely right. I think first it's important to remember that these numbers are, from more than 3 months ago by this point. We are expecting a small upward revision, or rather a smaller contraction, but that's on account of, a better CapEx number that has more to do with survey disruptions. I think second quarter, we're still looking at an extremely sharp fall in GDP over 20% on an annualized basis.
Let's get more into that CapEx number. Business spending, we saw a little bit of a buildup in cash ahead of the virus outbreak. How do you see the picture going forward?
Well, I think, in terms of where we stand with the economy, the good news here is that with the lifting of the government state of emergency in the middle of May to end of May for some prefectures, I think the economy bottomed last month. However, I think the question is the pace of the recovery. First, that pickup in June, any kind of pent-up demand, followed by third quarter onwards. And on that point, we're still expecting a pretty sluggish recovery because there's been a pretty big hit to incomes and labor markets from the shock. And moreover, we think that consumer confidence is going to be depressed. And finally, I think some parts of the service sector are going to struggle to get back to pre-normal levels if you think about restaurants, big events, bars, and things like that. So overall, we don't think consumption is going to return to the pre-COVID normal for a couple years.
Now, with that, Zumi, we have the numbers out from Japan, the first quarter final GDP numbers coming through after a 3.4% annualized quarterly drop in the preliminary data. We are seeing first quarter GDP shrink by 2.2% on an annualized basis. The forecast is for a 2.1% contraction. When it comes to first quarter business spending, we saw a pickup in that, 1.9% on a quarterly basis. And when it comes to the current account, we are seeing that come below the estimate at 262.7 billion yen. Consensus was for 360 billion. Now, with this data, Izumi, what can we extrapolate? As already said, double-digit contraction likely for the Japanese economy in the second quarter. Business spending on the rise. What are you seeing here?
Yes. Hi, Sophie.
Hi, Izumi. So with the latest data, what stands out to you the most in this latest data?
Good. Thank you.
Izumi, I just want to check that you can still hear us. In terms of these GDP numbers, how concerned are you that we're not going to see the reflationary effort or I suppose the impact continue, given that we had household spending in April falling the most on record? Do you anticipate a recovery even as the economy comes out of the state of emergency? We are going to try and get back with Izumi in just a moment. Izumi Devalier, BofA Global Research Head of Japan Economics, who we are just having a few technical problems getting in touch with her. Let's get you a quick check of the latest business flash headlines in the meantime. And Britain's top drug maker, AstraZeneca, is said to be interested in a merger with American rival Gilead. Sources tell us that informal contact has been made in what would be the biggest healthcare deal in history. No terms have been released yet and no decisions have been taken, but AstraZeneca is valued at $140 billion, with Gilead worth just under $100 billion. We're told that Gilead, though, is not interested in a sale or a merger. Apple aims to boost sales by letting people pay via monthly installments. Sources say the plan will be rolled out in the coming months via the Apple Card, letting customers split the cost of new gadgets with interest-free staggered payments. We're told the deal would cover iPads, Macs, keyboards and some monitors over a 12-month period. Apple launched an iPhone program last year with 24 months at zero interest. NetEase has priced its Hong Kong stock offering at 123 Hong Kong dollars per share, which would raise around $2.7 billion when it begins trading on Thursday. China's second biggest gaming company has its main listing in the US and makes its Hong Kong debut at a time of rising tensions between the US and China. Washington has threatened to delist Chinese companies and limit their access to capital markets.
Let's get a quick check on what markets are doing so far this morning. Heidi, we're taking a look at stocks here. U.S. futures just pointing higher by about 0.7%, while Singapore Nikkei futures gaining more than 1% this morning. The yen just holding steady after a 3-day decline. And check out oil gaining ground after a 6-week advance for crude. WTI topping $40 a barrel right now. So we're keeping a close eye on the commodity space, of course, given the OPEC Plus deal that was hammered out on Saturday. There's a question of, though, whether or not Russia and Saudi can enforce the rules when it comes to that agreement. And of course, we just had Japanese first quarter GDP numbers, the final data for that quarter. We saw a contraction of 2.2% on an annualized basis, a slight pickup in business spending for the first quarter, more so than the estimated numbers. So we're going to get a reaction on those numbers when markets open in Tokyo at the top of the hour. So we're keeping an eye, of course, on what's going on in that space. Also want to highlight in New Zealand, we are seeing Kiwi stocks gain ground. Air New Zealand among the advancers there, this after it signaled that it would seek a cost-cutting plan extended, potentially seeing some job cuts there in order to rein in its wage bill. The Kiwi dollar up about 0.4%. Now, coming up on the next hour of Daybreak Asia, BlackRock head of active investments Belinda Boa joins us to discuss investment strategy and the outlook for markets. Checking in on that ahead of the market open, this is Bloomberg.
Los que hayamos adoptado un abuelito, vamos a continuar viéndolos a nuestros abuelitos, ¿no? No podemos dejarlos de verlos por el hecho que se termine de solucionar la pandemia. Más bien al contrario, habremos tenido un mayor contacto con nuestros abuelitos hasta sus últimos días.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Welcome to Daybreak Asia. I'm Heidi Stroud-Watts in Sydney alongside Sophie Cameroon in Hong Kong. Japan and South Korea have just opened for trade. And let's get you our top stories this hour. Asia Pacific markets look set for gains after US payrolls smashed expectations. Futures point higher in Tokyo and in Hong Kong. Global stocks have added $20 trillion since the bottom in March. Oil rises for an 8th straight session as OPEC and its allies agree further output curbs. The new deal lasts a month and the cartel will keep an ever closer eye on production levels. And the future of Hong Kong amid rising tensions at home and abroad. We hear from the Financial Secretary Paul Chan as the city reels from new security laws, the coronavirus and months of protests.
Let's take a look at the open in Tokyo after the final first quarter GDP data came out just moments ago. We are seeing stocks gaining ground with the Nikkei up 1%. The topics also moving to the upside, while the yen just holding on to a 3-day gain, steady around 109 mid levels right there. And JGB's expected to soften at the start of a week that is short on BOJ bond buying operations with only 2 on the agenda. Markets watching for potential buying in the super long sector. Now let's switch it out to check in on Seoul market this morning. Kospi adding 1.5% this morning. We're keeping an eye on Korean Air as it secures more funding support. So the Kospi gaining ground this morning, set to erase its year-to-date loss. And the Korean won also firmer this Monday, trading at 1200 spot 95, trading at a March 11th high. Also on the docket this Monday, the Finance Ministry to sell 2.6 trillion won of 5-year bonds, keeping an eye on that. Now let's switch out the board to check in on S&P E-minis, which earlier edged above 3,200. We're seeing move to the upside there. But taking a look at commodities, you have New York crude topping 40, Brent above $43 a barrel after a 6-week gain, the longest stretch of wins since May 2018. And check out iron ore futures in Singapore, climbing above $100 for the first time since August 2019 in the wake of a Brazilian labor court ordering the shutdown of a Vale mining complex after 188 workers tested positive for the coronavirus, Heidi.
All right, well, emerging market stocks have posted their biggest gains in more than 8 years. This as investors look past geopolitical tensions towards the reopening of economies and of resuming growth. Joining us now is Belinda Bauer, who's the head of active investments for Asia Pacific at BlackRock. Belinda, great to have you and thanks for being with us. We've been talking a lot about this potential for Asia to be first in, first out of this pandemic crisis, right? Is that still your base case, that we'll see the fastest and most robust economic recoveries in this part of the world?
Yes, thanks for having me. We're actually seeing signs of recovery across a number of markets, but I do think that there's going to be very big divergences between countries and regions. And we're seeing that in the macro data. In North Asia has benefited from being first in and first out. And their policy response and recovery from this economic standpoint, I think, is pretty clear. However, if you look at Southeast Asia and the South, it's lagging. But our view is that markets will price in ahead and look forward to see some improvement, which I think we're already seeing. And obviously, news flow last week was very supportive of a rally in risk assets.
Belinda, in terms of emerging markets and what the future holds, I want to bring up one element, of course, it's how the US dollar travels from here. Take a look at this chart if you can, or at least for the benefit of our viewers. We're seeing slipping for a 7th straight section when it comes to the dollar, longest losing streak since September 2017. That's, of course, the Bloomberg Dollar Index. At the same time, though, we've seen the yuan fall for 15 straight days against its trading basket of currencies. So which is the biggest driver then when it comes to currency headwinds for emerging market assets in Asia?
Yeah, well, it's an important question to ask for Asian assets. Actually, we've seen the dollar weaken since it's opened its swap line from probably the middle of March. I don't think it's been uniform, and it hasn't actually been too big, but it is still meaningful for the region because, you know, further strength for Asian assets, and particularly risk assets, will be driven off a weaker dollar. And as you said, the yuan has been weaker, but we believe going forward it would probably more likely stay range-bound, although we could probably see shifts in this direction. So I think, in general, the dollar weakness is actually very positive for risk assets in Asia.
Now, Belinda, let's get into your investment themes, 4 of which have been identified by your team. Let's get into the oil majors piece here. Given the agreement that we saw from OPEC+, what does this imply around the supply-demand dynamic?
Yeah, so over the weekend, obviously, we've seen them extend the decisions on energy, and we've been moving and rebalancing into energy. You know, we believe that big market dislocations like we've seen with coronavirus, which has created both a supply shock and a demand shock in the energy space, plus the disagreements with these oil leaders, has sent oil prices to sort of very distorted levels. And we're expecting higher oil prices going forward. So we are very positive on some of the energy opportunities in the region.
I'd like to turn now to the travel segment here. We're seeing reopening of economies across the world, travel bubbles, air bridges being established between economies, particularly in Asia. We've seen a pickup in airline stocks across the board, although there are still some limits as to what that implies for travel demand. What upside are you anticipating?
Yeah, again, you're looking at some very beaten up names in the travel space. We're looking to rebalance into domestic-focused travel names rather than international, as we don't see those routes coming back just yet. But also, I think you need to be very selective around finding companies that have stronger balance sheets in this space. But as you say, we saw some very meaningful rises in some of the airline names at the end of last week.
Belinda, how much longer can we expect to see the corporate debt rally, I should say, continue, given the levels that we're at the moment? And yet, of course, when the Fed meets this week, they're not likely to take their foot off the pedal anytime soon.
No, I think the meeting for the Fed is obviously something that we really want to watch this week. This has been unprecedented in terms of the policy response that we've seen, particularly from the US. So I think watching what happens with the Fed meeting is going to be important. It will give some indication of how they're seeing the economy and how much further they need to support it. But our view is that policy response is going to remain very strong, regardless of the fact that we saw a very strong jobs print at the end of last week.
In terms of the bond space, China is something that you're looking at?
Yeah, so we've been positive on China for some time. We do like China SOEs. We like the investment-grade credit. And also, we are favorable on China high-yield property sector, where we think fundamentals are both stable, and we're seeing a recovery in construction and sales. You know, when you look at China and the policy response, it's been different to the rest of the world. And it's, you know, when you look at the credit growth that's coming out of China and the size of that market, I think it's also going to be very positive in terms of some of the material names for equities as well. So China is actually very favorable in both our fixed income and our equity portfolios.
Now, Belinda, turning to India, the country enters the first phase of its reopening this Monday, with more dire economic news likely later this week, then prompting more calls for rate cuts from the RBI, along with bond purchases from the central bank. When it comes to the credit markets, where are you seeing opportunities given the dislocation?
Yeah, in India, we've been a little bit cautious on the credit side. We did have a Moody's downgrade recently, which is really just moving in line with both S&P and Fitch. So we don't think that's as meaningful, but we are a little bit more cautious and remain up quality. the equity side, though, this is a country that has been hit particularly hard, and it's a carry country, which really, attracts foreign capital flows and typically runs a current account deficit. And while liquidity was withdrawn, particularly in March, and we saw volatility, this market was really hit very hard. So our view is actually we want to rebalance into this carry trade in equities. Some of the sell-off has left sectors within India at 20-year lows. And so from a valuation perspective, we think that there are opportunities.
Thank you so much to Belinda Bauer, Head of Active Investments, Asia Pacific at BlackRock. Now let's check in on some airline stocks that are on the move this morning. In Korea, we are seeing Korea Airlines gain ground on the back of news that will secure more funding, and we are seeing Tokyo stocks gaining ground. Japan Airlines up nearly 7%, and ANA also moving to the upside more than 5% this morning. We're getting some news lines from the NHK that ANA and JAL are planning a large boost to cargo flights this month. Also, the Asahi reporting that the ANA is looking to get more funding support, including credit line from banks, and that would see perhaps 950 billion yen of credit support, although the ANA is looking to cut its international flights. So we're seeing Air New Zealand also gain ground. Plenty more to come on Daybreak Asia. This is Bloomberg.
This is Daybreak Asia. I'm Karina Mitchell with the First Word headlines. China's trade surplus rose to a record last month as a jump in medical exports helped outbound shipments fall less than expected. Although imports did decline, exports fell by 3.3% in dollar terms from a year earlier, while imports slumped almost 17%. That left a trade surplus of almost $63 billion, helped by the falling price of commodities that China needs. Staying on China, its simmering spat with Australia is deepening, with Beijing issuing a travel warning saying discrimination against Asian people is on the rise. The Ministry of Culture warns Chinese travelers to be on alert and not to travel to Australia. The warning follows Canberra's call for an investigation into the origins of the coronavirus and Beijing's decision to put tariffs on some imported Australian goods. Reports from London say the government is planning to tighten up legislation on takeovers amid concern about China's growing influence. The Times says the Johnson administration will make it mandatory for companies to report attempted mergers that could threaten national security. The Prime Minister is said to want academic partnerships and research projects to be included in any future bill. And OPEC and its allies have agreed a one-month extension of production curbs while calling on members to stick to agreed levels amid allegations of cheating. Energy consultant Wood Mackenzie says the deal could see Brent climbing to $50, and it's seen as a win for Saudi Arabia and Russia as they try to rebalance the market. The OPEC Plus Monitoring Committee will also meet every month to assess demand. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. So,
Karina, thank you. Global stocks look set to rise on the back of a welcome surprise in the U.S. labor markets as payrolls posted a record increase in May. Our global economics and policy editor, Kathleen Hayes, is here with the numbers. Kathleen, now last week you told us there was a strong signal from the ADP reports that jobs could be up more than expected. But was there any reason to expect what President Trump called an outstanding report?
What people describe this report as jaw-dropping, not expected at all. The ADP report was suggesting maybe the decline wouldn't be quite as big as 7.5 million, but an increase, this just knocked people back on their heels. Quite a shock, that record rise, monthly rise in payrolls, unemployment falling when it was supposed to move up another 3 or 4 percentage points. Broad-based job gains from manufacturing to retail to restaurants. Look at this chart just to put these numbers in a visual perspective as well, because we saw payrolls up 2.5 million in May. That's the biggest monthly increase ever. Again, they plunged nearly 21 million. Look at that chart, that big orange drop. Well, that's what happened in April. Then you have unemployment. It was supposed to jump to 19%. Instead, it fell to 13.3 from 14.7. Again, not at all expected. And the Labor Department did say, well, there was a little bit of a misunderstanding for the way some people counted themselves furloughed versus employed, and it might have been 3 percentage points higher on the jobless rate. Nevertheless, nowhere near as high as it was predicted. Now, what are the negatives in this report? Well, 21 million U.S. workers still remain unemployed. Jobless claims people show that people are still getting laid off in the millions. And in fact, black unemployment at 16.8% in May, even a wider gap versus the U.S. unemployment rate. It's the highest since 1984. Just one more reason why Bloomberg Economics and so many economists are saying there's more fiscal spending needed. President Trump called the jobs report outstanding. Even so, he too wants to see more spending. Let's listen.
We're going to be asking for a payroll tax cut. We'll be asking for additional stimulus money because once we get this going, it'll be far bigger and far better than we've ever seen in this country.
So the president behind it, we'll see how far it gets. The Senate, led by Mitch McConnell, but Senate Majority Leader said last week, nothing will be taken up until after the July 4th recess. So that puts us around July 20th. But it seems even with this better than expected jobs report, there's still a sense there's a lot of damage that has to be healed, has to be fixed. And that's why many people say you're still going to have to do more, especially for the American worker.
Yeah, some really grim parts to that report, as you pointed out. Kathleen, does this move the dial for the Fed this week at all?
Not really, because Jay Powell has made it clear. Think of the last Fed meeting in the press conference. In every speech he's given, we can do more, we will do more. We're not going to think about taking that key rate above zero until the economy's back on track. He's probably going to talk again. The Fed is willing to provide more stimulus if it has to. It can provide more stimulus. The Main Street lending facility just going into effect. He's going to talk about, yes, we'll buy more corporate bonds. We'll do whatever it takes. One thing that has shifted, I think, a bit, Heidi, look at another chart, the bets on negative rates. It's barely disappearing now, especially after that payrolls report said, gee, maybe this isn't as bad as we thought. Maybe the recovery will happen a little bit quicker. Compare that to in February, before the pandemic started hitting, before the lockdown started in the U.S. in March, you saw the market still expecting rate hikes. Well, now there was the brief period, the month where we flirted with that negative rate expectation. It's off the table. However, yield curve control is still being very seriously considered. I think people are going to be asking Jay Powell about that, too, after the presser on Wednesday, not only to keep bond yields and borrowing costs low for companies, but also for the federal government. All this stimulus costs money. It costs debt. It costs a larger deficit. The higher yields go, the more the government has to pay. That's another reason people say why the Fed should consider yield curve control. And this week, investor demand for U.S. Treasuries will be tested. The quarterly refunding, it's every 3 months. 3-year paper, 10-year paper, and 30-year paper. We'll see what yields they come at, especially at a time when yields have been rising and the yield curve is steepening.
Yeah, more debt sales on tap. And what else should we be watching, Kathleen, this week when it comes to the economy and the central bank front as well?
Well, around the world, it's going to be, let's just see how badly our economy has been hit by the pandemic, and probably raise the same question: have we done enough yet? If we start with Asia, we're going to get China's aggregate social financing numbers. It will show probably that the government, the People's Bank of China, have been spending more, not flat out with the accelerator to the floor, but certainly juicing things up. Factor gate inflation, PPI, is expected to get weaker. Another thing will be very closely watched. In Japan, we just got first quarter GDP revision, but you step back and you look at that. You look at expected machine orders, producer prices, everything underscoring. We've had 2 negative quarters for Japan. A third one is expected in the second quarter. Industrial production in focus. India's industrial production seen down 60% in April. Even the euro area, that number is expected to be down 18% in April, on top of an 11% decline the month before. In the U.S., I think weekly jobless claims will once again be in focus, because now we're looking for signs that the worst is over. In the U.S. labor market and the economy more broadly, it'll be interesting to see again, and it will be closely watched to see if it underscores that sense. Things are still bad, but they're not as bad as they were.
All right, Kathleen Hayes, our global economics and policy editor there with a look at that data. We have lots more to come on Daybreak Asia. This is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Well, China has hit back again at claims of a cover-up over the coronavirus outbreak, saying in a newly published white paper that it has acted transparently. Let's get to our China correspondent Selena Wang in Beijing for more. And Selena, what are the details of the paper and what purpose does it serve?
Heidi, this white paper outlines the steps and measures that China took to fight the coronavirus, with the purpose here of trying to push back against this criticism that China has tried to cover up or delay its response to the virus outbreak. Now, with almost 400,000 deaths globally from the coronavirus, this pandemic has become a growing point of contention in China's relationship with a number of countries, especially the U.S., as Donald Trump repeatedly faults China for having failed to contain the outbreak. And in this white paper, while China does not directly point out the U.S., it says that it shared information in, quote, clear and unambiguous terms, but that this was ignored by certain countries, which now seek to blame China for its own failures. Now, this white paper is also part of China's broader efforts to defend its actions, bolster its international standing. Beijing has been sending medical supplies and doctors to other countries, and Xi Jinping has pledged to make any Chinese-developed vaccine a global public good. And the white paper pledges that China will continue to supply the international market with materials to fight the outbreak, including pharmaceutical goods and daily necessities.
Now, Selena, turning to the diplomatic spat between China and Australia, which has Canberra looking to toughen up its foreign investment laws, China has issued an alert warning its citizens not to travel to Australia. How does this fit into the broader tensions between the two?
Well, this is just the latest sign of deteriorating relations between Australia and China, which is its biggest trading partner. So the Chinese Minister of Culture and Tourism published a statement saying discrimination and violent behavior against Chinese and Asians are on the rise in Australia due to the pandemic, and told Chinese tourists to be on alert for their safety and advised them not to travel to Australia. Now, Australia's Trade and Tourism Minister has hit back and said that China's claims are false and that the country looks forward to again welcoming visitors from all backgrounds. Now, this downward spiral in China-Australia relations has really intensified ever since Prime Minister Scott Morrison led calls for an independent probe into the origins of the virus.
And Selena, in terms of the trade surplus on the eco front, China's trade surplus surging to that record in May. What are the contexts, though, if you kind of look beneath the hood behind these numbers?
That's right. We saw a record trade surplus in May of $62.93 billion. That was really driven by exports falling less than expected because they were bolstered by an increase in sales of medical supplies and masks as the world battles the pandemic. And we also simultaneously saw a slump in imports that was due to lower commodity prices, even though purchase volumes increased. So according to China's Customs Bureau, the average purchase price of crude oil fell 21% in yen terms in the first 5 months of the year, even though purchase volumes rose more than 5%. And if you look at early indicators, they show that China's economy continues to its very slow recovery from May, but we do have rising risks of an escalation in U.S.-China trade tensions threatening that outlook.
All right, thank you so much to Selena Wang, our China correspondent in Beijing. Taking a look, some lines crossing the terminal now regarding JD.com's listing in Hong Kong due out just in a couple of days. JD's share sale is said to be oversubscribed by multiple times, including the institutional tranche. Now, bear in mind, the offer is for 133 million new shares at as much as 236 Hong Kong dollars. The latest there on JD.com's listing here in Hong Kong. Now let's get a quick check of the latest business flash headlines. NetEase has priced its Hong Kong stock offering at 123 Hong Kong dollars per share, which would raise around 2.7 billion US dollars when it begins trading on Thursday. China's second biggest gaming company has its main listing in the US and makes its Hong Kong debut at a time of rising tensions between the US and China. Washington has threatened to delist Chinese companies and limit their access to capital markets. Britain's top drug maker, AstraZeneca, is said to be interested in a merger with American rival Gilead. Sources tell us informal contact has been made in what would be the biggest healthcare deal in history. AstraZeneca is valued at $140 billion, with Gilead worth just under $100 billion. We're told Gilead is not interested in a sale or a merger. Up next, oil prices extend their best streak in years after OPEC Plus agreed to further output cuts, but can they enforce compliance? Analysis next. This is Bloomberg.
This is Daybreak Asia. I'm Karina Mitchell with the First Word headlines. Here in New York City, a protest curfew has been lifted as it prepares to begin reopening for business after the coronavirus pandemic. State Governor Andrew Cuomo says COVID-19 is the one variable for the city and is calling on all protesters to seek health checks. The weekend saw some of the biggest Black Lives Matter demonstrations across the U.S., most of them peaceful and with arrests sharply down on previous rallies. Meanwhile, Minneapolis says it's beginning the process of dismantling its police force in the aftermath of the death of George Floyd. The majority vote is veto-proof, and the city council members say they'll consult the community on what should happen next. On Saturday, Mayor Jacob Frey was booed by protesters after saying he did not support the abolition of the police. He was elected in 2018 after promising to mend relations there. And the Prime Minister of Singapore says the future will look very different post-COVID-19. In a national address, Lee Hsien Loong said the city-state, won't be returning to the interconnected global economy that existed before the lockdown. And with unemployment rising and travel hammered, the future will be even more tough. Singapore spent the equivalent of 20% of GDP on its response to the virus. And Russia is investigating a massive oil spill in Siberia. An estimated 20,000 tons of fuel leaked from a storage plant outside the city of Norilsk, about 1,800 kilometers northeast of Moscow. The plant is operated by Norilsk Nickel, which is accused of making the area one of the most polluted places on Earth. President Putin and other leaders only learned of the spill through social media. Global news 24 hours a day on air and on Quick Take by Bloomberg. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Heidi.
Karina, let's take a look at the markets now. We are getting a pretty buoyant, albeit holiday-thin start to the trading week here in Asia, tracking those gains that we saw on Wall Street on Friday after that defiant US jobs report, seeing an addition to payrolls as opposed to expectations of a depression era decline. We are seeing gains on the Nikkei 225 to the tune of about 1%. That stock market trading at the highest since about February 21st. The Kospi also trading at its highest since about late February as well, adding on about 0.25%. In New Zealand, we're seeing gains now extended to almost 2%. In New Zealand, one of the outperformers after the CEO said that he didn't rule out further job cuts to come. We also heard from the New Zealand Finance Minister, Grant Robertson, saying that the economy in New Zealand is coming back online quicker than expected after the strict lockdowns. And just a quick look at US futures, S&P E-mini futures adding just about 0.5% there, looking like that rally will continue, Soph.
Yeah, let's turn to the oil patch now, Heidi. Prices rising with Brent topping $43 a barrel. This after OPEC and its allies agreed to extend production cuts by an extra month. Bloomberg energy reporter Stephen Stepchinsky joins us on the line from Singapore. Now, Stephen, what is different about this latest OPEC Plus deal?
Unlike other deals in the past, this deal actually has a measure in it to ensure that production cuts in May or June are met, and that laggards will have to make up the extra reductions from July to September to compensate if they don't agree or if they don't cut what they agreed to do. The first OPEC output surveys showed that Angola, Iraq, Kazakhstan, Nigeria weren't exactly squeezing supply nearly as much as they had promised. This has been a bit of an issue for OPEC for decades, but it's come under bigger scrutiny now that Russia and Saudi Arabia are really pushing for folks to cut output and bring the market back into balance. So with this sort of stricter view on the market, there's an expectation that the cuts will be made, and this can help bring a faster rebalance forward.
And Stephen, what are we seeing in terms of measures from Saudi Arabia to try and boost market prices?
Not only do we see Saudi Arabia be one of the most aggressive in terms of just cutting their output, they've now come out with their pricing scheme for July. They put this out every month, and it's in either a discount or a premium to the market. And what you're seeing now is that their July exports have jumped basically to the biggest price increase for its oil in at least 2 decades, doubling down on its strategy to really bolster the oil market. In particular, the steepest jump will hit July exports to Asia. Now, this comes after March, where they had cut their prices significantly to try to capture market share from Russia. So this move shows that they are not at odds with Russia, and also they're trying to shore up prices so that the physical market sort of follows in step and you see a rebound going forward.
All right, our energy reporter Stephen Sapchinsky there with us. Coming up next, ahead of the one-year anniversary of protests in Hong Kong, with the national security law looming, we'll be assessing whether the anti-government movement has lost. Markets veteran Peter Churchhouse will be with us next. This is Bloomberg. Hong Kong's government is promoting a message of stability, in particular for its currency peg, which remains unbroken since the 1980s. This as the territory charts a course to revive its flagging economy. Bloomberg spoke with Hong Kong's Financial Secretary Paul Chan about when he sees that recovery.
This year, I think towards the second half of the year, particularly in the fourth quarter, this is hopeful. But this is very much depend not just on ourselves, but number one, the coronavirus situation globally. Because if globally this is under control, then a lot of economic activities can be revived. And secondly, the relationship between the US and China, particularly on the trade front, that would affect our foreign trade. And also thirdly, when at the moment, when we get the coronavirus situation under control, and the society back to a stable environment, we are going to encourage our own consumption. Say, for example, the $10,000 scheme for every eligible Hong Kong citizen.
People are still waiting for that, by the way.
It's coming soon.
That's been a big complaint of local people, that they haven't gotten their checks yet.
Yeah, we heard that. We are working very hard to
Why
set
did
up
it
the
take
system.
so long?
Well, say for example, in the US, you pay tax on a pay-as-you-earn basis. We pay tax once in a year, and we have also a very stringent Data Privacy Act. The data we gather from our citizens from different sources cannot be used for this particular purpose.
More stimulus needed, and where and how?
Well, we are working very hard to roll out the stimulus package that we have outlined in the budget and 2 rounds of anti-epidemic fund. Wait till these measures are all rolled out before we decide the third one.
Well, first quarter GDP growth was down 8.9% year over year. I think the worst on record.
Yes.
Is that the worst for this year? And do you have any reason yet that you can give us that you might have to revise your full year forecast again? I think it's for a contraction of 4 to 7% for the full year, right?
We will be doing another update in August as part of our regular process.
What are the tea leaves telling you right now?
Well, very much depend on external virus situation and the economic recovery in Western countries. Yes, we suffer dearly in the first quarter, but globally, Globally, I think we are in a global deep recession because of the virus.
Are you seeing any indications of capital flight?
Well, facts and figures speak louder than words. Ever since the announcement of the intention to legislate national security law, the Hong Kong dollar to US dollar convertibility undertaking has all along been on the strong side. When I talk to the banks, when I talk to the private wealth management individuals, when I talk to Hong Kong MA, in fact, there is no obvious outflow of capital.
The local news, though, shows signs of people a little bit worried. I mean, local money exchanges running out of US dollars, or they're lining up to get US dollars or other currencies. That's happened in the past in times of crises. People seem to want to get hard currencies. Is that just a temporary phenomenon right now, or is that an indication that there are some deep-rooted concerns in society?
I do not believe this phenomenon is a reflection of any deep-rooted issues as such. I would say this is a short-term anxiety and sentiment. Last year, during the social turmoil, we saw similar phenomenon. And in fact, last year, when we went through those difficulties, our financial market had been operating very smoothly. And again, there was no obvious capital outflow. The total deposits in the banking system at the end of last year, compared to the beginning of last year, registered a very modest 1% growth. And so far, this in the past 4 months, in the past 10 days, we did not observe any obvious capital outflow.
That was Hong Kong Financial Secretary Paul Chan. Now let's bring in Peter Churchhouse, Portwood Capital MD and Hong Kong General Chamber of Commerce Economic Policy Committee member. We just heard from the Finance Secretary discussing the resiliency of bank deposits in the city and hot money flowing in with some big listings in the pipeline. What are you observing in terms of capital flows, and what potentially could derail this resilience?
Well, that's absolutely correct. If we look at 25 years of history in Hong Kong, there's been rarely any incidents of mass capital outflow. That happened around 2008 during the financial crisis. But typically, Hong Kong's capital situation has been very, very strong, and banks have continued to see rising deposits. And that's what we're seeing right now, as I think Paul Chan just said. Recently, in the last couple of weeks, we've been seeing very substantial inflows of cash into Hong Kong, which has actually pushed the Hong Kong dollar to the strong end of the pegged relationship, which has meant that the finance gurus in Hong Kong have had to sell Hong Kong dollars to keep the pressure off the Hong Kong dollar from rising too high. So at the moment, we're seeing a net inflow of capital, not a net outflow. And that's largely due to the numbers of listings that are coming through in Hong Kong. We're seeing JD.com, a big Chinese company, NetEase, another China company listing in Hong Kong. So a lot of money is flowing in to hit those IPOs.
It would seem that authorities here in Hong Kong would like to keep up the momentum around big deals for the city. In an SEMP report citing an interview with the new Secretary for Financial Services and Treasury, Hong Kong is to relax its 14-day quarantine rule for executives of 480 of the largest companies listed here, including the likes of Tencent. Will we see more such measures to try and boost investor confidence against the political backdrop that perhaps could lend some uncertainty?
Yes, there's a long-term history of that in Hong Kong, where we've seen, for example, in the period leading up to the handover in 1997, there was a very significant opening up of liquidity from China into Hong Kong, which really supported the financial markets and the asset markets at that time. And one had the feeling that encouragement of capital flow was designed to make Hong Kong look good at the time of the handover, which was a time of considerable uncertainty. I suspect we may see a little bit of that this time around as well. And if we think about it, one of the big policy objectives of China is with the Greater Bay Area concept. This is a very high priority in China policy. And this, of course, it does involve Hong Kong is part of that process. So, again, I'm expecting to see a lot of capital flowing into the Greater Bay Area, and Hong Kong should be a beneficiary of that, would be my guess.
Peter, how do you expect the national security law to play out when it comes to the attractiveness for investment and business in Hong Kong? Because there seems to be a tension, right? There's a number of voices within, the business establishment saying that anything that introduces certainty and removes, these sometimes violent protests from our streets is a good thing for investment confidence. And on the other hand, it's been pretty roundly condemned by major trading partners like the US and the UK.
Yeah, that's absolutely right. I mean, let's face it, most countries around the world have law with regard to national security legislation, and China is no different here. And the law so far, as we have seen it, is talking about punishing or preventing acts of succession, subversion, terrorism, etc. But most significantly, it's also focusing on activities of foreign and external interference in Hong Kong. Now, let's face it, from a business point of view, that could be just about anything. Most foreign organizations and chambers of commerce and trade groups and so on all seek to influence economic and business policy in Hong Kong in one way or another to support their business. So now, is this going to be seen as an act of subversion that the business communities seek to direct and change policy with respect to taxes, with respect to rules on allowing businesses to operate and so on? Let's face it, every business chamber of commerce tries to do that. So that is a concern that these kind of activities could be seen as a threat to national security. In a funny kind of way, the U.S. raised the issue of national security over the steel industry and used that as a weapon against China in threatening to impose conditions on China's exports of steel. So national security was used there in a case of business, and that's what I think the business community gets concerned about.
So we talked about JD and NetEase, for example, but it's becoming increasingly clear that the capital inflows and investment inflows are likely to come from these Chinese companies almost coming home, right? Is there a real concern that we're likely to see a reversal when it comes to, actual foreign investment? And is this kind of the nail in the coffin after what's been almost a year of protests and the economic decline on the macro front?
I don't think so. I mean, if we look at Hong Kong's financial flows over the last 20 years, they've been largely dominated by flows in and out of China and China companies' exports and imports and so on. So it is very largely driven by the China business anyway. What I think is the major risk and the major concern is what you might call the nuclear option from the U.S. For example, if it blocks Chinese banks from the global dollar clearing system and puts in curbs of that nature, that could be devastating for Hong Kong and for China. But are we likely to see the Americans adopt that kind of policy? It doesn't seem likely at this stage. But that nuclear option is the one that we most fear, and that could be devastating, not just for Hong Kong, but for China generally.
Peter, with several unknowns remaining, both businesses and consumers in the city, people who are attempting to negotiate the potential outcomes here, they're trying to find their backstops, their insurance policies. We're seeing that in the property market. Property prices have remained resilient as people look to this space as a safe investment during these chaotic times. What else are you seeing when it comes to a potential exodus? Are you hearing from businesses, for example, that they're looking to shift their operations and assets?
Well, quite frankly, I think most families and most businesses for a number of years facing the trade issues and so on from the U.S. and the slowing economy in China, have been putting in place what you might call insurance policies or a plan B for their personal finances and for their businesses. For example, with the trade war initiated by the U.S. against China, many companies are setting up other manufacturing bases in places like Vietnam, India, Indonesia, Malaysia, Thailand, and so on. And so, of course, to some extent, there will be some drain of expertise and capital from Hong Kong and China to those venues. So I think that's happening anyway, and I'm not sure that we're going to see a massive exodus in this respect. For example, last year, the American Chamber of Commerce did a survey in October, and this was well before the latest security legislation was raised, and something like 50% of the members that replied to that survey had considered moving out of Hong Kong or had made contingency plans to do so. And the recent survey done last week by the American Chamber suggested that 70% of people that answered the survey were not considering relocating, but 30% of them were figuring on some kind of alternative plan B and escape route one way or the other. So I don't see a mass exodus by any means, but I think companies and families and individuals are putting in place a plan B in their insurance policies of one kind or another.
All right, Peter Churchhouse, really appreciate your time. Portwood Capital MD and Hong Kong General Chamber of Commerce Economic Policy Committee member there joining us. And let's take you to Seoul, where we are looking at live shots of the courthouse, where we are awaiting the arrival of the heir apparent to Samsung Electronics. JY Lee is set to appear in court today, as the court will decide if he should be arrested for possible involvement in alleged merger and accounting fraud. Of course, this is part of cases and a contentious legal dispute that JY Lee has been facing with Korean prosecutors dating back to 2015 over whether Lee and Samsung as a company used illegal means to help him take control of the conglomerate that was founded by his grandfather. So we'll be bringing you developments in that case as they emerge. Lots more to come. This is Bloomberg.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day winning streak. Moves in the currency market, which is down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
U.S. and Japan duke it out over exchange. China's slumping onshore bond market is great.
A quick check of the latest business flash headlines this hour. The anticipated winding down of the coronavirus lockdowns is prompting a recovery at rental sites like Airbnb. Business had essentially shut down in March with people confined to their homes, but Airbnb says that the gradual easing of restrictions has brought a rise in demand for vacation rentals. CEO Brian Chesky says people want to get away but aren't keen on taking a plane yet. British Airways is threatening to fire all 4,300 of its pilots and rehire them on individual contracts in a dispute with unions over new employment terms. BA aims to shed 12,000 jobs as it navigates the coronavirus disruption. The carrier has also begun a legal fight to stop the UK self-isolation requirement for arrivals. BA says the 14-day rule would thwart plans to resume services in July. South Korean financial authorities will provide 1 trillion won, that's around $828 million to keep the country's flag carrier operational during the coronavirus pandemic. Government issued guaranteed bonds will be issued as early as the end of this month. Korean Airlines has already received a similar amount for the first half, and the latest funds aim to keep the carrier afloat through the rest of the year.
Now let's take a look at markets this morning. The Nikkei 225 rising for a sixth straight session, but Chugai Pharma, Japan's leading oncology company, stalling after a 60% gain this year. It is the best performer on the Nikkei and the biggest drug maker in Japan by market value. Now over in Seoul, the Kospi adding about 0.6%, with EM assets finding favor. The index edging closer to clawing back its year-to-date losses. And over in Wellington, the NZX 50 resuming gains, trading at a March 6th high with Air New Zealand among the gainers. Now Brent topping $43 a barrel on the back of that OPEC Plus agreement. Now let's switch out the board to check in on U.S. futures this morning, edging higher with S&P E-minis topping 3,200 just earlier. Taiwanese stocks could be set for gains, watching Hanhai after sales rose in May at the fastest pace since October. Chinese futures pointing higher, and the offshore yuan just holding a 2-day gain, hovering around 707, looking to settle into a range with implied vol staying quiet for the currency. Now that's it from Daybreak Asia. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. Stand by for Bloomberg Markets, the China Open. This is Bloomberg.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil. The Bloomberg Commodity Index.
It is 9 a.m. in Beijing, Shanghai and Singapore. Welcome to Bloomberg Markets China Open. I'm Tom McKenzie with David Inglis. Our top stories: Asia-Pacific markets start the week with gains after U.S. payrolls smashed expectations and bolster hope of a swift rebound. Global stocks have added $20 trillion since the bottom in March. Oil rises again as OPEC and its allies agree further output curbs. The new deal lasts a month and is seen as a win for recent rivals Saudi Arabia and Russia. Production compliance, though, is key. And China's trade surplus rose to a record last month as a jump in medical exports helped outbound shipments fall less than expected, the surplus climbing to $63 billion. So do we need to readjust to an environment where growth is actually picking up faster than some of the economists had expected? Those US job numbers, as we said, really smashing those forecasts from the economists. And here in terms of China, the trade data, it wasn't terrible. Exports contracted less than expected. The import numbers suggest that there is a bit of a pickup in terms of domestic demand. And that phase one trade deal we heard from Trump, again, seemingly to suggest that they do and are intent in keeping that trade one deal going, saying that he is seeing a pickup in terms of Chinese purchases of US ag.
Bits and pieces, Tom, all of them coming together, really mostly forming this picture that the recovery could come faster. Of course, that could change, but markets are latching on to what we've seen starting really about 2 weeks ago with India GDP, and of course the jobs number that you mentioned there back on Friday really bolstering what we're seeing right now with, global equities are continuing this run early Monday here with global stocks, by the way, last week. Best week since early April. You're getting, of course, a lot of lift off here, and a lot of these markets in the Asia Pacific are actually now very close to erasing and reversing all the losses for 2020. Flip the boards, have a look at where you are in the currency markets. By the way, CSI 300 want to watch later on, close above 4,000 for the first time in months on Friday there. Dollar China 707.46. Euro dollar, of course, that's a little bit below 113 right now. Dollars on 3 weeks of declines. So far, dollar index, watch it very closely as well, of course, given, I guess, where you are there on the basket. Flip the boards and have a look at where we are very quickly here. 2 and 10, so we're back above 90 basis points. We're up 7 basis points Thursday, another 7 on Friday. We're up a further 1 right now. We're looking towards 1%. And by the way, in case you missed it, pricing for negative rates out of the Fed within the next 12 months has basically now been priced out and has disappeared. $43 right now gets you a barrel, Tom, of Brent.
Let's get reaction now to that trade data that we got out over the weekend here in China. China's trade surplus rose to a record last month as a jump in medical exports helped outbound shipments fall less than expected. Exports dropped by 3.3% in dollar terms from a year earlier, while imports slumped almost 17%. Let's discuss all of that with Citigroup Chief China economist Liu Ligang. Ligang, thank you for joining us this morning. Your reaction, what are the key takeaways from this trade data beyond the headline numbers?
Yeah, thank you, Tom. Indeed, this is a better than expected trade data. Although, the market think, the export growth could be much more negative. The upturn was slightly minus 3.3%. And this means that given China has rather complete industrial production network in time of need, other countries will have to import the necessities and medical supplies from China. Keep in mind that the data basically, except the EU, tend to see rather positive, all tend to see negative growth other than EU. And in terms of some bright point within the data in May, is that China continued to import a lot of soybeans from the United States, suggesting that China still is very much willing to uphold the phase one deal. Indeed, since the outbreak of the coronavirus, it appears that the trade relations is the only positive communication channel between these two countries.
Yes, certainly. They seem to be showing a willingness to stick to that phase one deal. And as we mentioned, President Trump saying that he's seeing China buying more agricultural products. I guess the question is, can they actually do it? Is it sustainable? to match those purchase requirements or commitments that they made to the US? Do you expect them to be able to stick to those numbers given the economic slowdown that we've seen here?
Indeed, I think if you look at China's foreign exchange reserve data, also released on Sunday, it rose a bit to 3.1 trillion US dollars. Yeah, this means that China does have the capacity to buy more goods from the United States. And as you can see that in the phase one deal this year, Chinese additional purchase of U.S. goods could be as high as 76 billion US dollars, with 50 billion in agriculture goods. So in a sense, I think if there's a will and the phase one deal should be able to be fulfilled by the Chinese side.
Li Gang, David here. What's your assessment on the overall unemployment situation? How has that changed over these last, I would say, even 6 weeks?
China's unemployment situation continued to deteriorate for sure. We all know that within the export sector, directed, indirect, unemployed, workers affiliated with export sector is about 200 million people. Out of the 200 million, 80 million people are migrants. Given China's export growth has been in the negative territory, indeed, we need to worry the significant rise in China's unemployment. We estimate that this year, China's unemployment rate could rise from the current 6% to 10%, leading to around 25 million unemployed population. So this then requires the government to use some innovative approach to boost the job creation. Indeed, in China these days, there's a new term. It's called internal circulation. That is, those exporting firms that cannot send their goods to the rest of the world, they are encouraged to use the domestic market for those goods to be consumed domestically. However, we need to see further liberalization or removal of red tapes, especially in the logistics industry, in order for this internal circulation idea to be successful.
So that then takes us into the consumption question. If unemployment is continuing to deteriorate, the jobs numbers well, and obviously we have to find buyers for all these things that are being churned out by Chinese factories, Li Gang. Why isn't it not showing up on the consumption and retail sales numbers? Where do I look for clues that the consumer might not be as healthy as we think?
Yeah, in our May forecast, we still think that China's retail sales will remain in the negative territory, although narrowed quite a lot from the previous months. We still see around negative 5%. So we are seeing this kind of very uneven economic recovery. On the one hand, China's industry production has picked up quite strongly. We expect May to see industrial production pace at around 5.5%. However, if you look at China's GDP by expenditure, fixed asset investment, consumption remains in a contraction space, suggesting that indeed we will continue to see unsold inventory in the coming months. If that cannot be consumed domestically, and this could be a quite important deflationary pressure to the global economy.
Li Gang, thank you so much. Out of Citigroup, their chief China economist here. Some breaking news out of Indonesia right now. One stock to watch, obviously, when the stock starts trading in about an hour from now. So we're talking Indonesia's Indofood CBP here. The company will be buying Pine Hill Company, and the price tag there, $3 billion US. Again, stock to watch when Indonesia opens up in about, well, top of the next hour. All right, Karina Mitchell is in New York, and she has an update of your first word news. Karina.
Hey, David, good morning to you. Worldwide deaths from the coronavirus pandemic have now topped 400,000, with infection numbers approaching 7 million. The news comes as China rejects renewed accusations it withheld details about COVID-19, saying it has always been transparent and informed the outside world about developments in a timely manner because of the virus. The latest U.S. infection data shows a rise of 1% to just under 2 million cases. Meanwhile, Japan contracted less than originally estimated last quarter after stronger capital investment, even as it sinks into recession. The updated report shows GDP shrank an annualized 2.2% compared with the end of 2019. That's better than the initial 3.4% estimate. It still means Japan has contracted for 2 straight quarters, with an even sharper drop expected in the current quarter. And Minneapolis says it's beginning the process of dismantling its police force in the aftermath of the death of George Floyd. The majority vote is veto-proof, and the city council members say they'll consult the community on what should happen next. On Saturday, Mayor Jacob Frey was booed by protesters after saying he did not support the abolition of the police. He was elected in 2018 after promising to mend relations there. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. David.
Still ahead on the program, we count down to the open of markets in China. And when you look at the economy in focus, really, Hong Kong's financial secretary Paul Chan and Wendy Liu out of UBS, of course. Stay tuned for those conversations. And we'll also discuss the OPEC Plus extension. Vandana Hari also joins us next.
Yeah, but next, America's economy looks to be rebounding faster than expected. We'll run through the job numbers and consider the Fed's next move. This is Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
Welcome back. You are watching Bloomberg Markets China Open. We're a few minutes away from the open of trade in the Chinese mainland and Hong Kong.
Yeah, it's looking up, looking at how other markets are trading right now. So you have Japan, Korea, obviously Australia, by the way, is close. The global stocks extending this global rally here on the back of just a surprise jobs number that we had on Friday. Let's bring in Kathleen Hayes, our global economics and policy editor. She's here with the numbers. Kathleen, you told us last week there was a strong signal from the ADP report that the report, that came out on Friday could actually be better. Was there any reason to expect what President Trump then called this outstanding jobs report?
I have to say not really, because it's true the ADP survey was a strong signal. It surveys private jobs, and it did suggest, oh, maybe we won't get a 7.5 million drop in the May payrolls. Nevertheless, nothing like a record monthly rise, and that's what we saw in payrolls. And the fact that the unemployment shocker, it was supposed to move 3 or 4% higher, it actually fell down in the latest month. So all of this adds up to, a jaw-dropping report is what many people called it. Sure hit the markets that way, didn't it, Dave? So let's take a look at a chart as we talk. We'll just put these numbers in visual perspective, because you can see the top line on this chart is showing, again, the surprising jump in payrolls. It's the biggest monthly jump since the numbers were tracked in 1939. And you can see that big, almost 21 million person drop the month before. Unemployment at 13.3%. It was supposed to jump to 19%. Now, it's true. The Bureau of Labor Statistics did say it could have been maybe even 3 percentage points higher, except workers are a little bit confused when they get called on the phone to say if they're furloughed or unemployed. Nevertheless, still a better than expected number on the jobless rate. Where's some bad news? Well, we've still got 21 million U.S. workers who remain unemployed. That's the biggest amount since 1940. Black unemployment, actually that gap widened out against white unemployment. It's now the highest since 1984 at 16.8%. Bloomberg Economics, like so many economists on Wall Street, saying, hey, there's got to be more fiscal spending. President Trump actually agreed as he called the report outstanding. Let's listen to what the president called for.
We're going to be asking for a payroll tax cut. We'll be asking for additional stimulus money, because once we get this going, it'll be far bigger and far better than we've ever seen in this country.
Of course, Republicans and Democrats will still have to battle out what kind of stimulus package, if any, comes. Mitch McConnell, the Senate Majority Leader, said last week nothing will be discussed until after the July 4th recess. That puts it out to about July 20th.
Let's just update our viewers on the reference rate for the currency here in China. 7.08 per US dollar is the fix, just marginally, a fraction weaker than the estimates. The offshore currency, by the way, has weakened about 0.1%. It's currently trading at 7.079. The PBOC also, by the way, injecting 120 billion yuan in terms of 7-day reverse repos in terms of liquidity. Talking of liquidity, with the stronger jobs report in the background, what is the expectation from the Fed on Wednesday, Kathleen?
No change, but in a good way. Reaffirm the pledge to keep the key rate near zero until the economy gets back on track. Powell's expected to stress at the press conference after the meeting the willingness, the ability to provide more stimulus as needed. There's already 9 emergency lending programs in place. Some of them have barely gotten started. He's going to stick by that. Actually, the jobs report has helped extinguish bets on negative rates. Back in February, if you look at this chart, people were looking for rate hikes. Then lockdowns, pandemic hit, and they were betting on negative rates during May. Now that has turned again to people not looking for that, but certainly not looking for hikes. Yield curve control, though, is an active discussion right now, not only for private corporations to borrow, but how about the U.S. government? Like every other government in the world issuing so much debt, you'd rather maybe have some yield curve control to keep that from getting too expensive. But that's also expected to be in the discussion, and probably he'll get asked about that at the press conference as well.
Our global economics and policy editor, Kathleen Hayes. Coming up on the show, Hong Kong's financial secretary sees no obvious capital outflows amid rising tensions at home and abroad. We hear from Paul Chan next. This is Bloomberg. Welcome back. Hong Kong's government is promoting a message of stability, in particular for its currency peg, unbroken since the 1980s, as the territory charts a course to revive its flagging economy. Bloomberg spoke to Hong Kong's Financial Secretary Paul Chan about when he sees a recovery.
This year, I think towards the second half of the year, particularly in the fourth quarter, this is hopeful. But this is very much depend not just on ourselves, but number one, the coronavirus situation globally. Because if globally this is under control, then a lot of economic activities can be revived. And secondly, the relationship between the US and China, particularly on the trade front, that would affect our foreign trade. And also thirdly, when at the moment, when we get the coronavirus situation under control and the society back to a stable environment, we are going to encourage our own consumption. Say, for example, the $10,000 scheme for every eligible Hong Kong citizen.
People are still waiting for that, by the way.
It's coming soon.
That's been a big complaint of local people, that they haven't gotten their checks yet.
Yeah, we heard that. We are working very hard to
Why
set
did
up
it
the
take
system.
so long?
Well, say, for example, in the US, you pay tax on a pay-as-you-earn basis. We pay tax once in a year, and we have also a very stringent Data Privacy Act. The data we gather from our citizens from different sources cannot be used for this particular purpose.
More stimulus needed, and where and how?
Well, we are working very hard to roll out the stimulus package that we have outlined in the budget and 2 rounds of anti-epidemic fund. Wait till these measures are all rolled out before we decide the third one.
Well, first quarter GDP growth was down 8.9% year
Yes.
over year. I think the worst on record.
Yes.
Is that the worst for this year? And do you have any reason yet that you can give us that you might have to revise your full year forecast again? I think it's for a contraction of 4 to 7% for the full year, right?
We will be doing another update in August as part of our regular process.
What are the tea leaves telling you right now?
Well, very much depend on external virus situation and the economic recovery in Western countries. Yes, we suffer dearly in the first quarter, but globally, I think we are in a global deep recession because of the virus.
Are you seeing any indications of capital flight?
Well, facts and figures speak louder than words. Ever since the announcement of the intention to legislate national security law, the Hong Kong dollar to US dollar convertibility undertaking has all along been on the strong side. When I talk to the banks, when I talk to the private wealth management individuals, when I talk to Hong Kong MA, in fact, there is no obvious outflow of capital.
The local news, though, shows signs of people a little bit worried. I mean, local money exchanges running out of US dollars, or they're lining up to get US dollars or other currencies. That's happened in the past in times of crises. People seem to want to get hard currencies. Is that just a temporary phenomenon right now, or is that an indication that there are some deep-rooted concerns in society?
I do not believe this phenomenon is a reflection of any deep-rooted issues as such. I would say this is a short-term anxiety and sentiment. Last year, during the social turmoil, we saw similar phenomenon. And in fact, last year, when we went through those difficulties, our financial market had been operating very smoothly. And again, there was no obvious capital outflow. The total deposits in the banking system at the end of last year, compared to the beginning of last year, registered a very modest 1% growth. And so far, this in the past 4 months, in the past 10 days, we did not observe any obvious capital outflow.
And that was Paul Chan, Hong Kong Financial Secretary. By the way, he's giving a press briefing a bit later on as well, 11 a.m. local time, so watch out for that one. We'll get to that covered, of course. In the meantime, against the backdrop of this, we're going for 6 out of the last 7 weeks of gains here across global equity markets. 10-year yields now back at 90 basis points above zero. Have a look at the commodity markets right now. So 43, roughly 42.43 on Brent, $100 on iron ore. Check that out over in Singapore. And setting us up for the open in Hong Kong, we're back above 25,000 for the first time since early March on the benchmark here. We'll get plenty more ahead, really, on the shows. You had trade numbers out of China as well. We're looking ahead to the Fed. The open is coming up next. This is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Okay, there we go. Just under a minute away from the first trading session of the week. Beautiful, I'd like to say foggy, not smoggy morning, and hopefully I'm correct there with that assumption. Just to mention as well, one market that's opening up here is the Philippines, and just the central bank governor saying that they are participating in the FX markets right now. Perhaps, I would imagine, to stem the strength there in the currency, which has been trading on the stronger side of 50 for the first time since 2018. But we're still focused on China, Tom. Lots to consider. Yeah, the trade numbers out on the weekend, and of course, inflation numbers midweek.
Absolutely. So the markets will be digesting that economic data. And we heard some comments from Trump as well on Friday, US Times, suggesting that there is still an effort on the US side, as we heard from the Chinese side as well, to preserve this phase one trade deal. We're also looking for any action from the PBOC, by the way, because there's about 500 billion yuan of medium-term lending financing or facilities lending that is due today. So will that be rolled over? How much and at what rate? So we'll be watching for that as well. The futures were pointing up here for the mainland, and that is how it's playing out now in the very early moments of the trading session here. 4,000, just above 4,000 for the CSI 300, up 27 points. Is it on momentum? Is there enough momentum to get them to 4,200, which was the year-to-date high, by the way, in early March? Shanghai and Shenzhen also in the green, and the Chinex small caps adding 16 points there. We can move it on to the currency. Had a fix just marginally weaker than the estimates, but we're looking at this in terms of the trading basket against its major trading partners at the CNY, and it has weakened for 15 straight days. So a boon there for exporters, for China's exporters. Does this continue? Of course, versus the dollar, you've seen dollar weakness, which has seen the yuan strengthen against the US dollar, but it has given them an opportunity then to see a bit of softness versus the trading partners, again, boosting the exporters there. and something to bear in mind and to continue to watch. We can move it on to a couple of themes as well in terms of what we're watching here in mainland China. Looking at some of the cosmetic players, the domestic cosmetic players, which are actually trying to carve out some market share. Investors have been betting on the likes of Proya and Guangdong Marubi. They're actually doing very well year to date. Proya is up about 80%. Very digital focused, local cosmetics companies trying to carve out market share from some of the bigger incumbents, foreign incumbents. The other aspect or theme that we're looking at is the fact that a lot of tech companies here have been raising money offshore, the likes of Tencent and Xiaomi as well. So how that plays into investor appetite for some of these stocks is another question. David.
Yeah, the open in Hong Kong was above 25,000 using the past tense there. Since then, we've come a little bit lower right now. What are we? Yeah, there we go, 18 points below that that threshold, if you will. A couple of stocks as well we're tracking. 8 Hong Kong exchanges, which operates the exchange here in the city. It's going to be a very big next 2 weeks here in terms of new and big listings in the city. You have NetEase and you have JD.com. Some final pricing this morning, $236 a pop there, 133 million shares. About $4 billion listing there. So said to be oversubscribed, both the retail and institutional tranche there. As well, Hang Lung Properties up despite the fact that the company on Friday post-market came out and said, hey, we might see a loss for 2020. But that being said, really, this theme of markets remaining fairly divorced from reality, or looking ahead, let's put it that way, perhaps a theme to consider as we move ahead. 42 stocks up, 7 down, 1 unchanged on the Hang Seng Index, Tom.
Yeah, let's bring in now UBS's head of China strategy, Wendy Liu. Wendy, when you look at the market action, you take into account some of the economic data that we've got out over the weekend. We're looking ahead to inflation, as David said, later in the week. Is there more momentum? Is there more upside for Chinese equities? Are we going to be looking at 4,200 for the CSI 300 by the end of the year? Or are investors overly complacent about all of these risks that we discuss?
I think in the month of June, it would be critical to look at what happens on the liquidity front, both from the PBOC and the Fed. Suffice to say, when we speak to investors, the rally since mid-March was, in large part due to the plentifulness of the liquidity. And then more recently, this cyclical upside trade from the reopening of the economics. So I think liquidity is what we should focus on.
The focus on liquidity. And in terms of capacity and getting back to full capacity, it's something that The Economist magazine has written about, a 90% capacity world and the detrimental effects that that would have. What are you seeing in terms of China's economy getting back up to full speed, and how does that translate, do you think, into earnings going forward?
We look at the capacity issue and precisely that and come to the conclusion that interim numbers are probably going to be below consensus expectations. So the real economy is taking on a lot of hit. The winners are the digital-enabled space or the sector leaders with digital capability. They have to have that capability before the COVID crisis hit. So it's not something people can change right away. And in the reopening of the DM market, there's some anticipation that China's resumption of business is a bit of a benchmark to look forward to. So I think as we get closer to late June and into July, people's going to be able to figure out if that is the case. So I think there are risks on marginal liquidity, and there are also risks on interim results. I.e., what is the post-COVID full capacity vis-a-vis the previous norm?
Wendy, David here. What would that EPS growth look like then on a full-year basis by the end of this year, given that you do think that we're not going to be able to reach what was previously capacity or full capacity on the EPS front?
Yeah, so for MSCI China, our base case is a 6% decline. CSI is a up, year over year of 3%. HSI is a decline of 17%. And vis-a-vis consensus, it's 9% below for MSCI and CSI 300 and 5% below for HSI.
Okay, if you had to pick one, CSI 300, MSCI China, and soon to be a little bit different, HSI, which of the three do you like?
That's a very tough call, and depending on the date of entry. I would say the most resilient, as we see right now, is CSI 300 because the domestic liquidity is a little bit unique to itself. But then HSI generally have been viewed as a weaker index because the constituents, only 27% of them are in the new economy bucket, whereas about 45% in CSI 300 and 58 to 60% of MSCI China is in that latter bucket. So I think it really depends on the entry point. And I think at these levels, we'd be a bit more wary of the downside risk.
Wendy, where do you stand on the growth versus cyclicals and defensives argument that's taking place now? Are you starting to get more appetite? If these liquidity issues resolve themselves, do you become slightly more risk on in terms of moving to cyclicals?
We were quite optimistic on the market in mid-March and asked people to raise exposure. But we also suggested as we move beyond late May, early June, there could be downside risks. We also did analysis on how different styles performed during the global financial crisis a little over 10 years ago. And growth really won very handsomely over defensives and cyclicals. Cyclicals is about timing the upswing. If we lose that timing, it's difficult to get the performance. And I think in the current environment, what we see is the COVID-19 pandemic has greatly accelerated digitalization around the world. So there's structural gainers and structural losers. And the growth bucket happens to be in that structural gainers. So I think we buy equities for growth, and there's no argument we got to be in growth. We just need to be in the sector leaders in traditional industries with digitalization capability and the digital platforms and enablers. However, within cyclicals, we are also seeing market share concentration rising, improving pricing power in some cases. So we would be more selective on the stock picks. Now, on defensive, something interesting is also happening. Within the China space, there's some defensive that's been price regulated for a number of years, valuation very cheap, dividend yield pretty high, and in this yield, challenged environment, if the regulatory picture stabilizes a bit on the margin, they could be quite attractive also. So depending on the
Wendy Liu, thank you very much. Wendy, we have to leave it there, I'm afraid. Thank you very much for your analysis. Always great to get you on the show. Thank you. UBS Head of China Strategy. Let's get you the first word news now and some of the updated stories we've been looking at. China's simmering spat with Australia is deepening, with Beijing issuing a travel warning saying discrimination against Asian people is on the rise. The Ministry of Culture warns Chinese travellers to be on alert and not to go to Australia. The warning follows Canberra's call for an investigation into the origins of the coronavirus and Beijing's decision to put tariffs on some imported Australian goods. New York City has lifted its protest curfew as it prepares to reopen for business after the coronavirus pandemic. State Governor Andrew Cuomo says COVID-19 is the #1 variable for the city and is calling on all protesters to seek health checks. The weekend saw some of the biggest Black Lives Matter demonstrations across the US, most of them peaceful and with arrests sharply down on previous rallies. Russia is investigating a massive oil spill in Siberia. An estimated 20,000 tons of fuel leaked from a storage plant outside the city of Norilsk, about 1,800 kilometers northeast of Moscow. The plant is operated by Norilsk Nickel, which is accused of making the area one of the most polluted places on Earth. President Putin and other leaders only learned of the spill through social media.
All right, coming up here, we're talking oil advancing after OPEC Plus extended output curves. But the next guest says prices will actually stay where they are over the short term. In fact, we've come off our highs already for prices of Brent right now. In a moment, Vanda Insights gives us their outlook for energy markets. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Okay, welcome back to the show. A couple of minutes into the session here, so we're losing some momentum across risk assets, oil included. We were above 43 bucks earlier on, but have since, what are we doing now? There we go, 42.25 on your most active contract. Still, though, when you look at this longer term, we're still above 40 bucks. We're still right in the middle of that gap lower that we had back in March when, well, then the previous OPEC plus talks collapsed and really taken us all the way down to about 20 or 20 below, and we're now obviously recovered most of those losses right now. But where do we go from here with oil prices, and have we priced in basically all the information that we have on the table? Let's bring in our guest, Vandana Hari, founder and CEO of energy markets research firm Vanda Insights. Vandana, thank you for coming on the show. Good morning. Do you think things are fully priced at this point?
Good morning to you, and thank you very much for having me on your show. I do feel crude has priced in the decision that was taken over the weekend, a one-month rollover of the deeper cut. If you recall, it was telegraphed to the market effectively last Wednesday when news reports said that Saudi Arabia and Russia had effectively or informally agreed to extend the deeper cuts by a month through August. Through July, beg your pardon. So I think it's mostly factored in. We saw prices rising steadily towards Friday, more than a 5% jump on Friday alone on news of the OPEC meeting finally coming together on Saturday. So I see limited headroom right now. I think demand will now need to come in and do its part.
We saw that with China, though, back in May. In fact, you know, the Chinese, they imported a record amount for May. I guess my question is, looking forward, is the market actually rebalancing quicker than most people think at this point?
Yeah, so as I say, a swallow doesn't a summer make. I think China is probably diverged a little bit from the rest of the world. Indeed, there was news over the weekend that Chinese crude imports reached an all-time high of 11.3 million barrels per day, quite incredible for a lot of people in the market in May. But then again, one has to remember that China was just lapping up crude through April when we saw the worst of the price crash. And when you're buying through April, you get those barrels delivered through May, which is why we see this spectacular jump in Chinese imports tallied for the month of May. Look, in China, yes, domestic demand has recovered. We do know that the country is running almost 2 months ahead of the rest of the world when it comes to reopening. But then I do feel there's going to be a limit. Some of the crude buying was for stocking purposes. Some, of course, because the refinery rates were up. But how much more can they continue to crank up refinery runs? You know, as the crude prices rise, and which we have been seeing over the past few weeks, their margins are not going to be that good. They're not going to be able to export that much more, oil at a good profit margin. Asian GRMs have been in the negative for almost since mid-March.
Vandana, what is happening with U.S. shale? Is the sector starting to come back online now? And what are the implications if that is happening for OPEC Plus and the deal that it's come to?
I'm glad you asked that question. I think there's a bit of a misinformation and I would say probably some misunderstanding happening in the market as well. Every now and then we see reports so-and-so is planning to bring back shut-in wells. And while those reports are entirely legitimate, it doesn't mean shale is about to rebound. Far from it. So there's
two phenomena happening in shale, and we need to understand that very clearly. There were some producing wells that were shut in simply because there was nowhere to put that crude, and the buyers had just disappeared mostly through April and May. Now, as demand returns in the U.S., obviously it makes sense for the producers to bring those shut-in wells back on stream. But there's also a bigger phenomenon happening in parallel, which is a huge capex cut. So rigs have been laid off, fracturing fleets have been laid off, and they are not going to come back. They're not going to come back, to my mind, until we see perhaps around $50 and sustainably at those levels. Let's not forget, there may be plenty of volatility, uncertainty in the market still, despite the price recovery. So no, I don't think there's a rebound happening in shale. We might see some of the shut-in production come back through Q3, but year on year, I think, according to our calculations, we're going to probably see 1 to perhaps even 1.5 billion barrel per day drop in crude production in 2020.
Yeah, and the enforcement mechanism is going to be key for this OPEC Plus deal, it seems, as well. Vandana, thank you very much indeed. Vandana Hari, CEO and founder of Vanda Insights, I should say. Thank you for your analysis and for coming onto the show. Now, coming up, Big Pharma looks past the pandemic to a potential tie-up that could be the biggest in healthcare history. Details of that potential deal next. This is Bloomberg.
Okay, just to tell you about this rolling over here of your 7-day repo over in China, 150 billion renminbi, and what's key here is the rate is, well, they're doing it at the same rate, 2.2% there. Not really getting any sort of market reaction here, but just keep in mind, as we move into the latter part of June, there's a lot of liquidity that's getting taken out of the system, so do expect perhaps a little bit more injections out of the PBOC to keep money market rates in check, which, by the way, have actually gone up and are still up and elevated compared to levels of early May. Tom?
Let's get the details on this potential mega deal in the healthcare sector now. Two drug makers behind the most prominent responses to the COVID-19 pandemic are looking into the possibility of a combined future. Bloomberg has learned that UK-based AstraZeneca has made a preliminary approach to its US rival Gilead. Sue Keenan has the details. And Sue, if this deal was to happen, if they were to pull it off, it would be a blockbuster for the industry, right?
Yeah, and that's almost an understatement because it would be the biggest combination dollar-wise in the history of the drug and healthcare industry, an almost $240 billion combination. Now, AstraZeneca is the UK's biggest drug maker, valued at $140 billion, and it's also one of the co-developers of a promising vaccine for the coronavirus. Then you have Gilead Science. Here in the U.S., it's valued at $96 billion as of Friday. And Gilead is the maker of the only U.S.-approved treatment for the coronavirus so far, remdesivir. And Bloomberg News has learned that AstraZeneca made a preliminary and informal approach to Gilead about a potential merger a month ago. This is according to people close to the matter. And they say that contact was made to gauge the interest of a possible tie-up. Now, these people are saying that no terms were specified, no formal talks have taken place, and we're told Gilead has discussed the idea with advisors, but no decision has been made. Again, this is all according to people close to the matter. Representatives for both companies have declined to officially comment.
Now, what will this mean, though, Sue? Because some analysts are saying that this kind of merger actually could signal a return to normalcy for many of these pharma companies, which right now, as you pointed out, are actually focused on developing or on focus on treatments for COVID-19.
Yeah, there had clearly been a race to find the vaccine, to find the treatment. A lot of analysts says this would not likely generate a lot of profit for companies, so the return to normal that this appears to signal is welcomed. And if you look at the deals that have taken place in the industry over the recent years, you can see that this combination would by far away be the largest deal in history. So a lot of thought and speculation, and even the speculation alone, observers say, is a positive sign that the drug industry is starting to look past COVID and the landscape perhaps changing. Back to you.
All right. As with many markets and assets right now and how they're priced, Sue, thank you so much. Sue Keenan reporting there. Now, quick check of your latest business flash headlines, and let's have a look at Singapore Airlines here. So the company has secured the equivalent of just over $7 billion US in fresh liquidity as it looks to ride out the coronavirus pandemic. Just over $6 billion of that was secured in a rights issue. That was last Friday. Now, the airline says all committed lines of credit due 2020 have been renewed for at least another year, and another $500 million is being raised in a short-term unsecured loan with several banks. Now, Taiwan Semiconductor is reported to have won extra orders for 7-nanometer chips, with production lines remaining fully loaded through the end of this year. The Taipei-based Commercial Times says orders come from Apple, Qualcomm, AMD, and others, and they'll help make up for declining chip demand from Huawei's high silicon technologies amid pressure from the United States. Now, the anticipated winding down of the coronavirus lockdowns is prompting a recovery at rental sites such as Airbnb. Business had essentially shut down in March with people confined to their homes, but Airbnb says the gradual easing of restrictions has actually brought a rise in demand for vacation rentals. CEO Brian Chesky says that people want to get away but aren't keen yet on taking a plane. Speaking of being on a plane, markets up for a sixth straight session here in the Asia Pacific, longest win streak now going back to early of 2019. Equity markets in China are on the way up as well. We've now cleared 40 points of 4,000 on the CSI 300. Hang Seng Index is inching back. We'll see if we get there, Joe, back to above the 25,000 level. Right, dollar China 708.77, and of course the backdrop here is yields on the way up, and the dollar is on a 3-week losing streak going into today as well. Lots of data to tell you about. Well, a couple of key events this week. You have the Fed, of course, midweek. You have inflation numbers out of China as well, and we're coming off that blockbuster jobs number on Friday, which is continuing to reflate assets and steepen these yield curves the world over. So anywhere you look, Tom, pretty much you don't see any signs of a recovery or the deepest recession in about 100 years. But then again, people say that markets do look ahead and look forward.
Yeah, and will that mean sustained dollar weakness, and what are the implications for this part of the world? We can talk about that with Asia FX, and in terms of MUFG Bank Global Markets, Cliff Tan. We can discuss some of the implications of those currency moves. We're also going to be discussing Chinese airlines and the aviation sector post-COVID with BOCOM International's Lu Ya-Yo. We've seen today Hong Kong suggesting they'll weaken some of those quarantine requirements for business executives. So lots more to discuss. Stay with us. This is Bloomberg.
Chances are you may have started cooking more during quarantine, which means you've made plenty of trips to the grocery store, either in person or virtually. But brace yourselves, that chicken wing and hamburger patty, it's about to cost you more money. Just 4 meat processing plants account for about 80% of production in the United States. Back in April, President Donald Trump ordered all meat processing plants stay open.
They're going to be very careful. They are. As to who's going into the plant, the quarantine is going to be very strong.
Even as workers fall ill and production output suffers. So where are plant operators in all this? They have to go through lower productivity and higher costs, which means they need to make some major changes. And some plants are already running slower because of social distancing and fewer workers, and some production lines are fully automated. Tencho Das is a professor at the New Jersey Institute of Technology. He gives us the numbers. He says reducing meat processing plants to 1/3 of their capacity and also distributing the adequate protective equipment, this could all boost chicken prices at grocery stores by 25 to 30%. That means if you buy chicken at 99 cents per pound for 5 pounds, now at $5.95, it could cost you up to $6.44 before taxes. That means higher costs for an industry that's been pretty efficient at putting out cheap protein.
Well, it's almost 10 a.m. in Beijing, Singapore, and Hong Kong. Welcome to Bloomberg Markets Asia. I'm Yvonne Mann with Haslinda Ahmed. Our top stories this morning: China's trade surplus rose to a record last month as a jump in medical exports helped outbound shipments fall less than expected. The surplus climbed to $63 billion. Asia-Pacific markets rise for a 6th day amid growing hopes of a swift post-virus recovery. Oil edges higher as OPEC and its allies agreed to extend production curbs for another month. But oil prices losing a bit of momentum now in the Asian session. A major shakeup we're also following is the killing of George Floyd, as Minneapolis says it will dismantle the police. We'll have the latest on the protests in the U.S. and beyond. And take a look at markets here on this Monday morning. We are still seeing mostly higher here when it comes to risk assets, although we are losing a bit of steam here as we kick off this trading week. Yes, that job surprise from the U.S. really lifting risk assets here. But then again, you have oil prices also petering out a bit here. So it seems like right now we're kind of slightly higher for Asia Pacific. Jakarta just coming online, still seeing gains of more than 1%. Interesting to know the likes of the CSI 300 in China inching above 4,000 here for the first time in some months or so. Take a look at what we're watching when it comes to currencies, though. Dollar seems to be gaining a little bit of footing here this morning. It's a little bit of a gain for the yen. So with the exception of the yen, dollar mostly actually higher against some of these currencies. The Kiwi and the Aussie, which were the early outperformers, seem to be also losing some ground now. But the Aussie certainly has had such a relentless rally. Take a look at what really has been driving the sentiment here today is the likes of oil. If you flip the boards, after 6 straight weeks of gains, this rally seems to be taking a bit of a pause. You take a look at Brent, we're still hovering around 42, 41 after OPEC Plus did reach that deal. Crude in the U.S., New York crude, now around 39.52 or so. Keep in mind, we're watching the likes of U.S. 10-year. We surged to that 11-week high after that jobs report on Friday. We are also backing off now. Of course, a lot of focus on the Fed when they take the stage later on this week. The yield curve, though, one of the steepest in 3 years has.
And expected to steepen further from here, Vaughn. Now, China's trade surplus surged to a record in May as exports fell less than expected, helped by an increase in medical-related sales. Let's get more on this story with our correspondent Selena Wang in Beijing. Selena, what's the context behind the trade surplus?
Yeah, these numbers were much better than projections had, Linda, showing that China's economy is continuing that slow recovery. You had exports falling less than expected, imports slumping, resulting in a record trade surplus in May of $62.93 billion. When it comes to those exports, as you mentioned, they were really bolstered by an increase in sales of medical supplies and masks as the world continues to battle the pandemic. When it comes to that slump in imports, even though purchase volumes increased, you saw that slump because of lower commodity prices. For instance, according to the Customs Bureau in China, the average price of crude oil fell 21% in yuan terms in the first 5 months of the year, even though purchase volumes rose 5.2%. But you do have rising risks to the trade outlook given escalations in U.S.-China trade tensions, and we had reported earlier this month that Beijing has told some major state-run agricultural companies to pause purchases of some U.S. farm goods.
And Selena, as China ramps up spending to support the economy, what challenges does the stimulus efforts really face at this point?
The biggest challenge here is China's massive budget hole. So the government is expecting most major income sources for the government to shrink in 2020, with revenue overall expected to drop 5.3% this year, which, Yvonne, is the first decline in at least 2 decades. And on top of that, you have this decline in revenue being compounded by tax breaks to help these firms survive that have been hit really hard by the pandemic. And when you look at non-tax revenues, the blow is even more evident, and this includes profits from state-owned enterprises. So the way it works is that tax revenues are usually used to pay for spending, including Social Security, education, health, and wages. And then China will use land sales as a source of money for infrastructure projects to generate economic growth. And you're also seeing pressure on land sales. And if they fall far enough, the local government will be forced to pare back spending. Now, even though the government can use money carried over from previous years or other revenue to make up the gap for now, the shortfall is great enough that it's still going to put pressure on spending.
Selena, China due out with inflation and credit data later this week. What are we expecting?
So when it comes to the inflation data on the consumer price inflation, Bloomberg Economics is expecting it to have grown 2.3% in May, so slower than in April. This is as food inflation continues to cool. That's supported by slowing pork prices. You also have lower gasoline prices. However, when it comes to factory gate prices, Bloomberg Economics is expecting a deeper drop of 3.3% in the producer price index, with that deflationary trend driven by weaker demand, lower commodity prices. This deflationary trend is expected to persist given the dim prospects for recovery in the rest of the world. Now, when you look at aggregate social financing, our Bloomberg Economics is expecting that to have increased by 3.5 trillion yen in May, so that's even more than April's expectations, which was far beyond what economists had projected. Now, this would reflect authorities' efforts to ease credit conditions, ease monetary measures, and try to stabilize the economy with an increase in the fiscal deficit.
That was our China correspondent, Selena Wang, with what to expect out of some of the Chinese data here later this week. Let's get to your first word news now. Worldwide deaths from the coronavirus pandemic have now topped 400,000, with infection numbers approaching 7 million. The news comes as China rejects renewed accusations. It withheld details about COVID-19, saying it has always been transparent and informed the outside world about developments in a timely manner. The latest U.S. infection data show a rise of 1% to just under 2 million cases. Japan contracted less than originally estimated last quarter after stronger capital investment, even as it sinks into recession. The updated report shows GDP shrank an annualized 2.2% compared with the end of 2019, less worse than the initial 3.4% estimate. It still means Japan has contracted for 2 straight quarters, with an even sharper drop expected in the current period. Minneapolis says it is beginning the process of dismantling its police force in the aftermath of the death of George Floyd. The majority vote is veto proof, and the city council members say they will consult the community on what should happen next. On Saturday, Mayor Jacob Frey was booed by protesters after saying he did not support the abolition of the police. He was elected in 2018 after promising to mend relations. OPEC and its allies have agreed to a one-month extension of production curves while calling on members to stick to agreed levels amid allegations of cheating. Energy consultant Wood Mackenzie says the deal could see Brent climbing to $50, and it's seen as a win for Saudi Arabia and Russia as they try to rebalance the market. The OPEC Plus Monitoring Committee will also meet every month to assess demand. And still ahead, BOCOM International discusses the prospects for China's aviation market and tells us what the rest of the world can learn as Beijing allows more international flights.
But next, Mitsubishi UFG gives us its outlook for central bank action as the latest data from China and the U.S. suggests things aren't as bad as expected for the global economy. Coming up next, this is Bloomberg.
China's currency has moved away from testing its 2008 lows versus the dollar, but that's not stopped the yuan from weakening against its peers. Take a look at this chart. The renminbi has fallen for 15 straight days against a basket of trading partners' currencies and is close to erasing its gains against those exchange rates this year. Let's get more now from Cliff Tan, MUFG Bank Global Markets Research Head of East Asia. Cliff, tell us a bit more. I mean, we've seen the renminbi down more than 4% against the euro, against the Aussie. Is the direction for the renminbi more clear now? How are you revising your forecast?
It's still not clear. I mean, obviously, with this big jobs number, people are wondering, if there's going to be a risk-on phase going forward. I mean, our view on the bilateral exchange rate is that authorities are probably pretty cautious to try to keep it above 7 because they're not sure about the strength of the recovery in the rest of the year. Against the basket, I mean, we've actually viewed it as a little bit of a reaction to Trump, in the threatened reprisals due to Hong Kong's national security law. So we thought that when the Phase 1 deal was signed, that there might have been an implicit or an unrevealed side agreement that China would try to push that CFETS basket back up to something like 93 and change. We're now back at 91 and change, and that rather noticeable weakening, might have been a little bit of a reaction to Trump stoking the trade fires again. That's the way we've been interpreting it.
So when you're looking at this whole reflation theme that markets seem to be pricing in now, do you think the dollar then is the most valuable gauge, Cliff, of this V-shaped recovery, and do you buy it?
Yeah, I mean, the dollar is a reliable gauge, but it's in the direction of weakness. I also have a saying that, the dollar weakens when it's safe to do so. And so when there is prospects of a stronger recovery, the dollar can weaken a bit because it'll lose some of its safe haven status. Obviously the jobs number was a huge surprise for most of the industry. And, I do have to admit that we economists have a tendency not to see what's staring us right in the face. I mean, I think the way to interpret the jobs number is that it's telling us that the pace, the gradient of the recovery in the third quarter will be a little bit faster than we expected. But, even though that initial gradient is steeper, we're in a really, really deep hole here. And even with some kind of a pretty noticeable bounce in the third quarter, we're still going to be way underwater as far as the world economy is concerned.
Cliff, when it comes to dollar yuan, with rising tensions within the U.S. and China, could the market drive the yuan much weaker than what the PBOC is comfortable with? Some numbers out there suggesting that perhaps 720 is a level that you could be watching.
Yeah, no, we've got the 720 in our forecast for later this year. But, right now, if the economy improves a little bit faster, we're going to actually head in the other direction. So as I said, the earlier question about this jobs number, I would have to say that if you look at all of the data for the U.S. and also for other globally important economies, the pattern is not in keeping with the strength of that 2.5 million jobs. We are improving. We're improving along this kind of elongated U that we had expected, but we're not seeing a V. And this is, I still think that that's the fairest conclusion. But, in the short term, in the next, 2 weeks or so, we have to be very vigilant that we're not missing something, that's obviously staring us in the face.
That's the jobs data in the U.S. How about the trade data out of China, which we saw just yesterday? Export drop shows perhaps, the weakness in external demand and perhaps that China needs additional stimulus, both in terms of fiscal and monetary. How do you see policymakers responding?
Well, I think the trade numbers, as you know, was greatly influenced by the sale of medical equipment from China. I've heard some interesting anecdotes in the last few weeks about just how much work it took to work out all the logistical kinks to get that medical supply out of China and to other places like the U.S., for example. As we go into the third quarter, if the world is unlocked, and if the world starts coming out of the deep recession, then we should see those medical supply numbers drop, but to be replaced by more normal exports, and that's something to be watching for. I think that the domestic demand side of China's economy is still under question, because what you mentioned just now, the counter-cyclical stimulus, my question would be, how much more can China do? You had mentioned, a little while ago about the credit numbers. The credit numbers are gargantuan. They are just throwing everything they can at the wall to see if it'll stick. And then earlier on, you mentioned about some of the, Bloomberg Economics mentioned something about some of the limitations to fiscal stimulus. So, this morning, the idea is that external demand might look a little better for China, but there's still questions about domestic demand.
Yeah, and that's why we're seeing that Chinese yield curve actually flatten against what we're seeing in other benchmarks as well. Cliff, you mentioned about, and you wrote this report about the retaliatory measures that we got from the White House on Hong Kong. Some would say were mild at best. Do you think that investors should look at this as a meaningful escalation? How are you assessing all the implications now from China's move?
I would say that the U.S. president, I mean, it's kind of an obvious statement, but, you know, since he made that Rose Garden statement about Hong Kong, I mean, he's been completely absorbed by the U.S. protests. And so, you know, I don't think he's had a lot of time to really consider the options in front of him. I mean, our advice is, you know, don't put your eyes off this ball, because we're still looking for further measures to be announced in conjunction with Hong Kong, particularly before the 6th of September LegCo elections in Hong Kong.
So what would that mean for, I guess, the broader theme of U.S. and China trade relations? Do you think the Hong Kong story becomes a little bit more of a prominent issue between the two sides?
I think the Hong Kong story is a catalyst. It sort of catalyzed, you know, a lot of anti-China sentiment in the U.S., but also in other countries, and it's becoming like a larger ball. And, you know, I think one of the things that will be surprising to some observers in Asia is that let's say Trump loses the election, and I think initially the markets will think, well, okay, all this is going to go away. I think what's going to be surprising is how much of it sticks or how much of it persists, even, say, for example, under a Democratic administration. So, you know, it's we've got more jousting, you know, possibly even more conflicts ahead of us over the next 2 or 3 years. It's a very different world than what I've grown up with, you know, most of my life, where we're looking at cooperation and globalization. You know, that story has really shifted quite a bit.
Cliff Tan, MUFG Bank Global Markets Research Head of East Asia. Thank you so much for your insights. Coming up, after extending curbs on oil production, OPEC's attention now turns to compliance as it looks to make sure members are sticking to their word. Details just ahead. This is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Oil prices are fluctuating between gains and losses to start the week after the extension to OPEC Plus output curbs Brent above $43 a barrel. The extension is seen as a victory for Saudi Arabia and Russia, which were locked in a brutal price war just 2 months ago. For more, we're joined by energy reporter Stephen Stepchinsky. Stephen, what is different about this OPEC Plus deal?
Well, this deal has an interesting aspect of it that has been talked about for decades since OPEC came together. And that's, in addition to the cuts, the 1-month cut addition that they're going to have for 9.6 million barrels a day, they're also going to have a new rule that says if you don't cut what you promised in May and June, you have to make those extra reductions for July and September to basically compensate. This is directly calling out folks like Angola, Iraq, Kazakhstan, Nigeria, which weren't exactly squeezing supply nearly as much as they had promised, while Russia and Saudi Arabia had been cutting at record levels. So this is going to help sort of bring in the OPEC production and in a way will likely be able to balance the market faster than what some were originally expecting.
And Stephen, we've seen, apart from the compliance front, that Saudi Arabia is also trying to boost market prices. How so?
Right. So Saudi Arabia every month puts out their pricing scheme for the next month. And they put out yesterday, Sunday night, effectively a July scheme that showed prices at a much higher level. In fact, Saudi Arabia made some of the biggest price increases for its oil in at least 2 decades for July exports. The biggest jump was July exports to Asia. This comes after they made enormous discounts in March to try to grab market share from Russia, as you said, when they started the trade war. So with Saudi Arabia boosting their prices, there's an expectation that this will feed into the physical market, and you could see Brent and WTI prices also get a boost from this jump.
All right. Anything to keep this rally going, it seems. Stephen Stepchinsky, our energy reporter, joining us from Singapore. Let's get to your latest Business Flash headlines now. Britain's top drug maker, AstraZeneca, is said to be interested in a merger with American rival Gilead. Now, sources tell us informal contact has been made in what would be the biggest healthcare deal in history. No terms have been released and no decisions have been taken. AstraZeneca is valued at $140 billion, with Gilead worth just under $100 billion. We're told Gilead is not interested in a sale or a merger. Singapore Airlines has secured the equivalent of just over $7 billion U.S. in fresh liquidity as it looks to ride out the coronavirus pandemic. Just over $6 billion of that was secured in a rights issue last Friday. The airline says all committed lines of credit due 2020 have been renewed for at least another year, and another $500 million is being raised in a short-term unsecured loan with several banks. Taiwan Semiconductor is reported to have won extra orders for 7-nanometer chips, with production lines remaining fully loaded through the end of the year. The Taipei-based Commercial Times says the orders come from Apple, Qualcomm, AMD, and others, and they'll help make up for declining chip demand from Huawei's HiSilicon technologies amid pressure from the U.S.
And Vaughn, Asian markets are off to the races, set for the longest winning streak in 16 months. Of course, we had better than expected U.S. jobs numbers, China's better than forecast trade surplus, all pointing to a global economy that's less bad. Of course, the focus this week is on the Fed. Powell seen reassuring investors he'll keep rates near zero. EMs, well, getting a boost. Risk on, so EMs continue to gain after posting the biggest gains in more than 8 years. Implied volatility dropped the most in 9 years. Investors continue to shrug off U.S.-China tensions and protests in the U.S. Taking a look at crude, currently in positive territory, has been swinging between gains and losses. We had, of course, OPEC extending its deepest cuts for another month. The CSI 300 now up by 0.8%. The decline in China's exports in May suggests the weakness in external demand. We have Nikkei 225 up 0.9%, up for the 6th consecutive session, by the way. The Hang Seng also in the money, getting a boost from the IPO adrenaline. JD, NetEase adding a lot of liquidity, and STI up by 1%. Of course, one of the last few ones to get into positive or rather bull market territory, currently up by 1%, 27.80. And China Southern, among airlines we're watching, of course, We're keeping a watch among the 4 Chinese carriers in focus. The Trump administration revising its China flight restrictions. Korean Airlines, Yonhap reporting that authorities will provide more than $800 million in liquidity. Up next, we'll look at how China
and we're looking at that ban on those
foreign airlines with Bocom's Liu Yu. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's 10:29 a.m. in Singapore and Hong Kong, 10:29 p.m. in New York. Here are your first word headlines. China's trade surplus rose to a record last month as a jump in medical exports helped outbound shipments fall less than expected, although imports did decline. Exports fell by 3.3% in dollar terms from a year earlier, while imports slumped almost 17%. That left a trade surplus of almost $63 billion, helped by the falling price of commodities that China needs. China's simmering spat with Australia's deepening, with Beijing issuing a travel warning, saying discrimination against Asian people is on the rise. The Ministry of Culture wants Chinese travelers to be on alert and not to go to Australia. The warning follows Canberra's call for an investigation into the origins of the coronavirus and Beijing's decision to put tariffs on some imported Australian goods. New York City has lifted its protest curfew as it prepares to reopen for business after the coronavirus pandemic. State Governor Andrew Cuomo says COVID-19 is the #1 variable for the city and is calling on all protesters to seek health checks. The weekend saw some of the biggest Black Lives Matter demonstrations across the U.S., most of them peaceful and with arrests sharply down on previous rallies. And Russia is investigating a massive oil spill in Siberia. An estimated 20,000 tons of fuel leaked from a storage plant outside the city of Norilsk, about 1,800 kilometers northeast of Moscow. The plant is operated by Norilsk Nickel, which is accused of making the area one of the most populated places on Earth. President Putin and other leaders only learned of the spill through social media.
All right, let's do a quick check on markets right now. Seems like this global rally is still gaining a bit of steam here, although we have petered off some of the highs of this session here when Asian stocks were up 0.6% for the regional benchmark. The CSI 300, notable to watch now. We have gained above that 4,000 threshold the first time since March. The Hang Seng as well. We're inching closer to 25,000. And the Kospi now close to losing, actually regaining all the losses this year. So join the likes of the Nikkei Nikkei, the Malaysia benchmark, as well as the CSI 300, which are close to regaining all the losses for 2020. For the boards, of course, we're watching the likes of U.S. futures there. India, how are we going to fare here in the Mumbai session? Looks like it's going to be signs of green here today for the Nifty, up about 1% for your Singapore futures. Brent crude, we see a bit of a divide here between Brent and WTI, but we peter a little bit after that OPEC plus deal have been reached over the weekend. Dollar certainly still that tailwind. We are losing that momentum here for another 8th day, so dollar down once again, but you are seeing some of these trade-dependent currencies seeing some gains here today after we did see, of course, that trade surplus from China surging to a record, exports falling less than expected, so perhaps the external demand picture not looking as bad as beforehand.
Vaughn, as countries start to reopen, global airlines are slowly increasing seat capacity, but Singapore's Prime Minister says things won't be the same.
We will not be returning to the open and connected global economy we had before anytime soon. Movement of people will be more restricted. International travel will be much less frequent. Health checks and quarantines will become the norm. It will no longer be so easy to take quick weekend trips to Bangkok or Hong Kong on a budget flight.
Now, China, too, is easing its ban on foreign airlines starting today. It didn't name any countries or carriers, but the move may open up a change for U.S. carriers to return for the first time in 4 months amid the latest trade tensions. Joining us is BOCOM International Transportation analyst Luya Yu. Luya, good to have you with us. I mean, we know that U.S.-China routes are among the most profitable in the world. How significant is this easing?
So right now, at least from what we've seen from the CAC, it does seem like this most recent policy is something like a short-term ceasefire. We do believe that this latest policy does open a very big path for U.S. airlines to return to China. However, we have seen a lot of tension basically over flight rights over the past few years, and we know that right now, given the entire circumstances between the U.S.-China trade war and all of the tension, we know that this kind of aviation fight there is still room for escalation. So even though this is a short-term ceasefire, we can't rule out any other further escalations in the future.
Having said that, though, Luya, I mean, the U.S. ban, how will that impact the likes of Air China, Air Eastern? I mean, we know as well that they have limited exposure to the U.S.
So for the actual airlines, if we're looking at earnings, these kinds of moves actually really does not affect their earnings much at all, because simply we're looking at the trade war tensions over the past few years. We know that for both the Chinese and the U.S. airlines, they've been rapidly decreasing their capacity on the U.S.-China route. So right now, when it comes to these kinds of, who gets to fly who, for how often, really in the grand scheme of things, these airlines have already really massively reduced their reliancy on these kinds of routes. So in the short term, effects on earnings really won't be very great at all.
So not much earnings impact. Luya, I want to bring up a chart just to kind of show when it comes to how, in terms of passenger traffic in China, those volumes actually have bounced back and doubled since the bottom, but we still haven't fully recovered just yet. Is this recovery really more dependent on the pent-up demand, or are you seeing that it really is contingent on the government restrictions now?
So while we do see signs of a pretty substantial amount of pent-up demand, we do know that at least for this year, for 2021, really traffic is going to be completely contingent on whether or not the government allows these flights to resume. And this is something we see both in China as well as in the U.S. and the rest of the world. So if people are looking at pent-up demand as a potential driver for traffic for this year, they might be a little bit disappointed, because at least for the rest of the year, it's really going to be the governments that have to say and whether or not how many flights will be flown.
So which Chinese airlines, the ones that you cover, Luya, could actually gain the most from what's looking to be a pretty nascent recovery so far?
So right now we do prefer basically all three of the major airlines: Air China, China Eastern, and China Southern. For China Eastern and China Southern, we do think that they have the potential to gain more market share, not in domestic China, but in the regional markets, like say Japan, Korea, Southeast Asia. Because right now we know that a lot of their foreign competitors are really not in a very good shape to increase their market share. So for these Chinese airlines, because they have no lack of liquidity, we do think that potentially in the near term or midterm, they might have more opportunities to gain simply because they are in a better shape right now with the domestic market bouncing back.
Leah, we heard from the Singapore Prime Minister saying that travel will not be the same post-COVID. For instance, short trips to the likes of Bangkok from Singapore will have to wait much longer. What do you make of that statement, and what trends, key trends, do you see developing?
So really in the long term, we don't see air travel shifting by much, but we do know that for the next few years at least, we could see some differences in trends. Like people have said before, ticket prices are very, very likely to rise because the smaller airlines will likely fall out of business, or many will cut capacity, possibly permanently. So ticket prices will go up. And also when it comes to access, we know that at least in regional markets, airlines are going to be a lot more prudent when adding new routes. So really, at the end of the day, travelers will have fewer options, higher prices. In terms of access, it may not be much higher, but in terms of prices, it will likely be a lot higher.
And Leah, at least Singapore, I mean, they're trying to create these travel bubbles, and countries are also coming up with these bilateral agreements for travel now. I see that you still have a neutral rating when it comes to Cathay Pacific. Hong Kong isn't really making those conversations right now. Is Hong Kong at a big disadvantage for not doing this?
Unfortunately, Hong Kong is such a massive global hub that for them, in order to really rely on these regional travel bubbles, it's a little bit difficult. We're looking at Cathay Pacific, and we know that their exposure to the European markets and the North American markets are rather huge. So for them, simply relying on, say, Southeast Asian, North Asian flights, it really won't be enough to really boost their revenue back to what it was. So Hong Kong is unfortunately so globally exposed that if there is still COVID active anywhere in the world, Hong Kong will be affected.
Luya, we're going to leave it there, but thank you, Luya Yo from BOCOM International, joining us from Hong Kong. And coming up, Minneapolis City Council pledges to begin the process of abolishing its police force. We'll have the latest on the protests in the U.S. next. This is Bloomberg. City Council in Minneapolis will begin the process of dismantling its police force after the death of George Floyd sparked a wave of anger and protests. Anti-racism rallies continue across the U.S. and around the world as cities lift curfews and President Trump orders a National Guard out of Washington. Let's get to our senior editor, Derek Wellbank. He has the latest for us. So Derek, obviously this is some sign of change that's happening in the city of Minneapolis. How are they going to replace the police force?
Yeah, it's actually quite a big change that they are considering here. And this is very, very, very early, but it tracks with some things that we're seeing some big cities look at doing in terms of reevaluating how they're spending their money. Now, some cities in the U.S. can spend a third or even half of their budget on public safety salaries, particularly policing. And there's a question about, is that the best way to go? The most optimistic scenario around this basically says, do you want to send the cops for everything you send the cops for? Or would it be better to send somebody else, maybe a social worker, maybe somebody with mental health, depending on whatever, situation it is. The problem is that in practice, this is a very, very difficult thing to do. Now, you've seen places in New York and Los Angeles say, maybe we'll devote a little bit less money. Minneapolis is certainly going further than anybody else. But it's important to note that there's a long way to go here. They don't have a plan set out yet. Right now, it seems like they have the votes to try and do something, but it's not clear what the something is. And based on some Minneapolis reporters that I know and have been dealing with, there's a possibility that the entire city might have to vote on this before it actually comes law.
Meantime, Derek, former Secretary of State Colin Powell, the latest Republican to criticize President Trump. Are we looking at a political fallout that's deepening?
Yes, you are. And you're going to actually see tomorrow one of the biggest encapsulations of where we are. Joe Biden is going to go to Houston. It's his first trip on an airplane since the coronavirus crisis really started, where he's going to meet with George Floyd's family. Remember, that's the black man whose death at the police hands started all of the protest movement. At the same time, Donald Trump is going to be meeting at the White House, holding a panel with law enforcement, and he has really been sort of sticking towards that side of the equation. So tomorrow is going to be a real big visual from both of the key candidates on where their kind of priorities are, where they're aligning, how they're messaging this going forward.
Senior international editor Derek Wellbank there in Singapore. Still to come, Europe's last live trading floor, the London Metal Exchange, faces an uncertain future. We'll hear exclusively from CEO Matthew Chamberlain next. This is Bloomberg. NYSE reopened its trading floor last week, but the fate of Europe's last live trading floor, the London Metal Exchange, is still uncertain. CEO Matthew Chamberlain spoke to Bloomberg's Danny Berger in London.
It was Europe's last traditional exchange floor until the coronavirus pandemic swept the globe. The London Metals Exchange, where the world's metal prices are set, has closed its open outcry trading floor and moved to electronic pricing, like its European peers all did in the past. Will the ring, founded in the 19th century, be able to reopen after the pandemic? The LME CEO hopes to keep this final vestige of in-person pricing.
Ultimately, if we did reopen, we'd be asking our staff, we'd be asking our members' staff to go back to the ring environment. And so I think the way that we analyze it right now is clearly we're waiting for the government guidance. We're waiting to see when that step 3 opening up happens. But even if, for example, the country can open up restaurants, you can run restaurants in a socially distanced way. We don't quite see how we can run the ring in a socially distanced way. So it may well be that we, together with our Category 1 members, actually decide that until social distancing can be lifted, maybe when there's a vaccine or maybe when there's a better treatment, that until that time, the most prudent thing would be to keep the ring closed.
Has electronic trading, because of the close down, has it gone smoothly? Is it able to replace the in-person, on the floor, open outcry trading?
So I think in a narrow sense, absolutely, we are confident that our market is still liquid, that our market is still orderly. You know, I talk a lot to end users of the market, and I genuinely haven't heard a single complaint or concern that people can't get their business away, they can't get their hedging done, they can't get their investment done under an electronic pricing model. So in that narrow sense, yeah, we're very confident that electronic pricing is working. But I think the broader discussion is about which venue drives more activity. Because you can have a market that works absolutely fine for getting your core business done, but perhaps it doesn't drive quite the same peripheral business. Perhaps it doesn't attract quite the same opportunities to make markets. So just because electronic is working doesn't mean that electronic is necessarily better. Let's remember that the ring has been working for over 100 years.
And Matt, you sort of hinted about this, talking about the 100 years more that you've had the trading floor. You know, I've talked to traders who sometimes lament about the lost art of the open outcry trading. So on a more of a big picture level, what would it mean to lose Europe's last open outcry trading floor, which right now the LME's ring currently is?
Yeah, I think there is a very significant emotional element to it, and I'm certainly not immune from that. You know, everybody who works at the LME, you know, we come in, we walk past the floor, and it's a very visible sign of the service that we're providing to global metals. And often, you know, when we have dignitaries who come to London from the metals world or from the broader finance world, they want to come and visit the LME. Because it is such a symbol of that trading activity. So I can't deny that if we ever did lose the floor permanently, which I'm not anticipating, it would be a hugely sad moment from an emotional perspective, because it is just such a great symbol of how metals markets work, and more broadly, how the London financial markets work.
And that was the London Metals Exchange CEO, Matthew Chamberlain. Let's do a quick check of the latest business flash headlines now. The anticipated winding down of the coronavirus lockdowns is prompting a recovery at rental sites such as Airbnb. Business has essentially shut down in March with people confined to their homes, but Airbnb says the gradual easing of restrictions has brought a rise in demand for vacation rentals. CEO Brian Chesky says people want to get away but aren't keen yet on taking a plane. Apple aims to boost sales by letting people pay via monthly installments. Sources say the plan will be rolled out in the coming months via the Apple Card, letting customers split the cost of new gadgets with interest-free staggered payments. We're told the deal will cover iPads, Macs, keyboards, and some monitors over a 12-month period. Apple launched an iPhone program last year with 24 months at zero interest. NetEase has priced its Hong Kong stock offering at 123 Hong Kong dollars per share, which would raise around $2.7 billion when it begins trading on Thursday. China's second biggest gaming company has its main listing in the U.S. and makes its Hong Kong debut at a time of rising tensions between the U.S. and China. Washington has threatened to delist Chinese companies and limit their access to capital markets. South Korean financial authorities will provide 1 trillion won, which is around 828 million U.S., to keep the country's flag carrier operational during the coronavirus pandemic. Government guaranteed bonds will be issued as early as the end of this month. Korean Airlines has already received a similar amount for the first half, and the latest funds aim to keep the carrier afloat through the rest of the year. British Airways is threatening to fire all 4,300 of its pilots and rehire them on individual contracts in a dispute with unions over new employment terms. BA aims to shed 12,000 jobs as it navigates the coronavirus disruption. The carrier has also begun a legal fight to stop the UK's self-isolation requirement for arrivals. BA says a 14-day rule would thwart plans to resume services in July.
And for Asian markets continue to rise higher, but they are off their day's highs. We have Asia set for the longest winning streak in 16 months. The MSCI Asia Pac Index up 0.6%. Of course, there's a lot of optimism out there, driven by U.S. jobs numbers, which came in better than expected. China's better than forecast trade surplus, all pointing to a global economy that's perhaps recovering, and we've seen perhaps the worst of it all. The focus this week is Powell. He's set to reassure investors he'll keep rates near zero, maintain policies to support the economy. Any suggestion on future stimulus and bond buying plans will be key. MSCI EM Asia also grinding higher. It is risk on. Of course, this comes on the back of their biggest gains in more than 8 years. We have investors continue to shrug off U.S.-China tensions, shrug off those protests in the U.S. as well. Taking a look at the key benchmarks here in Asia, the CSI 300 index up by 0.7%, 40.29 there. We had policymakers, there's a lot of expectation policymakers in China will continue to support both in terms of fiscal and monetary stimulus. Meanwhile, the yen has been falling for 15 days versus its trading partners, the trade deal, Hong Kong, among factors affecting the currency. The Nikkei 225 up by 0.9%. We had Japan's economy contracting less than forecast last quarter after capex revisions, even as the virus pushed Japan into a recession. Hang Seng also being lifted like the rest of the region. Shares have been in demand from mainland China, getting a boost from those IPOs, NetEase, as well as JD.com. Here we have a board of the airlines. China Southern continues to grind higher, up by almost 5%. The Trump administration revising its China flight restrictions, allowing 2 flights a week in total for Chinese airlines. Still, that would cut by half the number of flights to and from the U.S. by the 4 Chinese carriers. Korean Air up by almost 1%, 20,850 there, Vaughan. Yonhap reporting authorities will provide more than $800 million in liquidity by issuing government-guaranteed bonds as early as this month. Airlines getting a boost there, Vaughan.
Yeah, if you want to play this whole reflation theme, I think airlines are certainly the way to go, given just how battered these stocks have been. They certainly have come back in a big way here on the back of what we heard from U.S. airlines as well last week. Another way to kind of gauge this right now is, of course, the dollar. We're just talking to Cliff Tan from MUFG Bank, saying that perhaps is one of the most valuable barometers now of this V-shaped recovery. We're down for an 8th day here, set for the longest streak since 2017, although you are seeing some strength in some of these trade-reliant economies. So the won and the Taiwanese dollar also stronger here today. But the renminbi holding around 708.11 against the dollar. We got plenty more ahead. This is Bloomberg.
Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day winning
sizable moves in currency temperatures down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
The U.S. and Japan duke it out over exchange
China's slumping onshore bond market is great.
It's almost 11 a.m. in Singapore and Hong Kong. I'm Haslinda Amin with Rishad Slamat. Welcome to Bloomberg Markets Asia. Here are the top stories. China's trade surplus rose to a record last month as a jump in medical exports helped outbound shipments fall less than expected. The surplus climbed to $63 billion. Asia-Pacific markets rise for a sixth day amid growing hopes of a swift post-virus recovery. Oil edges higher too as OPEC and its allies extend production curbs. Compliance, though, is key. India starts a phased exit from its virus lockdown today, with malls, restaurants, and places of worship allowed to reopen. Critics, though, say the government's plan isn't working.
Right, let's have a look at what's going on market-wise. This is where we have modest gains right here for Asia-Pacific stocks. A situation where we saw that report come out, that U.S. jobs report, essentially stunned nearly everyone. And after Wall Street's Friday feeding session, Asian investors were thought to have had the same sort of appetite. Not quite. There are modest gains really across the board, as I was saying. Stock market participants in this part of the world not quite as convinced as their American peers that there will be a V-shaped economic recovery. This is where the Hang Seng is 0.4% higher. We got a Kospi, which has been flirting with gains and losses, up about 0.1% of 1%. The Chinese market up by 2/3 of 1% here. Now, we've got U.S. shares, in essence, close to wiping out their losses for this year, and investors are now perhaps looking at the Fed's policy meeting later this week. Officials there expected to recommit to using their full range of tools to support the American economy during the pandemic. Kicking it along, there we go. The Jakarta market coming on board at 2.2% up. We have no trading in Australia at the moment, so that would be the Friday close. And the Straits Times Index there in Singapore, 1.1% to the upside. Thailand also in the green. So we are in the green, but not quite as much as actually had been anticipated by some before today's session, Haslinda.
And in the FX market, Rich, it is broad dollar weakness. That trend does continue, currently down by 0.2%. The dollar has slipped every day for more than a week, its longest decline in years. Risk appetite is returning on optimism. The economy is recovering faster than expected. Plus, the unprecedented stimulus from central banks, that will keep the dollar pretty weak going forward. It's tumbled 4% over the past 3 weeks. In terms of the yen, it's looking at 109.53. The yen still trading near its lowest in more than 2 months. The stronger than expected U.S. payroll figures boosting risk sentiment and hurting haven demand. The Aussie at 69.72. The currency, of course, a proxy for risk appetite. It's rallied as much as 27% against the greenback, rising from 18th year low in mid-March. The RBA refraining from talking down the currency last week, fueling further gains. And the Kiwi at 65.18, strengthening the Kiwi in expectations. Prime Minister Ardern will announce a move to Alert 1 in terms of its emergence from the lockdown. Crude up by 0.8%, 39.87. We've had crude pretty much swinging between gains and losses. OPEC Plus extending its deepest cuts for another month, and Saudi Aramco raising its pricing the most in at least 2 decades. Gold futures up by 0.4%. Gold has fallen pretty sharply, and it's having its longest run of weekly losses since September After the latest job data, gold prices may face a near-term correction, though Sino-US tensions, risks around the global economy could just provide some kind of support. Now, let's get the first word news for you. Worldwide deaths from the coronavirus pandemic have now topped 400,000, with infection numbers rising above 7 million. The news comes as China rejects renewed accusations it withheld details about COVID-19, saying it's always been transparent and informed the outside world about developments in a timely manner. The latest U.S. infection data show a rise of 1% to just under 2 million cases. Japan contracted less than originally estimated last quarter after stronger capital investment, even as it sinks into recession. The updated report shows GDP shrank an annualized 2.2% compared with the end of 2019, less worse than the initial 3.4% estimate. It still means Japan has contracted for 2 straight quarters, with an even sharper drop expected in the current period. OPEC and its allies have agreed to a 1-month extension of production curbs while calling on members to stick to agreed levels amid allegations of cheating. Energy consultant Wood Mackenzie says the deal could see Brent climbing to $50, and it's seen as a win for Saudi Arabia and Russia as they try to rebalance the market. The OPEC Plus Monitoring Committee will also meet every month to assess demand. And Minneapolis says it's beginning the process of dismantling its police force in the aftermath of the death of George Floyd. The majority vote is veto-proof, and the city council members say they'll consult the community on what should happen next. On Saturday, Major Jacob Frey was booed by protesters after saying he did not support the abolition of the police. He was elected in 2018 after promising to mend violations.
Okay, let's have a look at this data which came out of the weekend. It's China's trade surplus surging to a record in May. This is as exports fell less than anticipated, and we had that helped along by an increase in medical-related sales. Let's get more on this story. Let's get over to our correspondent, Selena Wang in Beijing. And Selena, just give us an idea of the context behind what this trade surplus is telling us.
That's right, Rich. The numbers here were much better than expected, showing that China's economy is continuing this slow chug to recovery. That trade surplus reaching a record in May of $62.93 billion. As you mentioned, exports were bolstered by an increase in sales of medical supplies, masks, as the rest of the world battles the pandemic. And you saw that slump in imports partially due to lower commodity prices, even though those purchase volumes increased. So, for instance, according to the China's Customs Bureau, the average purchase price of crude fell more than 20% in yuan terms, even though the purchase volumes rose more than 5%. But the outlook is murky given the rising risks of U.S.-China trade tensions re-escalating. We had reported earlier this month that Beijing has told some major state-run agricultural companies to pause purchases of some U.S. farm goods. We did see in the May month exports to the U.S. falling more than 1%, while imports fell more than 13%.
Selena, as China ramps up spending to support the economy, what challenges does China's stimulus efforts face?
Well, the biggest challenge, Linda, is the massive budget hole that the Chinese government has to deal with. They are expecting that most major income sources are going to shrink in 2020, with revenue expected to drop 5.3% this year, and that's the first decline in at least 2 decades. And that pressure on revenue is being compounded even more by these tax breaks to help these firms that have been hit really hard by the coronavirus crisis. And the blow, if you look at non-tax revenues, is even greater. And that non-tax revenue segment includes profits from state-owned enterprises, which have been dampened. Now, the way it works is that tax revenues are usually used to pay for general spending like Social Security, education, health, and wages. And China will also use land sales as a source of money for infrastructure projects for economic growth. And we are also seeing pressure on land sales revenue. And if that falls far enough, local governments will be forced to cut spending.
And of course, we have China due out with inflation and credit data later this week. What are we expecting?
Right, a busy week ahead on the economic calendar. So Bloomberg Economics is expecting consumer price inflation to have slowed its growth in May compared to April. That's as food inflation continues to cool. You're getting lower pork prices, lower gasoline prices. But when it comes to those producer prices, we're expecting a deeper drop of 3.3% in that producer price index, with the deflation being driven by weaker demand and those low commodity prices I just mentioned. And for aggregate social financing, that may have increased by 3.5 trillion yuan in May, more than in April. And that would reflect authorities' efforts to continue this credit easing, more monetary easing, and all of these efforts to stabilize the economy through an increase in the fiscal deficit.
China correspondent Sina Wang in Beijing. Now, still to come, one of India's leading think tanks tells us why the government's virus-related stimulus plans are destined to fail. Later this hour, we speak to Yamini Iyer, the president and CEO of India's Center for Policy Research.
But just ahead, our next guest gives us his take on global economic data that came out better than anticipated. Rajiv De Mello telling us why forward guidance from the Federal Reserve will be the key element to watch for financial markets investors. You're with Bloomberg.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil, the Bloomberg Commodity Index.
Asian stocks are kicking off the week with gains after the latest U.S. job numbers smashed expectations and bolstered hope of a quick economic rebound. Our next guest says lifting lockdowns is rekindling growth. Let's bring in Rajiv De Mello, Development Committee Chair of the Investment Management Association of Singapore. Rajiv, good to have you with us. So the market's pretty much driven by this positive sentiment about growth, unprecedented stimulus, but when you take a look at fundamentals, do they justify the kind of gains we're seeing?
Well, fundamentals are still extremely weak. I mean, GDP growth is negative around the world, and we haven't. If we look at existing published data, they look terrible. But the market is focused on the inflection points, on what is changing the slope. And there, when we start seeing numbers like the jobs data from the U.S., PMI data, it seems to indicate that the bottom is in place in terms of the economy. and that's where the markets are focused. But I do agree with the direction of your question that markets have really rallied extremely fast for that small inflection that we're seeing. After all, the unemployment rate is very high and economic growth is still extremely weak or negative.
You talk about the slopes. Now all the curves, the 2s, the 10s, the 5s, the 30s have all pretty much steepened. Is this the start? Are we looking firmly at higher rates from here then?
Well, the front end, the Fed, which meets this week, will keep its indications that policy rates will remain very low, and it might even increase some of the policy initiatives that it has in its toolkit. But I do think that yields in the longer maturities are on their way up. There is going to be plenty of supply of new government bonds coming to market with the very large deficits in all countries around the world. And there needs to be some buyers for those bonds. But bonds at these levels of very, very low yields offer investors very little protection in their portfolios. And in fact, in many low or zero or negative yielding bond markets, they've actually seen losses over the past couple of months and very little performance at all. So the role of government bonds is seriously in question for portfolio constructors.
So fair to say that we'll see that rotation? I mean, money will firmly get into the stock market then, given where bond yields are right now.
Well, that's the biggest conundrum for investors. To build balanced portfolios, they really need to have some stable and some defensive assets as well. And that's something that they don't have right now because bonds are not playing that traditional role. And we have stocks still extremely risky, coming at back to levels which are implying substantial or growth in the economy, which is similar to what we had at the beginning of this year, the end of last year. So it does make it very difficult for investors to reposition away from bonds. I wouldn't say the automatic place is to go to stocks because that'll just increase the riskiness of their portfolios.
Rajiv, just getting some news from New Zealand. Prime Minister Jacinda Ardern saying that we are going to be seeing the removal of social distancing requirements in New Zealand, looking at retail hospitality coming back without limitations. On top of that, saying that, and this is a quote from her, we will see further cases of COVID-19. Well, that's the big fear, isn't it? A second wave, as it were.
Yes, and I think that's particularly true in some countries. But New Zealand is an exceptionally good case. I mean, they cracked down very early. They implemented a range of policies, and they have the disease under control, so they can expect, some infections and some deaths, but that's in the normal realm of disease and accidents, etc. Other countries, however, took much longer, have a much larger number of casualties, and one can't really see if they all have the disease and the infections under control. And so there it becomes much more difficult to emulate what New Zealand has just announced. I mean, in Asia, we have countries which have done remarkably well, like Korea, Taiwan, Hong Kong, and where disease and deaths have been kept extremely low. But I wouldn't say that that's the case more broadly in emerging markets or across the developed world as well.
Rajiv, of course, what's going to be the next wall of worry? You could say a second wave of this pandemic is one, but what have we also now got investors likely to be concerned about? Because they seem to be looking as though the glass is not just half full, but three-quarters full, given where markets are right now.
Absolutely, the glass looks as though it's filling up as time passes, and in a way, it does reflect the fact that we were at really no economic growth in the month of April, and any incremental return to work, loosening of restrictions, all that contributes to some growth and has been giving us this very positive view on the recovery so far. I think once one gets past this initial bounce, recovery, getting back to work, situation, then people will wonder whether this growth is really sustainable, how quickly will unemployment really come down to normal levels, and then also other worrying risks, which are U.S. elections coming up. Investors will have certainly started to focus on that. We're only 5 months away. And, of course, we have the U.S.-China trade tensions as well and other things as well. But I'm also worried about the second wave because when we see a lot of these restrictions relaxed and people getting together, we have to see what are really the effects and whether countries can cope with it. And in some countries, we're just seeing an increase in infections like Brazil, India, for example.
Well, just want to highlight a couple of things. We've got the U.S. elections in November. How does the market perceive a change in administration? That's one side of the question. The other side would be, of course, people looking at what you just referred to as well, Beijing and Washington and the rhetoric, the harsh words that they've had for each other of late. But even though that rhetoric has died down somewhat.
Well, the elections, I mean, what's difficult for equity investors is that in the Trump administration had implemented significant tax cuts for corporates, and that really led to an increase in earnings per share and then in stock prices. And we saw a tremendous rally following the tax cuts. Now, there is some serious discussion about reversing at least part of those tax cuts by the Democrats. And generally, following the incredible spending by governments around the world on measures to attenuate the effects of the lockdowns, we are going to see an increase in taxation, and that's inevitable. So that will cost company profitability as well, and investors will have to start pricing that when we get closer to the U.S. election, because that'll be a topic, especially if the Democrats have a clean sweep. And polls right now, which are always unreliable 5 months ahead of election, are indicating that there's a good chance that the Democrats sweep with the Senate and the presidency. So that's something to worry about. Now, on the U.S.-China tensions, what is concerning to me is that it's been embroiled in the election worries. And so it is something that, when things get better, will be wheeled out. It's bipartisan as well, but it can be whipped up. But at the same time, the administration is also cautious not to overdo it. But that is something we're going to have to live with. And in Asia, that's particularly a source of anxiety.
Rajiv, thank you very much indeed. Rajiv Zamela from the Investment Management Association of Singapore. Let's tell you what we have coming up on the program after extending curbs on oil production. OPEC attention now turns to compliance, and it looks to make sure members are sticking to their word. Indeed, not following the Mr. Pinocchio way of thinking. Details on the way. This is Bloomberg. You're back with Bloomberg Markets. Oil prices fluctuating between gains and losses to start the week after OPEC's extension to output curb sent Brent above $43 a barrel. We got crude suppliers agreeing to maintain current production levels for another month, and as part of the deal of the OPEC Plus members, they're also promising strict compliance. Let's bring in MLive Asia editor Seung-Woo Park. Seung-Woo, what does this agreement mean for the oil market? And tell me about the Pinocchio effect and whose nose is the longest.
Okay. The positive news over the weekend about the OPEC Plus agreement to extend output cuts has given fresh legs to oil's rebound rally. This achievement may reinforce the recent bullish momentum built on economic reopenings. Under the New Deal, it's pretty much positive in that, as you said, the Saudi Arabia and Russia has been on the same page to this improve compliance overall within the group. So that's one thing. And another thing is that the OPEC Plus alliance will cut 9.6 million barrels per day through the end of July instead of easing to 7.7 million barrels per day of supply curbs as previously planned. So the extra reduction of about 2 million barrels per day should help tighten the global oil market further. Along with demand on demand, that will chip away at hefty inventories built up during the height of the virus outbreak earlier this year. And some analysts even see the global oil market flipping to a small deficit by the end of this year. Apart from the OPEC Plus agreement, there are also a slew of other positives. For one thing, Saudi Arabia made some of the biggest price increases for its crude oil exports in at least 2 decades, and that can also underpin oil's recovery. Also, we see a continued slump in U.S. drilling activity, with the oil rig down about 70% this year. As you can see, from the last Friday's data point, the rig count is now at the lowest since 2009. And the surprise jobs data in the U.S. last Friday is brightening the outlook for demand on top of this, faster than expected recovery in China.
Any downside risks to this rally, Seung-Woo?
One of the biggest threats to the nascent rally in the price of oil is, of course, a return of U.S. shale production after the steep price gains recently. We are already seeing early signs of some shale producers trying to accelerate output later this year. Oil prices are still down about 40% from this year's highs. So the intensity and the degree of the next round of the rally depends on how soon and how rapidly U.S. oil producers will ramp up production. And it's not just about U.S. producers, but other producers could be tempted to increase output if prices continue to increase. Finally, we have these, some risks about the economic reopenings as concern over a second wave of infection.
Thank you, Seung-Woo Park there, joining us from Singapore, joining us about the oil market. This is Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Monday in the Lion City, almost 11:30 a.m. in Singapore. We're in the middle of the trading day. The STI in positive territory, up by 1.2%. It is up 25% from the bottom back in March and is now looking to test its 100-day moving average. Compared to the rest of Southeast Asia, well, it is an underperformer. MSCI Southeast Asian benchmark up 40% from the bottom. Singapore, of course, bracing for tougher days ahead. We heard from the Prime Minister Lee Hsien Loong cautioning about rising unemployment. He says Singapore's future won't look like the one before the virus. Sounds a tad ominous for my liking there, Risha.
Yeah, absolutely. Moving just on to what's going on with our first word headlines now, looking at China's trade numbers. Saw a surplus rise to a record last month. They had a jump in medical exports that helped outbound shipments, I should say, fall less than expected, although imports did decline. Exports fell by 3.3% in dollar terms from a year ago, while imports slumped almost 17%. That left a trade surplus of almost $63 billion, helped by the falling price of commodities that China needs, and it needs an awful lot of them. Meanwhile, Beijing's simmering spat with Canberra is deepening, with China issuing a travel warning saying discrimination against Asian people is on the rise. The Ministry of Culture warning Chinese travellers to be on alert and not to go to Australia. The warning following Canberra's call for an investigation into the origins of the coronavirus and Beijing's decision to put tariffs on some imported Australian goods. New York City has lifted its protest curfew. That is, the city prepares to reopen for business after the coronavirus pandemic. State Governor Andrew Cuomo said COVID-19 is the #1 variable for the city and is calling on all protesters to seek health checks. The weekend saw some of the biggest Black Lives Matter demonstrations across the United States, most of them peaceful and with arrests sharply down on previous rallies. The Prime Minister of Singapore saying that the future will look very different post-COVID-19. In a national address, Lee Hsien Loong said that the city-state won't be returning to the interconnected global economy that existed before the lockdown. And with unemployment rising and travel hammered, the future will be even more tough. Singapore spent the equivalent of 20% of GDP on its response to the virus.
And Rish, the city council in Minneapolis will begin the process of dismantling its police force after the death of George Floyd sparked a wave of anger and protest. Anti-racism rallies continue across the U.S. and around the world as cities lift curfews and President Trump orders the National Guard out of Washington. Now, our senior international editor, Jody Schneider, has the very latest. Jody, how is Minneapolis going to replace the police force?
Well, Linda, that's really the question. What we've heard from the Minneapolis City Council so far is that 9 of the 12 members said they support disbanding the city's police department, which is one of the most aggressive stances we've seen in terms of the policing reforms. This, of course, comes in Minneapolis, the city where George Floyd died at the hands of a policeman, and there's a civil rights investigation happening there. So they haven't yet said what they would do to replace it. We've seen this in other cities before in the past. Camden, New Jersey, in 2012, where crime was rampant, disbanded its police department and replaced it with a new force. We saw this in Compton, California in 2000. They shifted their policing to Los Angeles County. So presumably something will come in its place, but we don't know yet what that is. This is a veto-proof majority on that city council, so this is something that is going to go forward. The mayor does not support it there, and he has received a fair bit of criticism for not supporting it. The mayor there had run on a campaign to basically restore relations between the police department and the city's residents, and so he has facing a lot of criticism for not going ahead with this. And obviously, Minneapolis has been at the center of this storm of controversy and now protests across the U.S. and around the world. We saw protests globally over the weekend.
Jody, what's President Trump been saying about these protests, which effectively have been largely peaceful?
Yeah, they have been, Rich, they have been peaceful over the weekend. Obviously, last week we saw a fair bit of unrest, and we saw a lot of arrests and looting. Over the weekend, we really saw largely peaceful protests. Curfews were lifted. We have not really heard much from President Trump, except on Twitter. On Twitter, he said he was ordering the National Guard to vacate Washington, quote, now that everything is under perfect control. He had threatened, obviously, to send in active duty military last week. That didn't happen. National Guard did patrol in some areas. But we haven't heard from the president. There's been speculation that maybe he will address the nation again at some point, but we have not heard from him again except on Twitter.
Now, former Secretary of State Colin Powell is the latest Republican to criticize President Trump. This is, perhaps some have said, dealing a bit of a blow to his election prospects. This political fallout continues to deepen because I think Colin Powell's words also echo those of several other Republicans.
That's right. And some polls that have been conducted since the unrest started, since the death of George Floyd, have shown that the president is not polling well in some states, including states he had won last time. He had won in 2016. Given that this has really become the issue in the U.S. right now. And, of course, it comes after and still amid the coronavirus. We've now seen 110,000 deaths in the U.S., and this is something that obviously has hurt the president's election prospects, even with last week some good news for him. The unemployment numbers were not as bad as people expected. That certainly was a boost in the market, gave him a bit of a boost. But his lack of talking about this and talking about where the nation goes now is something that people have said in polls worries them. And in one poll, 80% of Americans said they did not like the direction the country was going in. And for a sitting president who's running for re-election, those are tough numbers.
Jody, good stuff. Thank you. Jody Schneider, the Senior International Editor. Now coming up, India enters the first phase of its economic reopening with malls, hotels and some restaurants to resume business as of today. Our next guest, though, thinks that the government has made some missteps in its virus response. That's next. And this is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Let's do a quick check of the latest business flash headlines. Singapore Airlines has secured the equivalent of just over $7 billion USD in fresh liquidity as it looks to ride out the coronavirus pandemic. Just over $6 billion of that was secured in a rights issue last Friday. The airline says all committed lines of credit due 2020 have been renewed for at least another year, and another $500 million is being raised in a short-term unsecured loan with several banks. South Korean financial authorities will provide 1 trillion won, around $828 million to keep the country's flight carrier operational during the coronavirus pandemic. Government guaranteed bonds will be issued as early as the end of this month. Korean Airlines has already received a similar amount for the first half, and the latest funds aim to keep the carrier afloat through the rest of the year. British Airways is threatening to fire all 4,300 of its pilots and rehire them on individual contracts in a dispute with unions over new employment terms. BA aims to shed 12,000 jobs as it navigates the coronavirus disruption. The carrier has also begun a legal fight to stop the UK's self-isolation requirements for arrivals. BA says the 14-day rule would thwart plans to resume services in July. JD.com's Hong Kong share offering is said to be multi-times oversubscribed by institutional investors. China's second biggest online retailer is looking to raise around $4 billion from the offering, which is set to price on Thursday. Like other Chinese companies listed in the US, JD.com is under threat of being delisted in America. The stock will start trading in Hong Kong on June 18th.
Hong Kong's government is promoting a message of stability, and it's particular for its currency peg, which has been unbroken since the 1980s. That has the territory chance, of course, to revive a flagging economy. Bloomberg spoke to Hong Kong's Financial Secretary Paul Chan about when he sees a recovery.
This year, I think towards the second half of the year, particularly in the fourth quarter, this is hopeful. But this is very much depend not just on ourselves, but number one, the coronavirus situation globally. Because if globally this is under control, then a lot of economic activities can be revived. And secondly, the relationship between the US and China, particularly on the trade front, that would affect our foreign trade. And also thirdly, when at the moment, when we get the coronavirus situation under control, and the society back to a stable environment, we are going to encourage our own consumption. Say, for example, the $10,000 scheme for every eligible Hong Kong citizen.
People are still waiting for that, by the way.
It's coming soon.
That's been a big complaint of local people, that they haven't gotten their checks yet.
Yeah, we heard that. We are working very hard to
Why
set
did
up
it
the
take
system.
so long?
Well, say for example, in the US, you pay tax on a pay-as-you-earn basis. We pay tax once in a year, and we have also a very stringent Data Privacy Act. The data we gather from our citizens from different sources cannot be used for this particular purpose.
More stimulus needed, and where and how?
Well, we are working very hard to roll out the stimulus package that we have outlined in the budget and 2 rounds of anti-epidemic fund. Wait till these measures are all rolled out before we decide the third one.
Well, first quarter GDP growth was down 8.9% year
Yes.
over year. I think the worst on record.
Yes.
Is that the worst for this year? And do you have any reason yet that you can give us that you might have to revise your full year forecast again? I think it's for a contraction of 4 to 7% for the full year, right?
We will be doing another update in August as part of our regular process.
What are the tea leaves telling you right now?
Well, very much depend on external virus situation and the economic recovery in Western countries. Yes, we suffer dearly in the first quarter, but globally, I think we are in a global deep recession because of the virus.
Are you seeing any indications of capital flight?
Well, facts and figures speak louder than words. Ever since the announcement of the intention to legislate national security law, the Hong Kong dollar to US dollar convertibility undertaking has all along been on the strong side When I talk to the banks, when I talk to the private wealth management individuals, when I talk to Hong Kong MA, in fact, there is no obvious outflow of capital.
The local news, though, shows signs of people a little bit worried. I mean, local money exchanges running out of US dollars, or they're lining up to get US dollars or other currencies. That's happened in the past in times of crises. People seem to want to get hard currencies. Is that just a temporary phenomenon right now, or is that an indication that there are some deep-rooted concerns in society?
I do not believe this phenomenon is a reflection of any deep-rooted issues as such. I would say this is a short-term anxiety and sentiment. Last year, during the social turmoil, we saw similar phenomenon. And in fact, last year, when we went through those difficulties, our financial market had been operating very smoothly. And again, there was no obvious capital outflow. The total deposits in the banking system at the end of last year, compared to the beginning of last year, registered a very modest 1% growth. And so far, this in the past 4 months, in the past 10 days, we did not observe any obvious capital outflow.
Paul Chan there, the Hong Kong Financial Secretary. We've had the Indian markets just start off their trading day in the last minute or thereabouts, and these investors are pushing things up 1.8% at the moment for the Nifty. There we go, same sort of move for the Sensex as well. Looking at Reliance, so 1.8% up at the moment. We've got Reliance Industries seeing more investment into its Geo platform. Silver Lake and its co-investors investing more money into that, as indeed is the Abu Dhabi Investment Authority as well. And the investment does increase the Geo platform's valuations, of course, here as well. That's what we have with markets. Positive start in India. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
India is starting a phased lifting of its nationwide lockdown, allowing malls, restaurants and places of worship to open as of now. The nation is now ranked in the top 5 in terms of infection numbers. Our next guest has been critical of the government's response to the virus crisis. Let's bring in Yamini Ayar, who is president and CEO of the think tank Center for Policy Research in New Delhi. Yamini, thank you very much indeed for joining us. Just lay out, first of all, what you've been most critical of the Modi administration.
Well, we went into a lockdown fairly early in the pandemic evolution as it broke out in India towards the end of March.
with about 4 hours of preparation and absolutely no clarity on where the government stood in terms of the kind of economic response it would offer against the backdrop of the lockdown. What we've seen unfold in these last 2 to 2.5 months since the lockdown has been large-scale economic distress, best exemplified in the fact that millions of casual workers and informal workers that come from rural areas into urban cities found themselves stranded and had to, on many occasions, make a very arduous and difficult journey home on foot, absent any kind of food or income support or relief measures from government. We today are in a position where we are now recognizing that it's economically unviable to continue with a hard, strict lockdown. Don't forget, the Indian lockdown was the strictest in the world. And as we are opening up, we are also reaching early phases of the peaking of COVID. The numbers are rising on a regular daily basis. And as a country, we still don't have enough clarity on what was achieved on the health front over these 2.5 months in terms of preparedness to deal with the peak of the pandemic as it unfolds. So right now, India is confronting both an economic crisis for which we still are awaiting a substantial package from government and a substantial roadmap for recovery, but also it's coinciding with the increased peaking of the COVID outbreak itself, which is beginning to stress the health system as it has done across the globe.
But I mean, I think you're also arguing here that it's not an economic crisis per se. It runs deeper than that, and that the whole pandemic has uncovered the fault lines, societally speaking, for India. How does it go about repairing those, and is there the will to repair those fault lines?
Well, let me put it this way. Absent the will, I think the country is going to, our democracy and the country as a whole is really going to suffer. So I don't think it's a question of will anymore as much as we just have to do this to hold together. It has brought out the deep social inequalities that the country has, I think, brushed over the carpet in the early phases of our growth cycle. And that's brought out most starkly by the fact that we have such a large population of informal and casual workers that move from poorer parts of India to regions which have seen better economic development. So the need to think about shifting our economic strategy so that it's more inclusive and better spread across the country is now critical, but also the need for the government to think much harder and build with full political will a more robust social insurance architecture that covers all Indians in a way that ensures protection against vulnerabilities. The biggest reality that this crisis has brought to light is the fact that a significant part of India, in fact, even as we moved out of poverty as a consequence of many decades of growth, is very vulnerable. So a single income shock can push you back very, very quickly into poverty. That's the reason why large numbers of Indians, when they lost their jobs, had to find ways, even by foot, to make it home. So we need to ensure that we have a better, more equitable strategy for growth that ensures all of India grows equally, and importantly, that we also have a more robust social protection system. Lastly, the pandemic has also, like I think across the globe, highlighted the fact that the failure to invest in robust public health systems leads to crises that we cannot manage, health crises that we find difficult to manage. The urgency of investing in health. India invests far lower in health as a percentage of GDP than any other comparative country. We need to really strengthen our health systems in order to ensure that we have a strong economy.
Very quickly here, I mean, we saw the migrant population go back to villages in this urban to rural migration pattern. Do you expect then now for there to be rural to urban migration of the same proportion, or do you think that people may stay in the villages very quickly?
I I think we are going to see two very interesting shifts. There will be a proportion that will stay in villages after all the hardships they have encountered. But, economic necessity will override a lot. And so you will, of course, see movement back. But I think the nature of that movement is going to change. And it will be much more shorter distances to areas that are closer to hometowns, unless we are able to build a stronger social protection system that ensures that people are able to access government benefits no matter which part of the country they are in. And we are also able to ensure a legal regime that protects workers better than we have done thus far. So we will see migration back into towns, no doubt, but I think the pattern of migration may well see some changes on account of the experiences of the last 2 months.
So could we see serious labor shortages in the city? We've heard from the likes of Jindal Steel, from the likes of Suzuki Motor, raising concerns about a shortage of labor.
Yes, absolutely. That's a very real challenge right now, especially as we are opening up manufacturing again. Partly because people have only just moved back, and I don't think, in light of the way in which the pandemic itself is unfolding and the chaos in terms of mobility across state borders, it's going to be moving labor back into factories is going to be easy or swift. But if you take a long view, of course, there will be mobility back into urban areas for economic reasons. But this is not going to be easy. Both private capital as well as the state will need to do a lot more to reassure labor that their basic rights and dignities will be protected before people are willing to move back and come to work. And that's the challenge that many of our big manufacturing units are confronting today.
You talked about income shortages, the poorest people in India getting hit for a second time since 2016, first by demonetization and now by COVID. Could this prolong India's recession?
Yes, in fact, don't forget, between demonetization in 2016 and the pandemic hitting, the economy was in any case going through a fairly significant slowdown. We recorded a very, very low GDP growth in the last quarter of the financial year that just passed before the pandemic hit. So overall, wages were down. Key drivers of the economy, from automobiles to agriculture, were going through a period of depression. And this, of course, is pushing it further. So it is unlikely that we are going to recover with any speed, even as the pandemic itself runs its course. Some economists are expecting that it will take at least till 2022-23 before the economy sort of slowly gets back on its feet. But I think there are also some moments of opportunity in the crisis, as the government is now trying to push some reforms.
Yamini, we have to leave it there. Yamini Iyer from the Center for Policy Research. And that is it from Bloomberg Markets Asia. Bloomberg Daybreak Middle East is next. This is Bloomberg.
hayamos adoptado un abuelito, vamos a continuar viéndolos a nuestros abuelitos, ¿no? No podemos dejarlos de verlos por el hecho que se termine de solucionar la pandemia. Más bien al contrario, habremos tenido un mayor contacto con nuestros abuelitos hasta sus últimos días.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
This is Bloomberg Daybreak Middle East. Our top stories this morning.
Asian stocks and U.S. futures rise after America's blowout jobs report. Investors now focus on this week's Fed rate decision and look for reassurance from Jay Powell.
Crude climbs again. The oil rally continues after OPEC and its allies agreed to extend the historic output curbs by an extra month and promise stricter compliance.
And Egyptian stocks surged the most in more than 2 months after a preliminary agreement with the IMF. We speak exclusively to the nation's Minister for International Cooperation this hour. It's just gone 8 a.m. across the Emirates. It's Daybreak Middle East. Warm welcome to the show. I'm Manis Cranney in Dubai.
And I'm Yusuf Gamenedi right alongside you. Let's get straight then to what is happening in the energy markets, because it is the pricing in of developments over the weekend, and it is currently looking to the upside by about 1.4% on the Brent trade, climbing for a sixth straight session. I mean, we're looking at a weekly increase once again, potentially, and that is after the production curbs were extended. So the new deal comes in at 9.6 million barrels per day as of next month. But there's quite a bit of skepticism around this deal, including from the folks at UBS. They're saying that the oil rally may prove self-defeating. And their argument is, well, if the laggards in compliance were laggards in the past, they're likely to be laggards in the future. Bloomberg Dollar Index is the other key metric to look at, currently down 0.1%. It is firmly risk on in the Asian session as we speak, and we are headed for an 8th straight daily decline in the Bloomberg Dollar Index. But EM currencies are not going to get a reprieve because of it, according to Barclays.
So as the dollar declines, Yusuf, are bubbles bursting to the 10-year government bond market? The jobs report shifted the narrative. The bond bears are in charge. We ramped by 25 basis points last week. Do you buy 1%? Are you interested in 1% yield? What is the risk here to the bond market that the Fed and Jay Powell signed less dovish? That is the risk to the bond market this week as you look at trading. Roll it over, have a look at the result of that cascading lower dollar. Easier terms from the Fed. We've gone from recession to depression to euphoria in 100 days. The MSCI index, we had the best week since 2011 last week. This is an unstoppable rally. Volatility is imploding in stocks and bonds by the most since 2011. And the juice bar is open. It's Jay Powell. What will he deliver? To the Asian stock market and the US futures, they're higher this morning, as we've been saying. America's labor market blew past the forecasts of a depression-style surge in unemployment. Expectations had been for a loss of 7.5 million jobs. Instead, there was a gain of 2.5 million. Investors will this week be focused on the rate decision and the language from Mr. Powell, the chairman there, to aid the U.S. economy.
Meanwhile, on the political front, Colin Powell is the latest notable Republican or former military leader to express concern about President Donald Trump, saying he'll vote for Joe Biden in November instead.
40 years. And he cannot in any way support President Trump this year. I'm very close to Joe Biden on a social matter and on a political matter. I've worked with him for 35, 40 years, and he is now the candidate, and I will be voting for him.
Let's bring in Jeffrey Halley. Let's bring in Jeffrey Halley from Owanda. He's the senior market analyst there. Jeff, just get a quick reaction from you from some of these key sound bites as we get closer to the November election in the United States.
Yeah, I guess the wagons are circling against President Trump by some very prominent Republicans now. I think what's really broken the camel's back has been his deployment of military forces with these protests going on in the United States, and that seems to have pushed everybody to the edge as far as Mr. Trump goes. I think the big worry here is that if President Trump is behind in the polls, he'll start looking for easy wins on the populist front, which could mean more action against China, amongst other things. So at this stage, I think it's going to be a hard-fought campaign, but you can never write President Trump off because he came from nowhere to win the last election. So people write his demise at their peril, I suspect.
Jeff, thank you very much for joining us this morning. I started the show with the bond market, Yusuf, with the dollar. We are looking at the longest losing streak since 2011. You say we're on a steamroller path. As you go into this week, the longest losing streak since 2011, what is my risk? Is the risk that the Fed does not sound sufficiently dovish to maintain the momentum? Or is it that NIRP, negative rates, have repriced and that creates a floor?
I guess the main risk here is that the Federal Reserve doesn't sound as dovish as the market hopes, but I think that's a very remote outcome, to be honest. What they may come out and say is that they're going to bring in some sort of yield curve control program. I'm 50-50 on whether that actually happens or not, but the Fed has been signaling since this whole COVID-19 pandemic really got underway that they are mega dovish, so to speak, and I expect them to hold that line quite strongly Thursday morning in Asia time when that announcement is made.
Jeff, the Treasuries market had a very rough week. In fact, it was the roughest since September on signs that the economy is beginning to reopen. U.S. 10-year yields sort of flirting with the 1% mark. GTV Go for our clients for that additional perspective on your terminal because you have, of course, the long maturities absorbing the brunt of the losses. The yield curve is at the steepest in more than 3 years. Where does that trade go, Jeff?
I think this is increasing the chance that the Federal Reserve will bring in some sort of Japan-style yield curve control mechanism. They won't want to see the yield curve going too steeply, and they won't want to see a blowout in those yields. And one of the main reasons for that is that the US government itself is going to have to issue some galactic amounts of debt to cover their fiscal deficits once they've finished getting through this COVID-19 pandemic. So the last thing that we need there are high long-term yields. So I would expect that the Fed will be keeping a very close eye on them, and they will act quite aggressively to cap those if they have to.
Galactic proportions of bonds. Yeah, certainly the Treasury's got more to do, and the duration is going to play into that as well. Jeff, we saw the jobs report on Friday. That was our hook to the narrative of this risk on all the way around. New Zealand reducing social distancing as well. These are just 3 instances. The Kaishan doubled since its low to 55. Economic surprises turned positive, and the jobs report. The question is it too early for you to rotate towards inflationary trades? Are you valuing small caps over large caps? Is it too soon to go deeper into junk on a recovery story relative to IG? How do the differentials play, or the rotational trades play?
Yeah, on the junk market, I think what's been going on there is a reflection again of the just enormous amount of quantitative easing that's been going on around the world, and that money needs a home, and that search for yield in a 0% world means that money goes to places that that it perhaps shouldn't be going. I do note I was somewhat skeptical about the non-farm payrolls until I saw the Canadian payrolls, which added 260,000 jobs when they were expected to fall by 500,000. So both America, the United States and Canada both had blowout jobs figures to the top side, which suggests to me that maybe there is some traction in this recovery. It's happening a lot faster than everybody predicted, including myself. And that this rally, therefore, does have some longevity to it.
Okay, and certainly if you look at the restaurant jobs, rehiring there 1.4, 1.5 million, certainly suggests that PPP did have a material impact. Jeff, stay with us. Do not hang up the phone. Jeff Halley stays with the Daybreak Middle East team. More to discuss on China. This is Bloomberg. Breaking news coming through from the Japanese parliament. The finance minister, Taro Aso, saying a minimum of 5 trillion yen response needed with second and third wave in regards to COVID. Of course, we had the Japanese data this morning showing GDP contracted by 2.2%. That was less than the estimates. Some are saying that that will be restated as we go forward. So this is the narrative. It is about fiscal stimulus. You saw it in Germany. 30% more than the market had anticipated. Here's Taro Aso talking about it. This is definitively the next part of 2020's story. Let's talk about the trade numbers and the data, because China delivered their trade surplus today, and it rose to a record last month. There was a jump in medical exports, helped outbound shipments, fall less than expected, I should say. Exports dropped by 3.3% in dollar terms from a year earlier. Imports slumped almost 17%. Meanwhile, Beijing has lambasted suggestions that it hid information about the coronavirus outbreak, saying in a newly published white paper that it acted transparently and it informed the world of the developments on a timely manner. Jeff Halley is the senior market analyst at Oanda. Jeff, when you look at the trade data from the United States, from China, if one was a very caustic skeptic, would say they had a very good COVID. They exported medical equipment around the world. Commodity prices imploded. But this surplus in itself is bifurcated because it doesn't put real support on the domestic consumer, Chinese consumer, or is it that we should be grateful that we're seeing good numbers from China? Which argument do you fall on?
I'm erring towards the former, to be honest. The reason the trade surplus blew out was because of the huge drop in imports by nearly 17%. Now, part of that was because commodities fell, and thus in dollar terms, that number fell as well. But that's quite a worrying development for me. It suggests that either purchasing managers in China and export-facing industries believe that demand will remain subdued, and thus they're not purchasing as much in advance, or it could be showing that domestic demand is not recovering as they would hope within China, and thus that is also feeding through to the purchasing managers' figures and the fall in imports. But whichever way you cut it, I don't think it's actually a very good number at all. And I think it's quite fortunate that there's so much bullish momentum and outlooks in other parts of the world that this number is sort of going to probably be fairly quickly forgotten, because if it was seen in isolation, this would probably have been quite negative for Asian markets today.
Jeff, what's going on with the Chinese yuan? Because we are now looking at 16 straight days of losses compared to partner currencies. That's what the Bloomberg data suggests. At the same time, you're also starting to see the key cross dollar yuan coming off the 2008 levels. Walk me through your thinking as to what are you telling clients about exposure to China at the moment?
I think the moves we're seeing in the currency markets, the cross yuan side of the equation has been driven by those underlying currencies moving much higher against the US dollar in the international markets. We've seen a big rotation out of US dollars over the last couple of weeks, in particular into currencies that have perhaps brighter growth stories all around the world. That haven positioning is finally coming out of its hiding place and starting to redeploy around the world. So my word to clients really is that I expect to see this dollar move continue. I expect to see the dollar to continue tracking lower. On the other side of the equation, because China runs a dirty float against a basket of currencies, as those currencies appreciate, then we are going to see downward pressure on the daily fixing, the US dollar CNY fixing each day. And I expect that dollar CNY will still continue tracking lower. Part of it will also be political, because China is interested, of course, in defusing any potential trade tension points with the United States, particularly after that blowout in the trade surplus this weekend.
Yeah. Jeff, it's been great catching up. Thank you very much for those insights. That is Jeffrey Halley. He is the senior market analyst at Owanda. Still plenty more ahead on this program. This is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
So it was risk on then for investors across the Middle East region yesterday, with gauges in Dubai and Egypt jumping more than 4.5%. Simone Foxman was watching the market for us from Doha. Simone.
Yeah, good morning, Youssef. Particularly watching the insurance space yesterday because we got two bits of M&A news announced, not one but two mergers. The two Saudi insurers, Gulf Union and Al Ahliya, signed an accord agreeing to merge, and that was after we had news breaking during the program yesterday that Dar Al Takaful would buy insurance assets from Noor, which is now owned by Dubai Islamic Bank. So that all those things pushing some shares of insurers higher. And if you step back, we'll see that insurance space generally outperforming our regional indices. This despite warnings from Moody's in late April about high risks for GCC insurers over the next 12 to 18 months. So the question I want to know is, could this be a place we see more action on the M&A front going forward?
Simone, obviously, Youssef and I, every time we read the headlines this morning, we understand that you can fly back into Dubai without quarantine. But this is obviously going to play into the story around Emirates. And we have some news around the salary cuts there to be extended. So this is a delicate balancing act, isn't it, for Emirates, keeping the staff but running the cuts and trying to see how the demand field opens up.
Right, and what's interesting there is that these salary cuts are going to be extended to September. That really mirrors what Etihad is doing as well, extending its own salary cuts from April to September. And really, if we look at all the largest three carriers, that's kind of the timeline that we're talking about, this fall timeline for those salary cuts. And so, we have to wonder if these pay cuts could imply could offer any insight about the duration of these sort of broad cutbacks we're seeing in that industry. If we're looking for positive news, though, there is some on the airline front. As you said, it's easier to come back to Dubai now. Turkey has restarted its flights. These are things that are driving the publicly traded carriers in the region. And if we look at the overall statistics on how much people are flying, Middle East so far, at least through April, has been really in line with the rest of the world in terms of seeing that sharp decline in passenger travel.
Simone, let's also talk about the Israeli shekel, because the chart shows a pop in late March in that particular pair. But now we've got new data from the Bank of Israel. Foreign currency reserves, they tripled in May. Is that likely to move the needle as the trading day gets underway?
Well, yeah, so we saw the shekel last week at its strongest since March 4th. So they were back to pre-crisis levels, and the Bank of Israel has been really worried about that. That's part of why these foreign currency purchases have increased, and that number in May likely to affect trading today. But we have to remember that the Bank of Israel's efforts were not successful, particularly pre-crisis, to try and stem the rising tide of the shekel. So what's to make us believe that it may work now, that's going to be on traders' mind as we head into the day.
Simone, thank you very much. Simone Foxman at the Qatar Financial Center in Doha with the very latest on the Middle East. Now, the former Xerox CEO, Ursula Burns, was the first black woman to take charge of a Fortune 500 company. She told Bloomberg large companies are starting to feel uneasy about the racial divide in America.
Just a top of my worry list, top of a concern list. But I entered this discussion and this debate during the coronavirus, at the start of the coronavirus, optimistic, interestingly enough. Optimistic about maybe coming out of this disruption time in a better position than we entered. And that meaning that people, companies in particular, paid attention to what we now call these essential workers. We start to understand what an essential worker really is, the guy who delivers food for us, the guys who stock the shelves, the guys who push the patients around, etc. I'm hoping that, knowing that a lot of the black and brown people in the United States work at the lower end of the socioeconomic employment ladder, I'm hoping that we can use this time, total disruption, pandemic, racial unrest, continued socioeconomic imbalance, to reset the whole conversation about how black and brown people are fit into the employment ladder, but also how companies view these quote unquote essential workers and how important they are, how we have to pay them, how we have to nurture them, and how we have to move them up the ladders.
We've seen...
I'm hoping it's an opportunity, but I don't know if it will be.
I'm glad you're optimistic. I hope that we can come out of the conversation still optimistic. How optimistic are you about some of the statements that are being made by corporations? I'm interested in particular because do you think they feel authentic across the board as it stands?
I think that many companies, many more than I've ever seen before, so the vast majority that are speaking now, many more than I've seen before, are starting to feel uneasy about the state of America in this space. They are starting to realize that this is fundamentally unsustainable. It's definitely unfair and wrong. And that the tilt is starting to come off. We're starting to go out of balance. And it's really important that the rhetoric in the administration, which is generally negative and definitely demeaning, that has to be offset by some action, real action, funding groups, changing employment practices, being affirmative in how they actually address their employment needs, being affirmative in hiring Black and brown people, being affirmative in progressing them through the companies, being affirmative about how they look at the C-suite and look at the board level. Without that passion and that drive, I think that we're going to not make progress. And I think the companies are now starting to realize more and more that not making progress is not sustainable. So they're going to have to do something. And the good news is it's kind of like it all came together at once. This is not enough to make change, but at least if we get enough crescendo of voices, maybe we can keep the action going. This is not the first time that a Black man has been killed by a policeman. It's not the first time. It happened before. It happened before that. And I'm hoping this time we just don't let this sacrifice of this human go unrequited, unpaid back, right? It's important that companies start to stand up and say, we have something to do with this. We have something to do with the solutions.
So Ursula, what makes this seem different to you that the outcome of this is going to be different and more positive than maybe what it was in the past?
I think that the number of the broad-based coalition that's now starting to speak, please don't get my little optimism as overjoyed optimism. Don't get me wrong. Yeah. I do not believe that what I'm hearing today is going to actually drive change. We're going to have to be involved and stay involved. All of the voices in the street, all of the voices in the news media, all of the voices in corporate America are going to have to stay involved to actually see true change. The only reason why I'm a little bit more optimistic is that people are getting fed up with the current state of play.
That was the former Xerox CEO Ursula Burns speaking earlier. Let's get back to the market action because we have a developing story around gains in the Asian session. At least quite a bit of upside coming through on the MSCI Asia Pacific Index. Up about 0.6%, then following the U.S. jobs report from Friday that smashed expectations and really bolstering hope of a quick economic recovery. The dollar is extending its recent slump, so firmly risk on across the board. Equities climbing modestly in Japan, China, and Hong Kong. Korean shares a little bit out of touch here. They lost much of an early advance.
And Taro Aso, of course, talking about the additional potential for stimulus to come through in Japan on a second or third wave. There's the U.S. equity futures. My favorite line on Twitter, I've obviously nabbed it from somebody, is we've gone from recession to depression to euphoria in 100 days. And of course, the S&P 500 had its fastest 50-day rally on record. The Dow Jones futures indicated up 0.2%. OPEC has a deal. Jay Powell speaks this week. And we're joined by Rania Al-Mashat very shortly on the Egyptian investment story. It's Bloomberg.
of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Egyptian stocks rose the most in more than 2 months yesterday after the country reached a preliminary agreement for $5.2 billion standby arrangement with the IMF. That seeks to alleviate the economic impact of COVID-19. Let's get a little bit more on Egypt's finances and the state of play. Rania Al-Mashad is the Egyptian Minister for International Cooperation. Minister, thank you very much for joining Yusuf and I this morning. So this backdrop, this standby agreement with the IMF, it's a good news, a good signal. What does it signal to the world about bringing funds to Egypt?
Well, good morning, everyone. And at the outset, I would like to say that it's not just that we are focusing on the immediate impacts of COVID, but we're actually looking forward. And that is very important because countries post-COVID are going to be distinguished by how much effort they put in trying to implement structural reforms that help put the economy on a path for more employment and more inclusive growth. So this is something that we have been able to do pre-COVID. We had concluded a very successful reform program by summer of 2019, and that has allowed us to enter into this crisis with a very good fiscal as well as foreign exchange position. And the government during the crisis has taken very important steps and policies, both on the monetary side, the fiscal side, but also more importantly, when it comes to structural reforms related to widening the social safety net, mitigating the impact on informal employment, creating also women-specific policies related to COVID. So there's so much that has happened, and what we want to do going forward is build on that in order to help not just rebuild the economy, but really reshape it.
Mm-hmm. Minister, you say you want to build on that. So let's flesh this out a bit more in terms of the kinds of targets you've set yourself for this year and beyond. Have you been able to secure some of the financing? I mean, we know that you have been able to do that. What else is in the pipeline in terms of that financing?
So it's, I used to work in the IMF before, and something that is very important, and I'm sure that all of you cover, any IMF program has to be fully financed. And that's where other multilateral and bilateral partners of development come in. In the case of other finances, and that is whether we're talking about the African Development Bank, we're talking about JICA, the French, the World Bank, etc. What we have been working on in the Ministry of International Cooperation is to make sure that the Sustainable Development Goals are not overlooked in the midst of all of this. So you will find that we have created a multi-donor platform for very specific sectors that will help actually push the economy forward. That includes electricity, transportation, the health sector, given the focus globally now on that and also nationally. We also have not only help or support to the sovereign, but also to the private sector through credit lines to Egyptian banks that are availed through the EBRD and the EIB. So it's really a multi-dimensional and a multi-sectoral effort to create sort of more impetus into sectors which are going to help the economy. So for instance, when I talk about electricity, Egypt has just received 2 awards from EBRD, one in terms of sustainable energy, the other one in terms of gender. When we come to solar and renewable, Egypt is the #1 in the Middle East. So we want to build on this. And that's why in the multi-donor platform, the energy strategy for 2035 is being pushed. These are very good opportunities where private-public partnerships can take place. Similarly, for transport, when we are talking about expanding the metro lines, more connectivity, all of this is quite important for investments going forward. When we talk about the support to the private sector, it's not just the big companies, but also the small and medium enterprises, which are really going to be the engines of growth going forward, particularly given the global shock that we've seen.
Minister, we need to push you a little bit in terms of the timing. When will you have these funds on the books? And let's press you a little bit. How confident are you that you will get all the money that we just listed in terms of the multilateral agencies? When, Minister, and how much?
You know, it's very important to mention that Egypt has a very successful record with all our multilateral and bilateral development partners. We have been able to, push through with lots of programs and projects with them. And we have already board dates set up with many of the items that you put on your screen. This is happening very soon. And you will see in the press that they have been secured. The other thing which is important, and I want to use this opportunity to mention it, we have created a new global partnerships narrative, which is people, projects, and purpose. And the idea here is that each and every project and each and every development partner that we just talked about comes under this umbrella. How many beneficiaries are going to be affected? What is the type of the project? Is it a PPP project? Is it the nature of its financing? And then third purpose, which SDG does it really meet? All of these that were on your screen have been secured. We're in the final stages of finalizing it, and actually we have board dates for many of them already.
Minister, Egypt's net foreign currency reserves came through overnight, and it's near the lowest level now in 3 years. The Egyptian pound has been on a losing streak as well. To what extent is that a concern for you, and how much does it, how highly does it rank on your priority list at the moment of things to do?
I mean, I think for international reserves and foreign exchange, that is a discussion you can have with the central bank. Nonetheless, as I mentioned, Egypt is a country that has tremendous potential. Our reform story has spoken very well about the commitment of the government in the past. And we are not new to shocks. We always have shown resilience. And I believe that, given our commitment to structural reforms, what we call the second wave of reforms, and these reforms focus on creating an enabling environment for the private sector, increasing productivity, creating more inclusion and focusing on sectors of priority. All of this is going to speak for itself going forward. We have not been only, sidetracked by COVID, but we have been looking really into details of how to create more jobs, create a more inclusive economy, and that is going to be very, very important to investors and for everyone who's following the Egypt story.
Minister, thank you very much for joining us this morning. That's Rania Al-Mashat, Egyptian Minister for International Cooperation. Thanks for getting up, especially early for Yusuf and myself this morning. That's the state of play in Egypt on the money flowing in. Much more to come on markets right here on Daybreak Middle East. It's Bloomberg.
about Brent crude because it is trading around $43 a barrel after OPEC and its allies agreed to extend historic output curbs by an extra month, and they promised stricter compliance to ensure members don't pump more than they pledged. Let's get to Ed Bell. He's the Senior Director for Market Economics at Emirates NBD. Ed, there's a growing amount of skepticism from quite a few houses as they get a chance to digest the latest agreement. What is your take on it all?
Well, I think in the short term, the messaging from OPEC over the weekend that they want to extend these deeper cuts is pretty positive in allowing that bid in crude oil to continue. But as you point out, the issue with any OPEC deal, and then now when you extend it to OPEC Plus, and you have about 20 members that you're trying to coordinate, is how do you ensure that every single member is going to be hitting 100% of their compliance or 100% of their production cut agreement? So we've had this pledge for the first time in an OPEC communique that countries that did not hit their target, in effect, had to make up for it in the coming months. Now that, again, pretty promising and unusual to get that from OPEC, but there's still no tool that OPEC Plus has to effectively force members to do that. So I think that's where there's a little bit of skepticism as to how strong that compliance is actually going to be going forward.
Yeah, and I think our story called it draconian measures. Ed, good morning to you. What I'm curious about is Saudi Arabia not only completed their commitment to the OPEC Plus deal, but they went a further country mile, so to speak, with an additional 1 million barrels. How important is it that we hear that Saudi Arabia recommits to that additional 1 million barrels? Is that my market risk?
Well, I think if we had an announcement from Saudi, from some of the other Gulf producers like the UAE and Kuwait, that they would effectively add on top of their targets, that would help the rally in the oil price we've seen be a bit more sustainable, to solidify us in the sort of 40 to 45 or even higher kind of range. So far, we haven't had any announcement to that end. What we did see over the weekend, though, from Saudi Aramco was that they would be increasing their official selling prices, particularly out to Asia. So that you could sort of think as an indication that, again, restrained crude volumes are going to be coming from Saudi Arabia. But until we get an official view that that extra 1 million barrel a day of cuts is coming, I think the market rally to the heights that we've seen right now may be a bit toppy.
And if there's ever a canary that is going to emerge from the coal mine, it is going to be from the broader U.S. shale developments. The Baker Hughes Index tells a powerful story. We're down 70% in terms of the rig count just this year. But as prices keep creeping up, that could turn around very, very quickly and put this whole deal into jeopardy once again.
Yeah, that's an absolute risk. I mean, I think for producers in the United States, the last couple of months have been extremely difficult. So not all companies there will have the capacity or the liquidity to be able to deploy rigs into actually increasing production. But for some of the better companies, I think the prices that we're seeing, particularly the 2021 prices, where you have the WTI curve in sort of the mid 40, sort of the 40 to 45 kind of range on average, that looks to be a little bit of an appetizing hedging environment. So they might be using that as a position where we don't necessarily see a big increase in production in the second half of the year, but certainly see a leveling off and a tapering of the pace of decline that we've seen in U.S. production. There was a call from OPEC over the weekend that other countries proportionally keep their cuts in place, but we really see no incentive for the U.S. or any state governments there to mandate official cut in production, say in Texas or other big oil-producing states.
You talk about the contango tightening up, and I just want to get a sense from you, Ed. Do you think that the contango has tightened sufficiently? I think you think we've gone from, what, $1.60 on the front month spread in the contango to a quarter of a cent. Do you think that tops out now, Ed, or could that go further?
Well, I think if we got messaging from Saudi that they are going to be extending their additional cuts, there could be some more topside for us to go back to neutral or slip into a backwardation in the Brent market. But I think there's a couple other indicators to bear in mind for the oil market. If you look at the refining margins, they're still pretty depressed in some key areas, particularly in Asia. So OPEC has done a very good job, I think, of consolidating control around the supply side of the market, restraining output, and helping oil prices bound higher. But really, we need to see the demand side improving significantly to allow for that rally to be sustained and for the curve to really flip forward. So we might be floating around these very low levels, particularly at the front month time spreads, but to see them flip into backwardation on a sustained basis, I think is a little out of reach at this point.
And as I look to the global markets map on my Bloomberg, a lot of green tiles flashing when it comes to the commodity space more broadly. It's not just an energy story, also a rally underway in iron ore, in natural gas, in copper, in sugar. This is a broad-based risk-on move. Where do you see the most sustainability in the moves to the upside, and where are you becoming a little bit more cautious?
Well, I think it's worth bearing in mind that the improvement we've had in the commodity markets has come in line with a broad risk-on rally in equities and other sort of risky FX as well. So it's not necessarily a commodities-only story, and in a way, a lot of the commodity fundamentals still remain quite distressed when you compare them with where we were a year ago. So, yeah, we had some positive numbers, at least from the overall trade balance from China, but if you look into the actual commodity volume numbers, so volumes of imports of iron ore or copper concentrates, they're still lower than they were a year ago. And it doesn't look like we have a particularly strong demand profile for a lot of those products going forward. So the improvement we've had has been, I think, a correction from extremely distressed levels, but not necessarily one that allows us to push much higher or really recover the ground that we had lost at the start of the year.
Yep, we could be in for a bit of a wobble, couldn't we, Ed, as we saw imports from Australia drop by 10.7%. Ed, thank you very much. Always great to get your input on oil and the broader church of commodities. Senior Director for Market Economics at Emirates MBD. Plenty more to come on your markets. This is Bloomberg.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
We saw the euro on a 7-day
sizable moves in the currency market. Temperatures down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the First Word Asia.
The U.S. and Japan duke it out over exchange.
China's slumping onshore bond market is
Hong Kong's government is promoting a message of stability, in particular for its currency peg, unbroken since the 1980s, as the territory charts a course to revive the flagging economy. Bloomberg spoke to Hong Kong's Financial Secretary Paul Chan about when he sees a recovery.
This is hopeful, but this is very much depend not just on ourselves, but number one, the coronavirus situation globally. Because if globally this is under control, then a lot of economic activities can be revived. And secondly, the relationship between the US and China, particularly on the trade front. That would affect our foreign trade. And also, thirdly, at the moment, when we get the coronavirus situation under control and the society back to a stable environment, we are going to encourage our own consumption. Say, for example, the $10,000 scheme for every eligible Hong Kong citizen.
People are still waiting for that, by the way.
It's coming soon.
That's been a big complaint of local people, that they haven't gotten their checks yet.
Yeah, we heard that. We are working very hard to
Why
set
did
up
it
the
take
system.
so long?
Well, say, for example, in the U.S., you pay tax on a pay-as-you-earn basis. We pay tax once in a year, and we have also a very stringent Data Privacy Act. The data we gather from our citizens from different sources cannot be used for this particular purpose.
More stimulus needed, and where and how?
Well, we are working very hard to roll out the stimulus package that we have outlined in the budget and 2 rounds of anti-epidemic fund. Wait till these measures are all rolled out before we decide the third one.
Well, first quarter GDP growth was down 8.9% year
Yes.
over year. I think the worst on record.
Yes.
Is that the worst for this year? And do you have any reason yet that you can give us that you might have to revise your full year forecast again? I think it's for a contraction of 4 to 7% for the full year, right?
We will be doing another update in August as part of our regular process.
What are the tea leaves telling you right now?
Well, very much depend on external virus situation and the economic recovery in Western countries. Yes, we suffer dearly in the first quarter, but globally, I think we are in a global deep recession because of the virus.
Are you seeing any indications of capital flight?
Well, facts and figures speak louder than words. Ever since the announcement of the intention to legislate national security law, the Hong Kong dollar to US dollar convertibility undertaking has all along been on the strong side. When I talk to the banks, when I talk to the private wealth management individuals, when I talk to Hong Kong MA, in fact, there is no obvious outflow of capital.
The local news, though, shows signs of people a little bit worried. I mean, local money exchanges running out of US dollars, or they're lining up to get US dollars or other currencies. That's happened in the past in times of crises. People seem to want to get hard currencies. Is that just a temporary phenomenon right now, or is that an indication that there are some deep-rooted concerns in society?
I do not believe this phenomenon is a reflection of any deep-rooted issues as such. I would say this is a short-term anxiety and sentiment. Last year, during the social turmoil, we saw similar phenomenon. And in fact, last year, when we went through those difficulties, our financial market had been operating very smoothly. And again, there was no obvious capital outflow. The total deposits in the banking system at the end of last year, compared to the beginning of last year, registered a very modest 1% growth. And so far, this in the past 4 months, in the past 10 days, we did not observe any obvious capital outflow.
Paul Chan speaking there. Let's also get to the story around 2 drug makers behind the most prominent responses to the COVID-19 pandemic. They are looking into the possibility of a combined future. Bloomberg has learned that UK-based AstraZeneca has made a preliminary approach to its U.S. rival, Gilead. Bloomberg's Lisa Du has the details. Lisa, let's run us through what we know in terms of the actual meat of the deal.
Yes, like you said, my colleagues at Bloomberg News did learn that AstraZeneca, which is the largest drug maker in the UK, reached out to Gilead about a potential merger in the last month. Now, neither companies have commented on the matter, but some people familiar have told us that Gilead isn't actually interested in being acquired.
Still, the fact that this was discussed and reviewed has people very excited. If such a deal happened, it would be the biggest one yet for the pharmaceutical industry. And Gilead was worth about $96 billion as of the close last Friday. And also just to add, the two companies are both involved in the pharmaceutical effort against the coronavirus. AstraZeneca is partnering on a very promising vaccine that's in human trials. And Gilead, of course, makes remdesivir, which is the only U.S.-approved treatment for COVID-19.
So what is the broader pharma industry? Because obviously AstraZeneca batted away a bid for themselves just a couple of years ago. It's going to raise the storylines about, mega mergers on the way in pharma, isn't it?
Yes, definitely. I think it just the mere idea of it has people really excited because kind of a huge pharma deal potential is a sign that the industry maybe is looking and thinking about something resembling business as usual. Right now there's a lot of eyes on the pharmaceutical industry because of COVID-19, but the truth of the matter is that successful treatments and vaccines for against the coronavirus are unlikely to be big money makers, and some companies have also agreed to give away potential treatments without royalties. So these drug makers will continue to face the pressures of having to boost innovation and having to come up with new drugs, and that may mean these types of mega mergers in the future.
Yep, and my favorite phrase in the Bloomberg story is the compound names: GlaxoSmithKline, Bristol-Myers Squibb. Always a great momentum in story. Stocks have got a strong bid to them this morning across Asia. You are seeing U.S. equity futures higher on the S&P 500, 31.95, just below the 2,000 levels. So we are looking for a better opening, Yusuf. There's an OPEC deal on the table and the dollar's falling over.
Yeah, New York City is going to be reopening today, and then on Wednesday you have the FOMC. Plenty more coverage ahead here and from the rest of the world. This is Bloomberg.
Chances are you may have started cooking more during quarantine, which means you've made plenty of trips to the grocery store, either in person or virtually. But brace yourselves, that chicken wing and hamburger patty, it's about to cost you more money. Just 4 meat processing plants account for about 80% of production in the United States. Back in April, President Donald Trump ordered all meat processing plants stay open.
They're going to be very careful. They are. As to who's going into the plant, the quarantine is going to be very strong.
Even as workers fall ill and production output suffers. So where are plant operators in all this? They have to go through lower productivity and higher costs, which means they need to make some major changes. And some plants are already running slower because of social distancing and fewer workers, and some production lines are fully automated. Tetra Das is a professor at the New Jersey Institute of Technology. He gives us the numbers. He says reducing meat processing plants to 1/3 of their capacity and also distributing the adequate protective equipment, this could all boost chicken prices at grocery stores by 25 to 30%. That means if you buy chicken at 99 cents per pound for 5 pounds, now at $5.95, it could cost you up to $6.44 before taxes. That means higher costs for an industry that's been pretty efficient at putting out cheap protein.
another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television.
Founded more than a century ago from humble origins, L'Oréal is now the world's biggest beauty products company. Specializing in cosmetics, hair, and skincare, it boasts an international portfolio of 34 brands and has a market cap of more than 105 billion euros. At the helm, a man who's dedicated his entire career to the company. Over 4 decades, he's covered all facets of the business. Today, on Leaders with Lacroix, we meet Jean-Paul Agon, Chairman and CEO of L'Oréal.
Monsieur Agon, thank you so much for speaking to Bloomberg.
Pleasure.
What happened to L'Oréal in the last 10 years? Innovation, your share price has grown. Was it exciting times?
Yeah, very exciting. You know, I started as a CEO 10 years ago. It has been 10 years very exciting. Of course, we had a crisis in 2008 and 9. But globally, the business has been very good. We have been growing, acquiring brands, launching new products, gaining market shares everywhere in Europe, USA, China. No, very exciting, fantastic.
What's been the most fun?
In fact, the most fun has been the past 3-4 years, because thanks to the digital revolution, everything has been transformed. And as I tell my teams, I think that this industry, our business, our company has more changed in the past 3 years than in the previous 30 years. So it's an amazing time, extremely exciting.
So is this the way you sell, or is it the way that people actually look at makeup?
No, in fact, it's the relationship between brands and consumers. In fact, the digital has completely transformed the relationship between the two. Before that, you know, the brands were talking to consumers, pushing towards them information or whatever. But now the consumer has taken the power. The consumer decides how he wants to see the brands, what he wants to know, what he wants to discover them. Digital, in fact, creates a relationship that has nothing to do with what existed before.
But isn't it much more difficult, therefore, to control your brand?
Yeah, but at the same time, it's more exciting, and it enriches the relationship. So now, thanks to digital, we can communicate the content of our brands. We can do tutorials to explain how the products work, how they should be used. We can have a personalized relationship with consumers. So it's a completely new dimension. It's much more rich and exciting.
So what sells at the moment? Is it the luxury brands, or is it the more consumer brands?
This year, luxury. This year, luxury has been booming everywhere. Mostly with Chinese consumers. You know, Chinese consumers are fantastic. They love beauty, they love luxury, they love our brands, and our business with Chinese consumers everywhere has been booming.
L'Oréal's global reach stretches across 140 countries. About 2/3 of its sales are generated outside of Europe. Much attention has shifted to China, where strong demand for high-end lipstick and perfume is driving growth. In 2015, China surpassed France to become the group's second biggest market behind the United States. Some of the success is being attributed to selfies, with camera-conscious millennials buying more makeup than ever before to look good instantly.
Have you had to adapt to the Chinese market?
Yeah, in fact, the products we sell, not for all brands, because the luxury brands, for example, are the same all over the world, of course, but for our mass brands like L'Oréal, like Maybelline, the product that we sell in China are formulated in China by Chinese, in our Chinese labs.
Because of regulation?
Not only, but also because we want to create the products that are absolutely right for them, especially skincare, because their needs, their skin, their aspirations are specific, are different. So we formulate in our Chinese labs, we manufacture in our Chinese factories, and L'Oréal now L'Oréal Paris is the #1 beauty brand in China.
I've also been reading that one of the most popular products is actually a homemade I guess, range of cosmetics wear, which is favored by the wife of the president, President Xi.
Yeah, it's a great brand, but still the #1 beauty brand in China, the preferred beauty brand by Chinese women is L'Oréal. L'Oréal Paris. They call it with a Chinese name. It's Pali Olaya, which is beautiful, by the way. And it's it's great because the L'Oréal Paris is the number one beauty brand for Chinese, for Americans, for Europeans, for Russians, everywhere. So it's a great
not bad.
Satisfaction. Yeah,
so,
not bad.
So tell me about your success in China. Is it through distribution? Is it through ads? Is it through celebrities? What's the attraction for your brand by the Chinese?
The reason of success of our brands everywhere is always the same. It's #1 quality. We for all our brands, our absolute priority is the quality and safety of our products, and it's something that the Chinese respect a lot. It's very important for them. #1, innovation. Innovation is extremely important. It's an industry where you have to innovate a lot. More than 15% of our products every year are new in order to keep innovation flowing very strongly. Of course, it's the imagery of the brands. Brands like Yves Saint Laurent, Lancôme, Giorgio Armani, L'Oréal Paris. It's a beautiful imagery, and Chinese consumers are very sensitive to that. They like it.
Is the U.S. tough? A tough market?
The U.S. this year is a bit tougher, a bit softer, let's say. It's not really tough, but it's a bit softer. Certainly softer than China. But it depends. Last year the U.S. was very good. So every year, it's funny because every year the market, roughly globally, is more or less growing at 4%, but it's never made exactly the same way.
But so how difficult is it to predict what will work and what won't? Why am I using this mascara, not the other mascara? Why am I using this foundation, not the other?
Again, it's very, when you know well your consumers, when you understand their desires, when you can guess their dreams or expectations, then you can really create what they will love.
What will the next 4 years bring? Is there a specific market that you think will grow more? Is it, for example, men's cosmetics or something else?
Digital, I think, will be the most important element of transformation of the market. So definitely we're going to see the e-commerce growing. For example, e-commerce in China is already more than 30% of our sales for our mass market brands. So it's huge. So we're going to see digital growing. We're going to see probably new channels also emerging, like specialty stores, our own stores. We are very big in also growing segment is the travel retail, the stores in the airports, because more and more people are traveling. So I think there will be new channels. In terms of regions, of course, the emerging markets are still growing, and our categories are growing too. Makeup has been booming for 2 or 3 years. I think it's going to keep booming. Skincare is growing too. So honestly, I'm very optimistic about the short-term, middle-term, and long-term perspective of this industry.
What do you think you spend most of your innovation on? Is it, for example, making a lipstick that lasts longer? Is it kind of changing it a little bit? I know you have so many products, it's unfair.
And a few secrets.
And a few secrets, but you can tell us, we're amongst friends. We were talking about what the next 4 years will bring,
Yeah.
and it's a lot more e-commerce. How do I choose my makeup online? It must be difficult to choose the right coloring.
No, because now you have some technologies that are amazing. You know, you can test online on your cell phone, for example, simulate the application of the makeup on your face, and then you see yourself with the lips covered with the lipstick you want, the shade you need, the powder, the mascaras. You know, I did a demonstration of that to my board, you know, completely made up, and it was they were ecstatic.
Was that for the launch of the app?
Yeah.
And so they said yes.
Yeah, I wanted
fantastic.
I wanted to share with the board the fantastic progress of technology. It's amazing.
Oh, I could look like pure reds. Oh, wow.
The lipstick is moving with my mouth, and I know that I don't have any on. It's like Amy Winehouse flicks. It's brilliant. I can't stop looking at myself.
So this is amazing because you also have to then change, I guess, your research and development. How much of the overall cost goes on actual digital products?
Well, it's difficult to say because it's everywhere, in every brand, in every division. But what I can say is that now, more in terms of media, 1/3 of all the media that we do now goes on digital. In terms of e-commerce, 7% roughly of the sales that we do go on e-commerce through digital, and it's growing 30% a year. So there is a shift happening, which is extremely fast, extremely strong.
The company that invented the platinum blonde is constantly innovating and developing new products as consumer demand changes. At its lab in Paris, scientists have studied more than 7,000 types of hair and are now experimenting with 3D printing. The hope is to one day help people suffering from hair loss. L'Oréal's already created fake skin to avoid testing products on animals and invented a UV patch to monitor exposure to the sun's rays.
We have the #1 R&D facilities in the world. We are spending roughly 3.5% of our sales in research and innovation. And obviously, the most important topics are hair, skin, and hair. This is where we invent and create new formulations for hair care, hair color, all type of hair products.
You also have a patch?
Yeah.
Is that right?
UV patch.
A UV patch, so you put it on to see when you're overexposed to the sun.
Yeah, it's a creation that was made 2 years ago that we presented at the Consumer Electronics Show in Vegas last year. And it's a UV patch, you put it on your skin, and it's linked to your cell phone. And it calls you or it rings when your exposure to UV has been too high. It's a fantastic tool.
So do you think there's going to be more of a trend, which I guess is between the cosmetics and the healthcare?
Yeah, absolutely. Yeah, and also with internet, you know, this triangle between beauty, health of the skin or hair, and Internet of Things is creating new opportunities, and that are going to be very useful for consumers.
What do you like about your job the most?
I love understanding people. You know, I think that one of my strengths is the capacity of empathy with consumers. So I have this capacity to understand, to feel, to guess what consumer want, what is their desires, sometimes their dreams, and then to be able to formulate products that will respond to these dreams.
Do you believe you have to take risks to innovate, or
yeah.
actually, do you?
Oh yeah, of course. Yeah, because every innovation by definition is a bet. Every launch is a bet. It's like a new film or a new movie or new music. You never know in advance. But that's the magic of it.
So what do you think you spend most of your innovation on? Is it, for example, making a lipstick that lasts longer? Is it kind of changing it a little bit? I know you have so many products, it's unfair.
And a few secrets.
And a few secrets, but you can tell us, we're amongst friends.
No, we are working on all categories. You know, we have 3,500 researchers from many departments, and they are all working on all type of cosmetics, skincare, hair care, hair color, all sun care. And because fundamentally, as I told you, we really believe first and foremost in terms of efficacy and quality. So the mission of the company, which is beauty for all, is also not only beauty for all, but the best of beauty, the best quality, the best performance, the best efficacy, the best safety, and that keeps us busy.
3,500 researchers.
Yeah.
How long does it take from, I don't know who has a concept of, for example, a new product, until that product being on the shelf for someone to buy?
Depends. Can be very quick when the formulation is easy. Can take maybe 6 months. Or when for example, the marketing guy has a vision, has a dream, but the labs don't know exactly how to formulate it, can take 2 years, 3 years. Really depends.
Mega volume on top, mega volume on bottom. Share it with your friends and buy makeup instantly.
One of the criticisms often leveled at the beauty industry is that it's only for young people. Is there any truth in that?
No, not at all, of course not. First, that would be stupid, because we are addressing all needs for all people, and look at our ambassadors. For example, Jane Fonda, Helen Mirren, they are not millennials. So no, honestly not.
Do you sell more to millennials or to people of a more certain age?
No, we sell to everyone. It depends the brand. The brands, of course, some of our brands like NYX, Urban Decay are more targeting young people. Biotherm or L'Oréal Paris may target other categories of consumers. But no, we cover the whole scope of consumers. And in terms of age, in terms of diversity, in terms of countries, Chinese, Brazilian, Europeans, everyone. It's a beauty for all.
So how do you sell to the emerging markets?
We adapt the products that we sell, of course. We make sure that they are affordable and that people can buy them. Brazil, for example, is very interesting because Brazil is the country in the world where the hair is completely unique, because it's such a mixed country in terms of ethnic origins, that the blend is completely amazing, and that you have to create for Brazilian hair care products that are completely specific. And by the way, it's very interesting because sometimes they are the most demanding consumers, and so when you can create in Brazil a product that is good for them, then you can make it for the world, because it's going to be great for everyone.
Do you think Generation X cares more about this than millennials?
There is an urgency, clearly. We are not talking anymore about a potential threat. I mean, there is a clear and present threat.
For Jean-Paul Agon, life at L'Oréal began in sales 39 years ago. He quickly understood the power of advertising.
Read my lips. I'm worth it.
The company obviously thinks it is worth it, spending more than $8 billion a year selling and marketing its brands. A third of that on digital media.
When I was 20 years old, I was in a business school, and at the end, I knew I wanted to do marketing. And for me, beauty is the supreme art of marketing, because it's a marketing that is not only about understanding, analytics, but it's also about emotion, guessing, creation. So I think it's a fantastic marketing. There is no better marketing than beauty marketing.
And from that 20-year-old Jean-Paul Agon, what have you learned about yourself?
My God, a lot, a lot, because it was a long time ago. No, it took me, many years to get where I am today. But I was always passionate. I think the incredible part of L'Oréal also is that every day is a new adventure. Every day is a passion. It's a company made of really passionate people, and every new mission is an adventure.
So what are you like as a leader, micromanaging or overview?
I like overview, and from time to time I'm tempted to do micromanagement. But when I do that, my team say, Jean-Paul, you should not bother with that. Let us do it.
Do you review, though, the end product every time, or how does it work?
As much as, I have meetings with, of course, with all the brands, not all the time, of course. I travel in many, many countries around the world, and I'm just trying to help, to make sure that we are taking the right directions, pushing in the right innovations, understanding enough the consumers we are dealing with, trying to pilot the ship.
L'Oréal's Sharing Beauty with All program, launched in 2013, was designed to transform the business. Jean-Paul Agon was determined to make the company ethically and environmentally sustainable. It's been recognized for its efforts, awarded a AAA for water management, climate, and action against deforestation.
So when did you start thinking about sustainability?
Pretty a long time ago, especially when I came back from the USA and I took over as a CEO. I really understood at that time that for a company like L'Oréal, especially because we are the leader of the beauty industry, we had to make sure that also we would do the best and the most to make the planet a beautiful place.
What started it? Is it because you say we sell so much that we have to make sure that it doesn't go to waste? Or is it also because the consumers want something that's more sustainable? Or is it because the employees you hire want something more sustainable?
Very good points. I think it's all of that. First, because we have a moral duty. Secondly, because it's what our employees are asking for. Third, because it's what consumers want. Fourth, because it's what the society expects from a big company like us. So that's why we really went into this direction.
Does it make a difference for the consumer? I remember you telling me a couple of years ago, that if a consumer has a choice of a sustainable shampoo or a shampoo that makes our hair better, we'll always go for the shampoo that makes our hair better.
Yeah, but now what we want to do is to make a shampoo that makes the hair better and sustainable. Because now in fact, you're right. Our vision is that we have to find a way that it's not opposite, that it goes in the same direction. And it's the same for economic performance. For example, the sustainability performance should not be opposite to the economic performance. And in fact, we are able to prove that. For example, in the past 10 years, we reduced our carbon emission by 67%, when at the same time we were able to increase our production by 30%.
How do you do that?
We work a lot. We transform all our factories. We have now 10 sites that are carbon neutral. We completely transform the way also we engineer with water. We have what we call dry factories, that they don't use water at all. They completely recycle the totality of the water that they use. We eliminate waste. So it's a very comprehensive effort on all fronts to transform completely the way we produce, we distribute, etc.
And shareholders are behind you every step of the way for sustainability?
Yeah, absolutely. They are I think that our shareholders are very proud of what we do. I cannot say that they are pushing us hard to do it, but they are happy and proud.
Do you think Generation X cares more about this than millennials? The younger you are, the more you think about this?
I think that everybody now cares. You know, I think that it's very well understood that there is an urgency. Clearly, we are not talking anymore about a potential threat. I mean, there is a clear and present threat to the planet, and if we are not all doing the maximum in the very short term, it's going to be very difficult. So I think that every generation now understands that.
If I speak to you in 5 years, what will be your story?
In 5 years, probably I will tell you that the most important mission has been the transmission, because of course I will not be CEO forever, and I will be, by the way, very glad to pass the baton one day to my successor.
So if you think a lot about succession, what kind of successor would you like, and what would you like your legacy to be?
I will be proud to have been able to adapt L'Oréal to the new world. I think that we are living in a very special period. The world tomorrow will be very different from the world we knew a few years ago. And you know, my absolute priority right now is to adapt, transform the company in order to make it as successful as a leader, as performant in the new world as it was in the world before. And I'm very confident about it, because that's what we are doing. You know, we are doing a cultural revolution, a digital revolution, a sustainability revolution, and so the L'Oréal will be a fantastic company. And then someone else will take the baton and will drive the adventure further.
Jean-Paul Agon, thank you so much.
Thank you very much.
What do the world's tallest building, KFC in the Middle East, and e-commerce site Noon all have in common? They're all owned by billionaire Mohammed Al-Bar. His investments like the Burj Khalifa and the Dubai Mall have become iconic landmarks, and he's diversified into hospitality, retail, and e-commerce. He was named the most influential man in Dubai and consistently ranks amongst the top 5 most powerful Arab business leaders. But it's not all business all the time. He's also a sportsman. He's an active member of Emirates' horse racing community. Today, on Leaders with Laqwa, we meet Mohammed Al-Bar, the founder and chairman of Amar Properties. Thank you so much for joining us. You've really built a conglomerate. You've built a company that has multiple interests, multiple units, multiple portfolios. Did you diversify because you saw an opportunity or because you had to?
Well, I think all of us, we look at opportunities. We don't really have to do anything. But I think looking at the Middle East and looking at the industries that I went in with my team, I think we saw amazing opportunities in the Middle East in these sectors. And I'm glad that even though we've got difficult years, the past 2 years have been difficult years for us, still these businesses are operating well. So definitely it's based on opportunities and the sector's long-term growth potential.
Where do you see the most growth coming from? Which portfolio, which part of your business will do better than others?
The food operating well and strong in the region as a whole, especially with the food delivery business, and that's another story. I would say that our real estate business is still flying really strong. I mean, last year we grew about 28% in the region as a whole. Our e-commerce business is something that's very, very interesting. And we've got an amazing team looking at it, and that's also growing quite fast. But even with this growth, I think one have to be realistic as well. So you look at this growth and you look at what's going on in the Middle East, government policies, look at the world economy and what changes might take place. So you have to be alert at all times.
Okay, what does that mean? Do you expect a lot of the growth, in the Middle East? If you look at e-commerce, and we'll talk a little bit more about that, do you expect it to go threefold, fivefold over the next 5 years?
Well, I would say that our real estate business should continue to grow at about 20% a year. And that's the shareholders' expectation. And it's hard work to achieve that number and keeping cost under control, margins under control, and political and macroeconomic issues in hand. So food business, I think we should be growing 10% a year, year on year as well in the region. And keep in mind that we're talking about the Middle East, where there is a need for most of industries to grow, just because that I think the Middle East still has room to grow. And the other thing is that if you look at the population in the Middle East as well, and the whole demographics is in our favor.
Because they're young, and therefore these are, I guess, the youth will spend a lot more in 5-10 years.
Yes.
How will the economy shift?
Well, I think the economy will shift positively only because I believe Middle Eastern governments are really working harder than any other time in the past, and you see the changes that are taking place, positive changes that are taking place in Saudi Arabia. I think that's the same thing within UAE. I would look at Egypt. I'm quite interested in Egypt as well, and the change that's taking place in Egypt, with all the other issues that we have in the Middle East, where I believe that I don't think it's going to get any worse than this. I think we're looking forward to a more positive trend in policy and in politics and economic growth as well.
In terms of growth, country by country, which is a country that will outperform the others in the Middle East?
The majority of our focus is Saudi Arabia, UAE, Egypt. And I would say Egypt is going faster now. Saudi Arabia, I'm quite optimistic with the changes that you see taking place within the coming 24 months. I think you'll see quite a good trend, and the Middle and the UAE as well. You've got, of course, the other Arab countries who are some slow, some moving forward, but majority of our business are in these countries.
I mean, you're holding a big investment with the PIF on e-commerce for Saudi Arabia. Will there be more, for example, on property in Saudi Arabia?
Well, the Public Investment Fund, they are with us in our e-commerce business, but they are also with us in our food business. Now, are we going to do more together? I think there's a possibility. There's a lot of work that they're doing in Saudi Arabia and outside Saudi Arabia, in the region and outside. So I would expect that maybe we should look at real estate together as well, because I think Saudi Arabia will look very interesting the coming years.
How much can it grow, property in Saudi Arabia, over the next 5 years?
Oh, Saudi Arabia, I think it's at infant stage. I think Saudi Arabia can really grow. If you talk about pure infrastructure, if you talk about retail, industrial, hospitality, residential. So you just have to make sure that you are going at the right category of residential or the right category of retail. So there's plenty of room to go that way.
When you look at how you spend your time for each of the units and also each of the countries, how do you do it? How do you keep on top of it all?
Well, I try. I still say that the real estate takes a majority of my time.
Is that 50%?
I would say the real estate takes about 40% of my time, and then the rest is a split. Noon takes a lot of my time as well. The food takes the least of my time, because the team that sits on top of that business is really world-class team, and they've been in the industry, they know the industry well. Noon is a vibrant team. It's a new organization. I need to give it more time. While my real estate business, I have an A team, but you know, I'm emotional about real estate.
Yeah, I mean, this was like the foundation of it all, right? Do you still see it as your baby?
I think my name is really linked to the real estate more than anything else, while all these other businesses have been with them now for about 2 years. So it's a new brand of product that's associated with me.
When you look at the various IPOs and the various units, was it to unlock value, but did you ever feel like it was also high risk?
I think mainly to unlock value, and we have investors who have put in their money with us, and it's time for them to get rewarded. But at the same time, I really like putting management under pressure, because IPO is quarterly results. You're out there in the public eyes, under pressure to perform. But mainly value creation. I think that's the business we're in.
Value creation, because what, shareholders understand what you do more, and it almost focuses the mind of managers more?
Well, that is one, but many of our units, that if they're under the mother umbrella, I think value-wise, they're not fairly valued. So as we put them on the side and put them as separate entities, I think you create better value that way, and then you cash out a little bit and put management under pressure.
Are you looking at IPOing any other units or portfolios?
When you look at our business, we have businesses. We have India, we have our hospitality business, we have Turkey business, we have another business in Saudi Arabia. So the reality is that you can take all these businesses public at the right time. I think within the coming 3 years, we'll probably have India going public. We'll probably have hospitality as well going separately to the public route.
But so how much bigger will you be if I speak to you, and I hope to speak to you before, but if I speak to you in 5 years, how much will your holdings be worth?
I think we should be double in value, because we should be growing in value 20-25% on an annual basis. And I hope that my management and my boards really put that as a focus. And to be honest, I think we're capable of doing that. We just have to focus. We just have to focus and have to make sure that we have the right people to do it. And we do this day and night. And that's really how we do business in our region.
But that's acquisitions, or that's organic growth?
I would look at organic growth. If you talk about acquisition, which we have not done much of, I'm expecting that we do more acquisition in the coming 2 years.
Mohammed Alabar, thank you so much. Coming up next, going from bricks and mortar to clicks, we talk Mohammed Alabar's big push into e-commerce and how his company Noon could become the Amazon of the Middle East.
Mohammed Albar is not only a titan of property, he's also betting on e-commerce. His startup, Noon, launched its operations in the UAE last year. The site is described as an Arabic-first e-commerce platform and is rivaling the Amazon-purchased Souk, looking to take over 15% of the growing market. One of the biggest investors in Noon is Saudi Arabia's public investment fund, which put up $500 million. But Albar is not just competing against Amazon. He's also a major player in the luxury space. He's partnered with Yux Net-a-Porter Group to offer a premium retail service to the Middle East's fashionista set.
So Mohammed Albar, do you ever feel like there's a conflict that you actually own Dubai malls, but at the same time you're trying to sell on e-commerce platforms?
The issue is that, are you relevant? That's really the big question that we have, is that I don't think it's if there's a conflict or not, but are you relevant to the space? So are we really relevant in this retail scene, or in the whole, the economy is becoming so digital. If you are not thinking about it, if you're not acting to do something about it, I think there is a risk of your business, being probably at huge danger the coming 24 months.
And so how do you stay relevant?
I think staying relevant, first of all, I have to talk to my kids all the time. And I learn from them because, I have a little girl that sells jewelry to women in Korea out of Dubai on her Instagram. I mean, what type of world is this? So therefore, I think all of our business, from real estate to retail to hospitality, I think the digital scene is changing all that. So if we talk about e-commerce specifically, or if we talk about Net-a-Porter, it is just moving your business to the digital scene. And I think the whole economy is moving that way, from healthcare to education to retail. So therefore, I think we just want to be relevant. And I don't think there's any conflict, because at the end of the day, there ought to be a collaboration or connection between the real world and the physical world. And can we really try to find a solution and work them together and stay relevant in our business?
But so how much of your sales will actually be done on your e-commerce platform in 5-10 years? And in general, for the Middle East, are you a step behind in actually selling on e-commerce? And so is the potential much bigger than here in Europe or in the US?
Well, remember, I mean, when I look at the Middle East right now, I mean, e-commerce is between 1.5% to 2%.
Tiny.
Which is tiny compared to the rest of the world. So there is room for all of us to grow. Where will this be? I think it will go much faster than the rest of the world, and it will get into the 10-15% quite fast, again, because of the demographics of the region. So we owe it to our society, we owe it to our 300 million Middle Eastern Arabs, that there ought to be a native organization that look after this sector and participate and learn and serve.
What will Noon become? And are you nervous at any point that you're going to head with the most successful retailer of all times, Amazon?
Well, Noon, of course, it will be an ecosystem. And am I nervous? Of course I'm nervous. I'm nervous from everybody. In my real estate business, I'm nervous. In my e-commerce business, I'm nervous. In my Net-a-Porter business, nervous, because competition is severe and markets are open. Anybody can come in. The big players are going to come in. Some of them came already. More are going to come to the region. But I am from that part of the world, and I think it's our duty to participate in the scene. And remember, we as Arab businessmen, we're a bit tribal, which means that I am from this society. I have a duty that get into business and be aggressive and achieve the numbers, achieve success. But that's a duty that I feel responsible for, that competition is good for the consumer in the region, rather than one player come and controlling the life of our customers. I think it's fair to have competition and let the customer win at the end of the day.
Okay, but how do you decide? I mean, how will you go against Amazon? Do you have to convince retailers to sell on your platform instead of Amazon's platforms, or is it a price war? I mean, how do you see the kind of the fault lines?
Well, we are working with the local retailers, and we are their partners. Now, how other international players, they do it through sourcing overseas or working in some other methods, that's their business. But we differ is that our partners are the local retailers. Maybe our margins will be a little smaller, but that's okay. We'd rather win on the long term rather than alienating the local retailers. Now, will there be a price war? Well, the past 2 months, there's a price war. Customers are winning. Everybody's 20% or 15, 10% cheaper on some of the product. So I'm so happy that people in my region, they don't have to buy milk for their kids at 10% more expensive. There was one operator or one monopoly controlling, the human life. I think this is good for all of us. So of course there'll be a competition. But the amazing thing is that the world is open. So much new technologies are being provided to everyone that want to go into the scene. But are you planning long term? You have good people with you. Are you serious about it? Are you willing to provide quality service?
But is it the service or is it the products? How does the Middle East actually shop? What's selling at the moment and what will sell in 5-10 years?
Well, if you look at the mix of what's happening on the e-commerce scene, it's not much different from what's going on in the world. People want delivery, fast delivery. People want quality.
Will they pay for the delivery?
For the time being, we're subsidizing delivery. Because, as I said, people are just learning the art of e-commerce, and that's what global companies are doing. They give it to you for free first, they get you used to this way of life, then later on take a little bit of margin, maybe control market, the usual trick. But what I'm saying is that people want it all. Want quality, want value, want consistent, want delivery time that's fast, and we want the product that they want, which changes from 1 month to another month. And therefore you have to provide that and then get ready to provide the new thing that might be happening next month.
Okay, how important is market share? And how important is market share right at the beginning so that people get used to your platform and not Amazon's?
Market share is very important, and at the beginning you have to be aggressive and you have to probably provide the best service ever. You will be cutting prices as usual because we see it, it's a live competition. There's nothing wrong with that. But the good thing is that the market's big enough. 2 players can come in. But imagine if you do business in UK and there is only one operator. How fair is that to your family?
But isn't there only Amazon here?
Well, there are many other players, I think, in UK as well. I prefer that more than one player in a market. And in the Middle East, there will be more than one player and will be one of the major players in the market.
Up next, we talk the leadership skills it takes to create both the world's largest mall and the tallest building in the world. More with Mohammed Alibar next. MR Properties has grown more than threefold since 2011 and expanded heavily in the Middle East and North Africa despite political instability in the region. So what kind of leadership does it take to shepherd a global company through turbulent times? Well, Mohammed Alabar, chairman and founder of MR Properties, is here. What kind of leader are you? Throughout the program, we were talking about encouraging your leaders, your regional leaders, and also your portfolio managers to be aggressive. Do they always need to be on their toes?
Well, I think, number one, they have to be relevant because the change that's taking place in the world. So are you relevant? And the other thing I like is that I think we all have to believe in the reset. Are you doing this upgrade? Are we upgrading every 1 month? Because there's so much happening. And do we really act? I mean, that's, so we have to be relevant, we have to act, we have to have discipline, we have to believe in the best people, and we have to take care of our society. These are things that these are the elements that I really depend on to manage my business.
Okay, but what does it mean being relevant? Because in more traditional times, you could ask a customer what they wanted, and you're saying, okay, I'm relevant. But now the change of pace is so fast. Well,
relevant is that, are you watching social media daily, what's going on with your customer? And what's going on with your business? There's no more I'll do a research and I'll wait 30 days. How alert are you? And how alert about how your customer feel, or alert what's going on to the industry, what's going on with politics, what's going on with the economy, what's going on in new tools of management, how fast can you go? So I think, are you awake?
What do you need to be awake for more? Is it for your clients, or is it politics, or is it how your business interests are going?
Well, it's about my customer, number one, my people, number two, the society, what's going on in politics, what might happen to interest rate. You almost have to have all that construction risk in my business, what's going on in technology, what's going on in digital. You almost have to be alert of all this but number one, people. And then you have to make sure that you share with them this environment, and are they fit in this environment?
So what does that mean? What do you see your role? Are you putting the fire under your manager's feet to kind of keep them going, or do you micromanage?
I don't think I micromanage, but there's a situation where I do have to go and micromanage, and I think that's we should be able to go down in case we want to. And remember, I came from my mom's kitchen. I used to work in my mom's kitchen, and when we were all 13 kids living in one room, so I know how to do that. So I can pull back and be the chairman of the organization. But if there's need to move in, I can comfortably move in. But I have reasonably good qualified people with me. But I really think that I'm the target creator. I'm the guy who does the monthly performance reviews. I'm the guy who push the limits. I want people to work hard because I think we as human beings, our productivity is still low.
I mean, you spend a lot of time in property because that's where you came from. That was the first company. True. But what excites you the most in all the others that you're doing? So hospitality, retail, e-commerce.
I would say e-commerce excites me a lot because when I look at how the digital world is changing our lives, I come back to my real estate business and I say, maybe this office is null and void. Maybe this is all not required anymore. But also, if you look at the digital guys and you see how fast they work, or the process they use, or the age of people in these offices. Therefore, I really believe that the younger generation are running the world, and they run it extremely well. So much learning in the digital side of the e-commerce. But I think my investment in MEVP, which is a private equity firm that specializes only in digital and technology in the Middle East with almost 80 ventures, that's amazing learning about what's going on in the Middle East as well, and the industry that are about to come.
Do you focus a lot on diversity for your companies? Is that important?
Yes, very important, very important. And I think it's happening naturally. I mean, we don't even have to do it anymore. It's just naturally, that's how.
So do you have metrics?
We have metrics, we have KPIs for that. But as I said, it's so nice that it's really embodied in the organization. It's happening automatically, and I like that.
Do you think it'll increase with time, or are you going to see more female workers?
Well, the female workers are really taking charge. I mean, if you look at the people who run my organization, most of our organization, I would say most of our organization, our food boys have to have more of that. But look at our government. highest percentage of senior people in government anywhere in the world.
Mohammed Alabar, thank you so much for joining us. He is, of course, the chairman and founder of MR Properties.
Thank you so much.
Thank you.
Thanks.
Good morning. Welcome to Bloomberg Markets, the European Open. I'm Anna Edwards, live in London, alongside Matt Miller in Berlin.
Anna, today the markets say, where's our rebound? European futures point lower after the U.S. jobs data pushed the Nasdaq within touching distance of an all-time high. The cash trade is less than an hour away. Here are your top headlines. Big Pharma wants to get even bigger. AstraZeneca approaches Gilead for what would be the largest healthcare deal in history. A joint company would be worth almost $250 billion. No cheaters. Brent's 8-day streak is the longest since February as OPEC Plus seals a deal to extend output cuts, but worries persist that some nations may not toe the line. And payrolls rebound. Unemployment in America declines, but the surprise jobs bounce back doesn't extend to black Americans. Republican Colin Powell turns against Donald Trump for his threat to use troops against the protesters. Let's take a look right now at what's going on in futures. As I said, European futures are not pointing higher right now. We get German industrial output falling more than expected, 17.9% month over month, extending a 16.5% drop. But even before this news, which is just breaking right now on the German economy, we had European futures down, not seeing the same kind of gains that the U.S. market saw after those jobs numbers came out. So not catching up to the U.S. market. That said, European stocks themselves had a fantastic day on Friday and 2 solid weeks. Anna?
Yeah, European equity markets did have that great day on Friday, Matt, with the Spanish market, the Austrian market, both of those up by more than 4%. Just looking for reaction in the euro to that German April industrial output number, and we don't see a great deal of it right now. The euro sort of fluctuating with that number in mind. Let's have a look then at the GMM and see what we can tell about the Asian session that we've been going through. And in the main, Asian equity markets have been pushing higher, so up by 0.7%. In fact, the Hang Seng, which has sort of wobbled into negative territory around half an hour ago, back into positive, only just. But broadly, we do have gains coming through in some of the smaller markets. Also in the Japanese market, up by more than 1% right now on the Nikkei, 1.4% to the upside. So the story for equities in the Asian session has been a positive one. In terms of the FX markets, we had seen some dollar weakness last week, of course. We continue to see a bit of that. The Bloomberg Dollar Index down around 0.1%. Worth noting what we have going on in commodities. We've got iron ore prices in Singapore up by more than 5%. Oil prices rallying with Brent now at 42.80, so up by 1.2%. People talking about whether we'll see Brent at $50 a barrel now, and so the commodity story continues apace. So let's get into the conversation now about what's going on in this Asian session. So Asian stocks seeing modest gains after Friday's US jobs report smashed expectations and bolstered hope of a quick economic rebound. Are we back to talking about that V-shape? Meanwhile, global governments are gradually easing the coronavirus lockdowns to revive growth while controlling the spread of COVID-19. New York and, I know, Belgium, both taking measures to ease the lockdown today. Let's talk now to our MLive currency and rate strategist, Ven Ram, who joins us. Ven, good to speak to you. No doubt you thought a lot about how on earth the estimates of job losses were so off the mark, because in the end what we saw was job gains in the United States. How has that reshaped your thinking about US assets?
Morning, Anna. Well, as you said rightly, I mean, there is some talk about possible miscounting of data in that report, and not one economist foresaw gains, which was a big surprise in itself. But the big picture takeaway from that report can't be mistaken, which is that the economy is holding up much, much better than everyone thought. What does that mean for the markets? It means a weaker dollar. And why would that be so? Because the dollar was being bid as a haven currency all these months through the coronavirus pandemic. Now that the economy is healing, and if we get continuing signs that this is indeed the case, as opposed to just that one-off jobs report, then the dollar will continue to weaken and all the risk currencies will be bid even more. Anna, Matt?
Hey, I'm wondering what you're thinking about oil and its effect on the currencies that you cover.
Good day, Matt. Commodity currencies will do very well in this environment because they've got a double boost that is not only from the OPEC Plus deal, but also from the risk on global sentiment that is boosting all non-dollar currencies in general. That said, the Australian and the New Zealand dollars are already trading near fair value because they've run up quite a lot in the past few weeks. So I expect the European commodity currencies, the Norwegian krona and the Swedish krona, to gain the most from this deal. I wouldn't, in fact, be surprised, Matt, if the Norwegian krone approaches 10 per euro over the next few months, but we are still some distance away. Matt, Anna?
Where do you see the euro heading next, Ven? We have had this German April industrial output number look worse than expected. The euro a slight wobble, but still at 112.83, so not falling by much at all. There does seem to be a theme building amongst the guests we talk to, and we'll speak to a couple today who have very positive views on the euro. What's going to limit the gains that the euro can make here?
I think that the euro is upside past $14.81 and possibly to $1.15 in the coming weeks. And the biggest story here is the curve steepening that we have seen globally and the risk on environment that is making the dollar weaker. Steeper yield curves means higher euro. And that we all know that the euro area economy is not going to do as well as the US economy, but that's already baked in the price. So all said and done, I think that the euro has buoyancy this time around. It's the most interesting the currency has been in a long, long time. Anna, Matt?
Ven, thanks very much for joining us. Ven Ram, there our currency, Bloomberg MLive currency and rate strategist. Worth noting the euro ticked up to 113.84 on Friday. So it's been having a fantastic rally here. And right now we're trading at, as Anna said, about a penny under that 112.83. Coming up, after America's blowout jobs report, investors will Now look for reassurance from Fed Chairman Jerome Powell. We'll discuss this week's rate decision next. This is Bloomberg. Welcome back to Bloomberg Markets. We are 50 minutes away from the European Open and looking at futures that are pointing lower today. Let's get the Bloomberg First Word News. Here are today's top stories from the terminal. OPEC and its allies have agreed to extend production curbs by a month, but skepticism the cartel will be able to ensure full compliance is tempering price gains. That's despite agreeing to the move. There is doubt some in the group will stick to their pledge. Still, the deal is a victory for Saudi Arabia and Russia, deadlocked in a price war just 2 months ago. New York City is lifting its curfew as protests remain mostly peaceful over the weekend. This as the city prepares for life after the coronavirus lockdown. And in a radical move, Minneapolis City Council has pledged to begin the process of dismantling its police force. Members say they'll consult the community on how to replace it. The UK is pressing ahead with a 2-week quarantine on international arrivals. That's despite airlines saying the move will devastate tourism and wreck any chance the travel industry can recover over the summer holidays. British Airways, EasyJet, and Ryanair are threatening to sue over the policy, which comes into effect today. Global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Matt, as we've been discussing, the jobs numbers from the United States on Friday really provided a boost for risk markets. Non-farm payrolls gained 2.5 million in May, trouncing forecasts for another sharp decline. That's put the S&P close to erasing its losses for 2020, so nearly year-to-date positive on the S&P. But the picture in the real economy is anything but rosy when you look at it more broadly. Let's get into the conversation now. We're joined by Kokou Agbublua, Global Head of Flow Strategy and Solutions at Societe Generale. Kokou, great to speak to you as always on the program. So does it make sense to you that the S&P and the dollar are very close to where they started the year? Does it make sense for us to be back at those kind of levels?
Yes, in some ways, because the S&P is not the U.S. economy, and I think this is a very important element. And the dollar has sort of been impacted by a record amount of stimulus and government support that is clearly helping the economy from descending into a series of defaults. And I think the key element here is that, number one, the sectors driving the S&P have been the tech, the healthcare stocks that obviously are going to make a lot of earnings throughout this lockdown, given the massive usage of social media and cloud computing. And now the second wave of the rebound is driven by the beaten up sectors, so the value stocks, the oil stocks, given the rebound in the oil price. And last but not least, I think this is also something to bear in mind, is that this is a self-inflicted economic hibernation that was accompanied by massive amount of support to prevent asset prices from collapsing and the economy ultimately going into a depression.
So it makes sense, Koku, if the U.S. put the economy themselves on hold and now they're juicing it to get it back up to speed. I wonder what the negative effects, though, are of that juice. I mean, do you expect any of the unintended consequences, the problems that we have had with quantitative easing in the past to come again?
Well, I mean, this is a very good question. So in the same way as the governments have looked to flatten the curve of the pandemic and the contagion, similarly, central banks have looked to flatten the curve of defaults, and they've managed to do so pretty well, because this problem will be extended into the next few years. Because one of the things that's quite striking is the amount of high-yield debt issuance year to date, which is over $1.1 trillion, double the amount of last year. So companies are going to be faced weakened balance sheet and a lot more debt than what they had going into the crisis in a recovery that will most likely be lower than what is expected. So today, I think the major concern will be the balance sheet repair that corporates will have to go through, and this could lead to lower capex, lower investments, and that might force government support to be sort of maybe longer than required. And this will bring the question around MMT and how governments finance their deficits, and corporate taxes can also be an unintended consequences, and maybe tech stocks could be the victim of that. And last but not least, the elections, the result of the US election is going to be a major determinant on fiscal policy going forward.
Yeah, you mentioned tech stocks. We see the Nasdaq, of course, doing much better than some of the other US indexes right now. So even if the S&P is just flirting with a flat line for year to date, the Nasdaq's already made it up there, of course. You mentioned balance sheet repair, and you said obviously we've seen high yield issuance in debt markets. We also see a lot of companies coming to market asking for equity investors to put in more money. Anne Richards from Fidelity and the FT over the weekend talking about how there's going to be a limit to the amount that the fund management industry can step in and support these companies. Do you see that as an area of weakness? Will companies be coming to market asking for equity investors to stump up, and they'll be faced with no's from the equity community? Is that something we're going to see?
Well, I mean, there's a price for everything, and I think one of the key elements is the sort of dispersion between strong balance sheet and weak balance sheet companies. And this is a theme that we've been very sort of bullish about, and it has played out pretty well through this crisis. And I think that, clearly strong balance sheet and those who have an ESG sort of mandate or screen well from an ESG perspective, and these are stocks that have seen pretty strong amount of inflows, are the ones that will clearly be able to raise equity and repair the balance sheet. But ultimately, I think that in the same way as we had a releveraging phase before the March 2020 event of debt-funded share buyback, we are likely to see equity-funded debt buyback for companies that will have no choice but to reduce the amount of debt they've taken to survive this crisis. And I do think that they will be able to raise these equities at the right price.
How many? I mean, we've already talked a little bit about bankruptcies, Coco, and you point out the government has done, and the Fed, what it can to try and stave off bankruptcies. We saw a massive blowout in spreads at the beginning of this crisis. Hillary put together a chart for me. I want to pull it up if we can. the spreads have tightened both in terms of high yield and investment grade credit, but they're still much higher than they were. Do you expect bankruptcies to continue? Could we get a second wave? Could we get a cascading bankruptcies later on?
Well, I mean, this is the biggest risk, and I think that the bankruptcy that we could have seen were clearly not there because the Fed is stepping in the high yield market and compressing these spreads, and the government is obviously providing liquidity in terms of working capital financing. But I do think that the biggest risk is what I call the fear factor. In 1933, F.D. Roosevelt said that there's nothing to fear but fear itself when was talking about the Great Depression. And similarly today, if there's fear around social distancing, around the risk appetite of investors and households, the marginal propensity to spend could be lower than expected, and this could drag and slow the recovery. So the amount of bankruptcy that we could see in the next few years on these companies having increased their leverage will be directly connected to the amount of confidence we are able to give to investors and consumers, because otherwise demand will be more subdued, and therefore cash flow for corporates will be more challenged. And ultimately central banks won't be able to prevent companies from defaulting.
All right, Koku, thanks very much. Koku Agbubloa from Societe Generale stays with us. We've got more to talk about with Koku. Coming up, Europe's show of unity wins over investors. Look at the euro powering up to 112, 113. 114 is next. The likes of BlackRock and Eaton Vance heap praise on the cohesion in the region. We'll talk about that next. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are a little under 40 minutes away from the start of cash equity trading, and we are seeing today a little bit of, red arrows on futures. Maybe it'll be some profit taking. We had gains of 2-3% and more across European equity indexes on Friday. The ECB president, Christine Lagarde, appears in front of European lawmakers today, just days after the central bank boosted bond buying by more than the market had expected. Speaking to Bloomberg, Governing Council member Pablo Hernández de Cos said deflationary risks warranted the decision to ramp up stimulus. Kokou Agboola from Societe Generale is still with us. Kokou, are you concerned about deflationary impulses in the European economy?
Well, clearly, I mean, this is something you can clearly see when you look at break-even inflation with five-year in the euro area sort of struggling to recover. And on top, we have negative rates across multiple sovereign issuers. So deflation in an environment of more leverage is sort of a pretty bad recipe for any economy.
A pretty bad recipe. How difficult will it become for the ECB to manage it then, Kokou? We hear from policymakers about using all the tools available to them. Do they have tools to deal with this?
Yes, absolutely. So I think clearly, the bond buying program was, in terms of size, a pretty strong signaling mechanism. And this is something they've managed to do pretty well thus far. Clearly, the risk is the longer we stay at negative interest rates, the worse it is for banks' net interest margin and their ability to lend to the real economy. But what has been pretty strong and effective in this crisis is the fact that central banks and government have joined forces in doing something significant by historical standard. And this is why markets are responding in a positive light. That being said, I think one can clearly point to a quote that says, the biggest risk now is not to take any risk, because if the recovery is not as strong or sustained, then we could get stuck in this liquidity trap and go into what's called the Japanification of Europe, of a long period of low growth or even zero growth with sort of deflation. And this would put a toll on household and corporate balance sheet and force further deleveraging, and you create a negative feedback loop. So I think the central bank has no choice but to act with determination to sort of bring confidence back to markets.
So we know that central banks are going to do whatever it takes right now. We see governments injecting a lot of stimulus, those who have the ability at least right now. Kokou, I guess there are some unknowns. Is there going to be a second wave? How much does the economy recover? But what do you see your clients doing, especially European clients right now, in terms of strategy? Is there an overriding game plan that they're executing right now?
Yes, I mean, I think a lot of clients have reduced their risk and moved into cash and defensive sectors, given the amount of unprecedented volatility in March. And I think Lenin once said that there are years when nothing happens, and there are weeks when decades happen. And clearly this forced a lot of clients to reduce the volatility and the asset allocation. And you had gold as a interesting sector to invest, given the fear of inflation later down the road. So there's also on the fixed income space where you see a lot of curve steepening trades, so bear steepening trade, where the idea is that in 1, 2, 3 years' time, the massive amount of sovereign bond issuance, even the recovery fund is acting as a new sovereign in terms of the issuance it has to do, will lead to steeper curve and higher yield. In the short term, clearly it's under control, but longer term, forward curve bond yield is clearly a strong theme.
Yeah, interesting theme to talk about. Kokou Agboola, thank you so much for joining us. We'll see if we get any comments on that yield curve control from central banks this week. Global Head of Flow Strategy and Solutions from Soc Gen. Coming up, we'll talk about oil. Crude climbs again. The oil rally continues after OPEC makes another move at the weekend. This is Bloomberg. Welcome back to the European Market Open. In terms of the European equity session, we are half an hour away from the start of the trading week and from the equity market session. And we do expect to see a little weakness at the start of trade. The Asian session gained, of course, but we've already gained. We gained on Friday from that jobs report, and so we see a little bit of retrenchment expected in futures. Let's talk about oil, though. Turning to oil, and OPEC Plus have agreed to a 1-month extension to the group's record oil production cuts. It also adopted a stricter approach to ensuring members don't pump more than they pledge, so it's all about compliance. This is a victory for Saudi Arabia and Russia, who put a destructive price war behind them to cajole Iraq, Nigeria and other laggards to fulfill their promises to cut production. And as supply tightens, Saudi Arabia has raised the official price of oil globally by the most in 20 years. We're joined now by Alex Booth, head of market analysis at Kepler. Alex, good morning. So what's the significance of what we heard over the weekend? What's going to have the longest lasting impact? Is it just a month of production cuts, or is it about compliance, or is it what Saudi's doing on price?
Hi, good morning there. Well, it's a good point you mentioned there. I think the announcement over the weekend was certainly fair, I would say, welcomed by the market. I think if we don't see these cuts extended, certainly through into July, then you'll see that length start to build in the market again. And so we certainly needed this extension, basically. I think it's always been an issue with compliance whenever there have been kind of OPEC agreements. And I think it's very interesting that the Saudis and Russia coming on board are now enforcing it, because from what we've seen, there has been a kind of a huge variety in terms of levels of compliance across countries who have essentially signed up to this. Clearly, the Saudis made a very, very big effort through May, considering just how high their exports were in April. They brought them down by over 3 million barrels into May, and they seem to be holding those levels at this point in time. I think it's worth highlighting, though, that we are still seeing that length in the market. We are still building crude inventories onshore. China, yes, it has increased its imports massively. So there was certainly an increase in crude demand through May. But they still built inventories onshore, and we're actually seeing a bit of a reversal of that, where yes, their inventories are building at the same time, and actually to a greater extent that their imports are building. So we really need to see this cut kind of continue. And as the Saudis and the Russians have highlighted, countries such as kind of Nigeria and Iraq to kind of really come into line with this as well.
What kind of rebound are you seeing on the demand side, Alex, as we see economies lifting the lockdowns?
Well, that's a good point. I think that one of the most obvious areas, say, was China. So if you look at their change in imports, their change in crude inventories onshore, that was suggesting about a 1.2 million barrel a day increase in kind of apparent demand, or implied demand, sorry, for China in May. Now, as I say, we have seen that drop back a bit. We've seen that come off kind of looking like about 300 KBD, 0.3 of a million barrels a day over the course of June so far. It's still very early days, though. But then if you look further to the west, we're still seeing this very steep drop-off in crude imports into OECD Europe, so kind of developed world Europe. Their imports are down 1 million barrels a day over the last couple of months. So there's still this very big kind of disconnect. And if you look at what's happening in the product markets, and not just the crude oil, but what's happening in, say, your transportation fuels, we're still seeing inventories being kind of volumes being held offshore, holding at those levels as of a month ago. So any kind of uptick in demand, there's still a lot of product waiting to fill that gap as well. You look at the US, again, the numbers are increasing, but they're still down. Say, gasoline demand in the US is still down around 20% year on year. It has improved a lot, but it is still kind of, it's a tricky balance at the moment.
Alex, if you were when you're looking at state oil companies and looking at $42 a barrel on Brent, some people talking about 50 now, do you see state oil companies being tempted to reopen production and to really seriously start those conversations about not extending production cuts, to go backwards? What's the pressure like as the oil price rises?
Well, I don't think we're there yet. I think that the rhetoric at the moment has been actually they've seen how this is working. This could kind of be the first time that that we've seen this change, in that there is going to be this compliance. Ultimately, we've only been in kind of a cut territory for not yet 6 weeks. So I think it's probably premature, and certainly at these price levels, they'd want to see a kind of stability around here. I think it's a bit premature to think that NOCs will be looking to come back, especially when you have the kind of the threat of what the rhetoric from Saudi and Russia around, okay, you really have to comply. We've done all of the heavy lifting so far in the last over the course of the last month, and I think the repercussions if they don't toe the line are very high.
All right, Alex, thanks so much for joining us. Alex Booth there, head of market analysis at Kepler. Thanks for your analysis on what it is going to be. I think obviously it's a huge story over the past months, but people are focused especially on it today with the extension. Now, the NYSE, New York Stock Exchange, may have reopened its trading floor, but the fate of Europe's last live trading floor, the London Metals Exchange, is still uncertain. The CEO, Matthew Chamberlain, spoke to Bloomberg's Danny Berger. Let's take a listen.
It was Europe's last traditional exchange floor until the coronavirus pandemic swept the globe. The London Metals Exchange, where the world's metal prices are set, has closed its open outcry trading floor and moved to electronic pricing, like its European peers all did in the past. Will the ring, founded in the 19th century, be able to reopen after the pandemic? The LME CEO hopes to keep this final vestige of in-person pricing.
Ultimately, if we did reopen, we'd be asking our staff, we'd be asking our members' staff to go back to the ring environment. And so I think the way that we analyze it right now is clearly we're waiting for the government guidance. We're waiting to see when that step 3 opening up happens. But even if, for example, the country can open up restaurants, you can run restaurants in a socially distanced way. We don't quite see how we can run the ring in a socially distanced way. So it may well be that we, together with our Category 1 members, actually decide that until social distancing can be lifted, maybe when there's a vaccine or maybe when there's a better treatment, that until that time, the most prudent thing would be to keep the ring closed.
Has electronic trading, because of the close down, has it gone smoothly? Is it able to replace the in-person, on the floor, open outcry trading?
So I think in a narrow sense, absolutely, we are confident that our market is still liquid, that our market is still orderly. You know, I talk a lot to end users of the market, and I genuinely haven't heard a single complaint or concern that people can't get their business away, they can't get their hedging done, they can't get their investment done under an electronic pricing model. So in that narrow sense, yeah, we're very confident that electronic pricing is working. But I think the broader discussion is about which venue drives more activity. Because you can have a market that works absolutely fine for getting your core business done, but perhaps it doesn't drive quite the same peripheral business. Perhaps it doesn't attract quite the same opportunities to make markets. So just because electronic is working doesn't mean that electronic is necessarily better. Let's remember that the ring has been working for over 100 years.
And Matt, you sort of hinted about this, talking about the 100 years more that you've had the trading floor. You know, I've talked to traders who sometimes lament about the lost art of the open outcry trading. So on a more of a big picture level, what would it mean to lose Europe's last open outcry trading floor, which right now the LME's ring currently is?
Yeah, I think there is a very significant emotional element to it, and I'm certainly not immune from that. Everybody who works at the LME, we come in, we walk past the floor, and it's a very visible sign of the service that we're providing to global metals. And often, when we have dignitaries who come to London from the metals world or from the broader finance world, they want to come and visit the LME. Because it is such a symbol of that trading activity. So I can't deny that if we ever did lose the floor permanently, which I'm not anticipating, it would be a hugely sad moment from an emotional perspective, because it is just such a great symbol of how metals markets work, and more broadly how the London financial markets work.
Interesting conversation. That was the CEO of the London Metals Exchange, Matthew Chamberlain, talking to our colleague Danny Berger. Up next, we'll talk about what's happening in South Africa. South Africa's central bank has arguably taken a more hands-off approach to stimulus compared to its US and European counterparts. We'll speak to a fund manager who believes there's a role for the fund management industry to step in to fill that void. That conversation coming up next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open right now, about 16 minutes away from the start of cash trading. We do see futures pointing down after the rallies we've had over the past couple of weeks. Here in Europe, the economy really turned to the ECB. America has turned to the Fed, but not everywhere has the central bank firepower to help mitigate the impact of the pandemic. We spoke to the South African Reserve Bank governor last week.
There are unrealistic expectations coming from society which are premised on the basis that the central banks have been so successful, and because they have been successful, we think that we can use central banks to solve all of societal problems.
This more hands-off approach by the SARB leaves space open for private investors to step in. And British South African fund manager 91, which listed in March at the height of the pandemic, has just announced it's raising money for a $600 million fund for just that purpose. We're joined now by the CEO of 91, Enrique Dutoit. Enrique, welcome back to the program. Thanks so much for joining us. What is more important in a country like South Africa? Or what's the most important thing for you to do with this fund?
Good morning, Matt and Anna. You know, the difference between most emerging markets and the developed economies post-COVID pandemic has been the lack or limited fiscal and monetary room or space to move. And clearly the Fed has flooded the entire world with liquidity, so the issue here is not liquidity. It's essentially firepower to support productive capacity and companies through this period of uncertainty before they can raise capital through the normal channels. Now, South Africa has a sophisticated financial market and an institutional savings pool. What we're trying to do is encourage the institutional savings pool to go where the problem is and not to take too long before companies are effectively zombified or productive capacity lost, which then turns the upswing into a weaker upswing than anticipated.
Hendrik, good morning. You mentioned there about the savings pool in South Africa. Is there room for international investors here? So if international investors believe there's a return to be made on the South African recovery story, should they get involved in this fund, or is this just a domestic fund?
All we're saying is it's the domestic asset pools or asset owners have an issue if they do not support the productive capacity. So it's them first. There's no reason why international investors cannot participate or invest in good companies appropriately. One of the problems there has been that the rules for capital raising are very strict, and therefore they've been relaxed after some lobbying and discussion with the exchange only a few days ago, but that the normal capital raising process is slower than you would have seen in the UK or the US. I noticed the Financial Times reported over the weekend that almost 70 billion of new equity has been raised in the crisis in most of the developed markets already, which is small, but still much larger than you've seen in many emerging markets.
What kind of companies are you looking to invest in here, Hendrik? I mean, are there any criteria? For example, is ESG involved?
Matt, what we're seeing is, or what we're trying to do is have an impact and a commercial return at the same time, but obviously address the kind of the pools of money would be interested in ESG type investments. But we have identified good companies we know well, which many of our asset owners actually have stakes in, but which are currently, and there's a lot of hope in this, you've seen it in the equity markets, a lot of hope about V-shaped recovery, about very quick back to normal. We know that is not going to happen. We know that COVID-19 has had permanent impact and that the way out, particularly in the economies which didn't have the ability to stimulate fiscally, will take longer. And it's really that need we want to address, but we don't want to go and put money into losers just to buy very expensive jobs. The economy also has to work, it has to be flexible, and we all understand that. But in the emerging markets, we don't have what you have in the UK and the US, where you essentially have guaranteed workers' incomes and allowed the business sector to restructure. There's no safety net.
There's no safety net, and so perhaps this is more important, what you're doing here, Hendrik, more important in emerging markets than in developed markets because of a lack of other measures in place. Does this look like a model that could be used in other parts of the emerging world?
We think that actually that model is already at play in a place like China, but it's more driven by the state, but through the businesses, where you've clearly seen Xi Jinping declare jobs and productive capacity as number one or as the top priority in the near term. So we think it could work, but where South Africa is quite unique. It has a well-functioning capital market. The pools of money are there, and you don't have to wait until the businesses are distressed. In America, the combination of distressed investment, but government underwriting or government financing for people out of work is a different model. And we think, therefore, many markets, not just emerging markets, could think about this.
Interesting conversation. Hendrik, thanks very much for bringing us the story. Hendrik du Toit, the CEO of 91. Thank you very much for joining us this Monday morning. Coming up on the programme, we're going to talk about mega pharma M&A. It might be the biggest pharma deal in history if it were to go ahead. AstraZeneca said to be eyeing a merger with rival in the US, Gilead. We discuss that next. This is Bloomberg. Welcome back. The European market open. 8 minutes until that European market open. It looks as if we'll get some weakness at the start of the trading day as the gloss wears off the job story in the US a little bit from an investor perspective. Now, two drug makers behind the industry's most prominent responses to the COVID-19 pandemic are looking into the possibility of a combined future. British pharmaceutical group AstraZeneca is said to be interested in a merger with the American rival Gilead. Sources tell Bloomberg informal contact has been made in what would be the biggest healthcare deal in history. Some big ones have been proposed, of course. Joining us now, Bloomberg's executive editor for global deals, Aaron Kirchfield. Aaron, very good to speak to you. So what can you tell us about this approach? How serious was it?
So I think the approach was a informal approach. It was kind of the floating of an idea. But the reality is any deal of this size, even if you're just proposing it without terms, is going to be something you would have had to think at least quite sincerely about before even breaching the topic with your counterpart. But yes, it's early days. As you said, it would be the biggest healthcare deal of all time, transformative for both companies. So it will be very fascinating to see what comes next.
What would the strategic rationale be, Aaron, for this deal if they decide to move ahead?
So I think if you look back just in the last 2 decades or so, all the mega pharma caps have been created through mega mergers, and it's all about getting scale and having the resources for R&D. As you know, it costs a lot of money to develop and then get new drugs on the market, and it's all about pipeline. And while the focus, at the moment is obviously COVID, treatments, vaccines, et cetera, longer term, all drug companies will continue to battle with the idea idea of how do we have a robust pipeline so that we have promising drugs to come for the years ahead. And I think by combining the two, Gilead has a track record of quite innovative therapies, including for HIV. So there could be, some nice, additions to Astra's pipeline if there were to be a deal.
Aaron, this is a question that no doubt nobody knows the answer to right now, but would we expect to see, obviously this would be scrutinized by regulators in the US and possibly even blocked. I mean, it's a very sensitive issue, isn't it? One country's drug company buying another country's drug company, as we saw when Pfizer tried to buy Astra.
You're absolutely right. I mean, we've seen a trend even over the last few months about increased protectionism to protect strategic industries, and there's no doubt drug makers fall into that category. However, I think you could argue, this is purely theoretical, both Astra and Gilead are working on treatments or vaccines for COVID. And if you've seen, the U.S. is supporting both of those ventures. I think they offered to invest something like 1.5 in the work that Astra is doing with Oxford University for a vaccine. They're also obviously been pushing the Gilead treatment. So I think you could argue there is a close relationship between the UK and the US, and there's cooperation on the COVID front.
All right, Aaron, thanks so much for joining us there. Aaron Kirschfield, our executive editor for Global Deals. This is Bloomberg.
A minute to go until the start of the first trading day of the cash equity markets for this week. Good morning, everybody. Let's get to your headlines. Big Pharma wants to get even bigger. AstraZeneca approaches Gilead for what would be the largest healthcare deal in history. A joint company would be worth almost $250 billion. No cheaters. Brent's 8-day streak is the longest since February as OPEC Plus seals a deal to extend output cuts, but worries persist that some nations may not toe the line. And payrolls rebound. Unemployment in America declines, but the surprise jobs bounce back doesn't extend to black Americans. Republican Colin Powell turns against Donald Trump for his threat to use troops against protesters. Matt, futures for Europe point lower.
Yeah, they're pointing lower. I mean, we've had such an amazing rally here over the past 2 weeks that it's, in a sense, to be expected. You know, the DAX is up 1,700 points over the last 2 weeks, so futures pointing lower. We won't see the DAX open for a little while. We're going to see the FTSE open first, down 0.2%. You should see the IBEX open right now as well. There's the Euro Stoxx benchmark down about 0.2%. But you will see the DAX open eventually, and it will be off almost 1% if futures are any guide here. You see the AEX down 1%. You see the CAC 40 down 0.75%. You see the IBEX down 0.8%. So there in the left-hand column of your global macro movers, you can see all of the equity indexes in Europe opening in the red. In terms of sovereign bonds, they're on the far right-hand side of your screen. You see a little bit of a mix there. So investors are buying German long debt, Dutch long debt, gilts right now, but they're selling Italian front-end debt at the 2-year. They're selling the Swiss 2-year as well. European markets, though, in terms of equities, are opening lower. After Friday's U.S. jobs report smashed expectations, putting the dollar on course for an 8th straight day of declines, we saw equity indexes all around the world up big. Joining us now is Peter Kinsella, Union Bancaire Privé Global Head of FX Strategy. And Peter, although you're focused on currencies, I'll just quickly start with the open and what we've seen in the equity index. This incredible rally that we've seen, it's not surprising, is it, to see stocks down this morning?
No, it wouldn't be surprising at all. I mean, we've had this for, ongoing rally since April or thereabouts. So it doesn't surprise me in the slightest that we see a little bit of a pushback or even just a slight taking profit at this stage. So, yeah, I mean, broadly speaking, given the jobs data we've had, it was good. But I think just given the sheer length of the equity up move we've had, a little bit of a down move on today isn't to be unexpected at this point.
Good morning to you, Peter. More broadly then, when you look at the rally in risk assets we've seen since the lows in March, do you see that continuing? And is that why you see no reason to hold the dollar at this point?
I can see it continuing for a while. I don't think it's going to go in a straight line, obviously. We've had a huge up move. We could plateau for a little while, but I've been more constructive on risky assets than not, just given the policy background that you have. You've got central banks across the world giving monetary stimulus. You've obviously got a fiscal stimulus, which will come once lockdowns end. So there are good reasons to be constructive on risky assets, though I do note that some of them are trading at very, very expensive P&Ls. And the corollary of that is that what we tend to see in the FX space during global economic recoveries is that the dollar does tend to weaken. And certainly what we've seen in terms of price action from the dollar, from equities, is very, very consistent with what we've seen in previous sort of global economic recoveries. So I'm of the view that broadly the dollar will continue to weaken. The Fed printing literally an unlimited quantity of QE. Looks to me like they're going to move towards a type of yield curve control. And broadly speaking, that's very, very supportive for global assets, for risky assets, and it's bad news for the dollar, I'm afraid.
Yeah, so I mean, on the one hand, Peter, you're saying because of the economic recovery, investors no longer feel the need for a safe haven. The dollar has proven to be a safe haven asset during the crisis. On the other hand, you're saying it's also because the Fed is just got the printing presses rolling on full speed right now, and that typically will devalue a currency. Is that a concern for you also in terms of inflation? Do you see that? Do you see that on the horizon?
So Inflation is something we haven't had to worry about for a very long time. And, there's a number of reasons for that, which are very well known. Most of the inflation or disinflation that we've seen has mainly been a supply side phenomenon. It hasn't been because of a lack of aggregate demand or anything like that. So consequently, I'm kind of the view that, cost side inflation shouldn't be something we have to worry about. Frankly speaking, even calculating inflation is going to be very difficult. Consumption baskets have changed massively from last year to this year just as a result of COVID. So I think that most central banks are likely to simply ignore inflation for the next year or so. Over the longer term, we might actually start to see a modest increase in inflation. Just if you look at the sheer increase in US M2, so broad money growth, it is very, very punchy, and that could lead to a modest uptick in inflation. The real question is whether or not central banks will care about that. My view is that they won't. They'll much prefer to see higher inflation than lower inflation. So it's not really bad news for risky assets at this stage in the cycle.
It's really interesting, that conversation on inflation and what central banks are really for at this point then, Peter. I mean, how would you describe the mandate of, say, the Fed at this point? Clearly, we know what the mandate says it's supposed to do around price stability and jobs. But do you see them having a real role in keeping borrowing costs low so that all of the costs associated with bailing out the US economy from the pandemic can be paid for? What is the role of the Fed here?
I think, listen, for me, the role of central banks around the world has shifted or morphed from, explicit or overt inflation targeting towards implicit and subtle debt management. And that's really what the Fed's doing. It's what the ECB is doing in a much more explicit manner. They're trying to keep the front end of the yield curve at very, very low levels. And in doing so, they're encouraging, governments to borrow. How many times before COVID-19 did you hear Christine Lagarde coming out and pleading with the rest of Europe to start borrowing money and keep spending it? The implicit point that she was making was that, look, you guys keep the show. I'll keep rates very low. You guys keep the show on the road, and that's basically what they're doing. So we're now in an era of central banks basically being glorified debt management agencies. That's my view on it.
All right, Peter, you're going to stick with us. We got more to come from Peter Kinsella, Union Bancaire Privé, Global Head of FX Strategy, stays with us. Coming up, we'll talk about America's jobs blowout report and what investors face or look forward to after that. Reassurance from Fed Chairman Jerome Powell is what they'd like. For sure, we'll discuss this week's rate decision next. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. Right now, we are 10 minutes into the session. We do see red arrows here, 1% loss for the DAX. The FTSE down about 0.7% or 46 points. Let's get the Bloomberg Business Flash for you. Today's top corporate stories from the Bloomberg terminal. Potentially the biggest pharma deal ever. Sources tell Bloomberg AstraZeneca has approached Gilead about a potential merger. The idea is in a very early stage, and there haven't been any formal talks or terms for the deal. And we're also told Gilead isn't currently interested in a big merger. A spokesman for AstraZeneca says the company doesn't comment on rumors or speculation. The UK is preparing to tighten its takeover laws. That's according to The Times. It reports the government will introduce new legislation to force companies to report attempted takeovers that could pose security risks. The plan comes as Prime Minister Boris Johnson looks for ways to reduce the nation's reliance on Chinese companies, in particular Huawei. And British Airways is raising the stakes in talks over job cuts. The union says the airline is threatening to fire all of its pilots and then hire them back on individual contracts. That's unless an agreement can be reached on new employment terms. The BALPA union says the move seriously undermines the talks. And that is your Bloomberg Business Flash. Anna?
Matt, European equity markets then under pressure today, down by 0.75%. US futures, interestingly, are fairly flat right now. Now, let's talk about Friday's jobs number, which provided another boost for risk markets. We saw that on Friday. Non-farm payrolls gained 2.5 million in May, trouncing forecasts for another sharp decline. That's put the S&P close to erasing its losses for 2020. But the picture in the real economy is perhaps not quite so rosy. Peter Kinsella, the Union Bancaire Privée global head of FX strategy, is still with us. We talked a little bit about the US economy already, Peter, but just pick it, or the US market, picking up on that a little. What you saw in the non-farm payrolls on Friday, do you think that's changed your view or the market's view in general about the shape of the recovery, the peak of the joblessness, and how quickly things get back to quote unquote normal in the US?
Yeah, I mean, look, we hear a lot of talk about the shape of the recovery will be V-shaped, U-shaped, L-shaped, and so on. And I think a lot of that is very nuanced and not, frankly, all that helpful. If we simply look at what's happened in China and look at what the shape or style of their recovery has been, the manufacturing sector has gotten back to work pretty quickly, and they're probably back at 90%-ish of pre-COVID levels. And the services sector is back, but albeit with a much larger lag. And of course, that makes sense. As long as social distancing policies are implemented, restaurants, theatres, and so on, they're going to have a much slower sort of return to normality than the manufacturing sector. So I would anticipate that we'll see something similar in the US, in Europe, and indeed around much of the world. Manufacturing getting back to sort of pre-COVID levels very quickly, but then thereafter sort of services sector taking much more time. And so really anything which involves, heavy social interaction, restaurant business, bars, and theaters and things like that, that's going to be coming back with much more of a lag. So it's kind of like a two-speed recovery, I think, for two sectors of the economy. In that sense, really, then, the L-shape, U-shape, or V-shape, whatever you might call it, it doesn't really matter the shape. It's rather the style of the recovery that we see, and I think that's really what we're likely to see in the US, in the Eurozone, and indeed elsewhere.
Do you think we're going to see a better picture, Peter, in the Eurozone? I mean, after all, we've got all of these Kurzarbeit or, furlough schemes in countries around Europe to keep people employed during the downturn. Are they just going to get fired after, or are we going to see a much lower unemployment rate in Europe compared to what we see in the US?
I don't think they're going to, if you look at the Kurzarbeit and certainly the short-term working sort of directives we've seen and furlough schemes, the intention of those schemes is merely just to keep income coming in the door for people. And then once we see, economic recovery kind of, come back, then we see people sort of working again. If you look at the sort of 2008, 2009 recession, unemployment in the UK didn't sort of, go through the roof the way that many people thought it would have done. And I think this time will be quite similar, actually, because quite simply, sort of, companies understand it's hard to get skilled workers. They want to hold on to them, and they don't want to lose them for short cyclical downturns. And so in that context, I think the furlough scheme that the UK government has done has been a very good one, a very good idea, and a similar story elsewhere in the rest of Europe. So, in Europe, they should, if they're lucky, they should just about avoid, very, very serious long-term unemployment. That might not necessarily be the case with our friends in the States, where, it could be likely if we've got a slower recovery, we could see very, very high levels of long-term unemployment be sustained for quite some time.
And where does that leave the euro, in particular against the dollar? We've had a number of guests turn more positive on the euro, or certainly putting it high up there on their top picks of late. Peter, would you do the same?
So I've been rather bearish in the dollar, for a number of months. And the reason I've been bearish on the dollar really is just, it's a function of what the Fed was doing, keeping the yield curve at very flat levels, engaging in various quantitative easing programs, and then, of course, engaging in swap programs, which reduce dollar demand around the world. So, my view in euro dollar has been that it would rise, but mainly as a function of dollar weakness, not really as a function of euro appreciation. Now, what we've seen since Merkel and Macron announced their plan to have mutualized debt for COVID-19 outlays, you've seen the trade-weighted euro has actually appreciated, which has been pretty interesting. And indeed, that trade-weighted appreciation continued for most of last week and indeed on Friday as well. So for the euro, I think what the ECB announced, and what Merkel and Macron has announced, has definitely reduced the tail risk of sort of a sovereign debt crisis in the eurozone. And indeed, I thought what the ECB said last Thursday, where it basically said that they would extend their PEP program, but also sort of to buy any asset class for any duration. And really what they're saying there is that, if necessary, they'll do whatever it takes to keep this show on the road. To my mind, that basically says that, you've seen a bit of short covering in the euro. I think a lot of that's kind of probably done by this stage, but a modest grind higher in euro dollar from current levels over the remainder of the year is definitely doable, in my opinion.
Can I just quickly ask about gold? I mean, you have a forecast for $2,100 an ounce, which is a big jump from here. Is that just due to dollar weakness, or do you see gold rising in euro terms and other currencies as well? I mean, is this as basically all central banks around the world are just pumping out money?
Right. I think there's a couple of things, really. One of the reasons I'm quite bullish on gold, and I've been bullish on gold for over a year now, was that I saw coincidental easing by various central banks. With the Fed, we saw the ECB in September last year, the RBA, the RBNZ, Reserve Bank of India, et cetera, et cetera. And banks all over the world were easing policy. And in that context, where you have this sort of global competitive devaluations, gold is the only asset which is going to hold its value. Moreover, I think the fact that we've seen an increasing use of negative deposit rates basically means that gold storage costs are now cheaper than negative deposit rates. So in a sense, that's going to attract consumers who've never looked at gold before and indeed will go forward. Every day, sort of every conversation I have with people these days, they all want to know about gold. Should they be buying? Should they be increasing, etc. So it just tells you that there is a strong underlying demand for gold. And I think if you look at it over the longer term, the pace of sort of M2 growth in the States, is consistent with a large up move in gold. I think fair value in gold, if we look at longer term sort of relationships with US M2, that indicates that fair value is in and around $2,100, $2,200. There is a tail risk, of course, and the tail risk would be if we see central banks moving towards so-called helicopter money policies. Then gold is sort of $2,500, $3,000 per ounce is definitely doable. So there are a number of factors behind my call on gold. The dollar would be one of them, but it's probably the least of them, if I'm frank. There are other very, very strong reasons to hold gold.
All right, fascinating stuff, Peter. Great to get you on today with those calls and that insight. Peter Kinsella, Union Bancaire Privé Global Head of FX Strategy. He's going to be continuing the conversation with us on Bloomberg Radio today. That's at 9 a.m. UK time. So if you're in the UK, just tune in on London DAB Digital Radio. Anywhere else in the world, apparently radioplayer.co.uk works, but you can also just Google Bloomberg Radio. Coming up, fighting on all fronts, British Airways threatens to fire all of its pilots in a standoff with unions as it considers suing the UK government over quarantine rules. We'll bring you the latest. This is Bloomberg.
Welcome back to the European market open. 23 minutes into a trading day that looks negative, down 0.7% for the Stoxx 600. Let's get to some movers. Shell in the oil space, biggest gainer on the Stoxx 600 by points after the OPEC deal that we learned about over the weekend, extending things for a month and trying to deal with under-compliance. AstraZeneca in the drug sector falling after Bloomberg had carried that story, our scoop, saying that AstraZeneca has contacted Gilead about a deal, a very informal approach, so very early stages there. And IAG in the aviation industry gaining after rejecting the UK's quarantine. Of course, that quarantine due to come into place today. The UK is pressing ahead with that 2-week quarantine on international arrivals. Let's get more details on this story. The move has come under fire from British Airways and other airlines. They say it will devastate tourism in the country. Along with threatening to sue the government over the policy, BA, part of IAG, has raised the stakes in talks with unions over a controversial 12,000 job cut proposal. Joining us now on the phone is our European Airlines reporter, Siddharth Philip. And Sid, bring us up to date with this then. So over the weekend, we learned that BA, so angered by the quarantine rules, are threatening to sue the government, and they don't seem to be alone on this. What's the stance being taken by these airlines at the moment?
Sure. So BA, along with EasyJet, Ryanair, and other travel companies in the UK are considering suing the government over the policy, saying that it was ineffective at curtailing coronavirus while also destroying thousands of jobs. And they said, I mean, the fear among airlines and other travel companies is that while immediately it may not have much of an effect, given that most airlines are restarting their flights middle of the month or early next month, there's still a worry that this might put off people from booking travel for later in the summer, which is pretty crucial for airlines.
Yeah, I mean, I definitely wouldn't want to fly to London if I knew I was going to have to quarantine for 2 weeks. I might go through Dublin, as I hear that's a loophole. Sid, is that a possibility? If I just book my flight through Dublin, can I avoid the quarantine?
Apparently, according to the airline, that's a loophole that anyone can exploit. That if you go through Dublin, then you won't have to do a quarantine. We're still not clear on the details, given the fact that you'd obviously have travel history from somewhere else.
And Sid, what about the relationship between BA and its pilots right now? They've been trying to renegotiate a deal, such as the circumstances they find themselves in, and now they're threatening to fire and then rehire all of their pilots. What's the legal background there?
Sure. So BA has been in talks with its pilots union, PALPA, for the last couple of days. And they've now issued a fresh notice to the union saying that they would dismiss all its pilots and rehire them on individual contracts unless they can reach an agreement with the union on new employment terms. And BA has essentially asked for a further 125 pilot jobs to be cut, in addition to the 1,130 pilot jobs that were already being discussed with the union.
All right,
Siddharth, thank you very much. Siddharth Philip, thanks for joining us. Bloomberg's European Airlines reporter. Up next on the programme, we'll get back to the Brexit conversation. Brexit negotiators call for backup. The EU's Michel Barnier says the talks needed extra political momentum. So the pressure's on for Boris Johnson and Ursula von der Leyen when they meet. That meeting coming next week. We'll discuss next with Ali Renison at the Institute of Directors. We'll talk about Brexit. It's a while since we talked Brexit. We thought we should do that. This is Bloomberg. Welcome back. This is the European Market Open, and we're half an hour into that market open for European equity markets. The Stock 600 down by 0.8%. We see the DAX coming under particular pressure, down by around 1% right now. The CAC down around 0.9%. If you look at what's going on from a sector perspective, we've got oil and gas stocks actually making some decent gains, with Brent crude up at 42.90, so up by 1.4%. We saw an extension of those production cuts by OPEC over the weekend, and some more moves to tighten up on compliance by OPEC and friends. So oil and gas stocks up by 1.2%. To the downside, we've got healthcare stocks and technology. So a sort of mixed bag from a sector perspective. Matt?
Let's get you Bloomberg First Word News right now. Today's top stories from the Bloomberg terminal. New York City is lifting its curfew as protests remain mostly peaceful over the weekend. This as the city prepares for life after the coronavirus lockdown. And in a radical move, Minneapolis, the city council there has pledged to begin the process of dismantling its police force. Members say they'll consult the community on how to replace it. Colin Powell has become the latest notable Republican to express concern about President Donald Trump. He says he'll now be voting for Joe Biden in November instead. The former Secretary of State says the president's threat to use active duty troops against protests shows he's drifted away from the Constitution. New Zealand is ending social distancing after eliminating COVID-19. It paves the way to resume normal life in one of the few countries to have successfully eliminated the pathogen completely. Strict border controls will remain in place to keep the virus out. Global coronavirus cases have now topped 7 million, with over 400,000 deaths. Global news, 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. Anna?
Let's talk about Brexit and the future of the trade relationship across the Channel. British and EU negotiators are calling in their leaders to break the deadlock over the trade deal. The fourth round of talks ended on Friday with little progress being made. The EU's chief negotiator, Michel Barnier, accused Britain of backtracking on promises previously made and said the talks needed extra political momentum. That puts pressure on Boris Johnson, the British Prime Minister, and Ursula von der Leyen from the Commission to reboot the process when they hold talks next week. We're joined now by Ali Renison, head of EU and trade policy at the Institute of Directors. Ali, good morning to you. So there seem to be three major sticking points around fisheries, around the role of the ECJ, and around standards. Do you see any quick progress being made on any of those? And do you see one as a key stumbling block, or do we just carry on tackling all three from here?
I think it depends on what soon means. Obviously, we have the summit at the end of the month. That's been seen as very much by some as a do-or-die summit because of the requirement to notify at that point whether either side wants to extend transition, and we know the UK government definitely doesn't want to. I think all eyes are on that summit for hints of progress that we perhaps haven't seen until now. You see some people saying effectively ignore some of the press conferences, and it all hinges on what happens both in June and I think also in July, because we have to remember to situate this in the context of everything else that's going on from the EU side, and to what extent this ending up being a distraction works in the favor of making sure that we have a smooth transition, exit from transition, or does people wanting to focus on their own priorities mean that we have a disruptive end because people can't be bothered to focus on this anymore? That's the concern that we have, is making sure that trade is still, protecting trade is still high up on both sides' agenda.
What if we have a no deal, fall back on WTO rules? How bad will that be for business? You know, we talked to Tim Martin sometimes from JD Weatherspoon, and he doesn't seem concerned about that, even if his biggest seller is Lavazza Espresso and Coffees.
Yeah, I mean, we have to take it with some context. I think Tim Martin certainly has a very fixed set of views leading his position-making. I mean, in terms of the wider business community, and we sort of talk to thousands, tens of thousands of businesses at a time, I think the biggest concern that unites everyone is making sure that this is done properly. You know, you can adjust, and business is very resilient, but they can't do it if we end up in a situation that we had last year, which is in the run-up to no deal, the potential first no deal in March. businesses were only getting information about what the tariff schedule was going to be, what the plans for the Irish land border were going to be 2 weeks before that point in time. And that's what we want to avoid. So I think it's making sure that both sides realize that whatever the outcome, that you need to have a smooth adjustment. And that's what we get in standard trade agreements regardless.
Alice, that's interesting about the period of adjustment that will be given here. I wonder, when you talk to members, Ali, and you hear from them, how much time do they spend thinking about Brexit, given what we've seen from COVID and the impact on the economy, the huge unknowns surrounding the economy still very present here in the UK? I remember on the 31st of January covering the UK leaving the European Union and saying even then, this is starting to get pushed off the front pages by COVID, and that's certainly gained momentum ever since. How much time do you think businesses are really spending thinking about Brexit trade relationships across the channel?
Well, interestingly, I think it's actually, in the wider sense, commensurate with the news coverage. You know, I think that actually we've started to see some more proactive interest from our members. I think that's because it has been more in the media of late, quite frankly, and it's reminding people of things they need to do. But you have to remember that there is a little bit of confusion over what it is that businesses are supposed to be doing at the moment. Because on the one hand, we've been told that transition is not going to be extended, but we don't really have any kind of narrative from either side saying this is what you need to prepare for or prepare full stop. So we know that it won't be the same kind of no deal as we would have had last year. We do have a withdrawal agreement to fall back on, but it's no less disruptive from the perspective of whether it's tariffs or planning. You know, if you talk to businesses in the agri-food space right now, they have no idea, because things are so changing on a day-to-day basis with their suppliers because of COVID, what position they're going to be in at the end of the year. And I think that reinforces the message that regardless of where we get to, just make sure that you deliver a commitment that people will have some sufficient time to adjust once those changes are clear. Because at the moment, what we have to prepare for as a business community isn't 100% clear whatsoever.
Yeah, certainly a big issue in Northern Ireland, the agri-food business that you talk about there. Ali Renison, thank you very much, Head of EU and Trade Policy at the Institute of Directors. Coming up, Matt, we'll be back to the pharmaceutical story, the biggest pharma deal in history, if it goes ahead, of course, if it gains any traction. AstraZeneca is said to be eyeing a merger with rival Gilead. We'll discuss that next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. We are looking, well, now at a little bit of a mixed picture, but still, for the most part, red arrows across Europe after the amazing rally we've seen. The DAX losing 85 points this Monday, the FTSE down about 18. Two drug makers are behind the industry's most prominent responses to the COVID-19 pandemic, and they're looking at the possibility of combining in the future. British pharmaceutical group AstraZeneca is said to be interested in getting together with American rival Gilead. Sources tell us informal contact has been made in what would be the biggest healthcare deal in history. Joining us now is Eric Leberrigo, managing partner and equity research analyst for pharmaceuticals at Bryan Garnier & Co. Eric, what do you think about, well, first of all, let me dispel with the word merger just drives me insane because, of course, it's always one company buying the other. There's always a target and an acquirer. There isn't this sort of Daimler-Chrysler merger of equals pipe dream that PR firms would like us to believe. Is this AstraZeneca trying to buy Gilead?
Well, it's very difficult to say, but you're right probably in starting by talking about the right words, because I read link up as well as merger, and I think link up is probably closer to the truth than merger. If a merger was at stake, then probably AZ being 1.5 bigger than Gilead would be driving it, but I think it's worth talking about some kind of deal between the two, not necessarily a merger. They're too different to think about a merger, I guess.
Yeah, good morning. Let me ask you a little more about that. I mean, if this were to be one company, outright buying another, then maybe there'd be some regulatory scrutiny given the sort of moves towards more protectionist policy that we've seen in various parts of the world in light of the COVID-19 pandemic, and trying to buy a drugs company would probably jump right to the top of the list in terms of considerations there for any Western government. Do you see regulatory scrutiny, and would that be a reason to keep any partnership kind of light?
Not necessarily. Actually, if you look at what AZ and Gilead are today, Gilead is deriving 3/4 of its sales from HIV treatments, which is very specific. They're by far the leader in the world in HIV. This makes Gilead a real cash machine, but this is very far from what AZ is doing. And usually when you think combining two companies, you're thinking about getting synergy. And it's far from obvious to see where the synergies might come from, because AZ is about oncology, respiratory, cardiometabolism, not at all virology and HIV. So it's like merging two very different animals. So I don't see why FTC or the kind of regulations would look at this merger with bad eyes. I don't see any issue there. Even on the COVID front, they're working both on COVID treatment or vaccines, but I mean, there are dozens of companies that are doing that. So even combining those approaches in COVID won't make them really a threat for the others.
Sure, and even if they went ahead with this, it would be, these things take time, right, Eric? And speaking of, I wonder, after a longer term period, when you look back at these mega mergers, at these $100 billion deals, how many are successful in hindsight?
Well, there have been very different times for those mega mergers. At the very beginning of the 2000s, the rationale for that was just to get bigger in an environment where really size did matter. It's not necessarily still the case today, and the few of the remaining mergers that are still consumed, like the Celgene BMS, are done with some kind of defensive angle, because clearly BMS was looking into Opdivo as a single drug becoming probably too big. So they want to diversify to acquire a little bit of hematology into Celgene. So it's becoming very rare to get any strong rationale to go for this kind of mega merger. And talking with most of the management people from large cap pharma, very few of them think it's a solution.
Eric, thanks very much. Thanks for joining us. Eric Berrigaud, Managing Partner and Equity Research Analyst for Pharmaceuticals at Bryan Garnier & Co. Now, Friday's US jobs data showed black unemployment climbing to the highest level since 1984. This comes amid an increasing call to examine the socioeconomic inequality in the US. Bloomberg discussed the prevalence of racial inequality with the former Xerox CEO, Ursula Burns. She's been on the program before. We've spoken to her, got her insights before. She's the only black woman to ever lead a Fortune 500 company on a long-term basis.
Just top of my worry list, top of a concern list. But I entered this discussion and this debate during the coronavirus, at the start of the coronavirus, optimistic, interestingly enough. Optimistic about maybe coming out of this disruption time in a better position than we entered. And that meaning that people, companies in particular, paid attention to what we now call these essential workers. We start to understand what an essential worker really is, the guy who delivers food for us, the guys who stock the shelves, the guys who push the patients around, etc. I'm hoping that, knowing that a lot of the black and brown people in the United States work at the lower end of the socioeconomic employment ladder, I'm hoping that we can use this time, total disruption, pandemic, racial unrest, continued socioeconomic imbalance, to reset the whole conversation about how black and brown people are fit into the employment ladder, but also how companies view these quote unquote essential workers and how important they are, how we have to pay them, how we have to nurture them, and how we have to move them up the ladders.
We've seen.
I'm hoping it's an opportunity, but I don't know if it will be.
I'm glad you're optimistic. I hope that we can come out of the conversation still optimistic. How optimistic are you about some of the statements that are being made by corporations? I'm interested in particular because do you think they feel authentic across the board as it stands?
I think that many companies, many more than I've ever seen before. So the vast majority that are speaking now, many more than I've seen before, are starting to feel uneasy about the state of America in this space. They are starting to realize that this is fundamentally unsustainable. It's definitely unfair and wrong. And that the tilt is starting to come off. We're starting to go out of balance. And it's really important that the rhetoric in the administration, which is generally negative and definitely demeaning, that has to be offset by some action, real action, funding groups, changing employment practices, being affirmative in how they actually address their employment needs, being affirmative in hiring black and brown people, being affirmative in progressing them through the companies, being affirmative about how they look at the C-suite and look at the board level. Without that passion and that drive, I think that we're going to not make progress. And I think that companies are now starting to realize more and more that not making progress is not sustainable. So they're going to have to do something. And the good news is it's kind of like it all came together at once. This is not enough to make change, but at least if we get enough crescendo of voices, maybe we can keep the action going. This is not the first time that a black man has been killed by a policeman. It's not the first time. It happened before. It happened before that. And I'm hoping this time we just don't let this sacrifice of this human go unrequited, unpaid back, right? It's important that companies start to stand up and say, we have something to do with this. We have something to do with the solutions.
So Ursula, what makes this seem different to you, that the outcome of this is going to be different and more positive than maybe what it was in the past?
So I think that the number of the broad-based coalition that's now starting to speak, please don't get my little optimism as overjoyed optimism. Don't get me wrong. I do not believe that what I'm hearing today is going to actually drive change. We're going to have to be involved and stay involved. All of the voices in the street, all of the voices in the news media, all of the voices in corporate America are going to have to stay involved to actually see true change. The only reason why I'm a little bit more optimistic is that people are getting fed up with the current state of play.
That was the former Xerox CEO, Ursula Burns, speaking to our colleagues in the United States. Up next, how will fewer exchanges impact liquidity? We're back to a markets conversation. We'll put into context the losses we're seeing in European equity markets this morning. We do see US futures fairly flat as well, so we'll ask what lies ahead for the week. We'll talk to Christine Aquino, who leads our Markets Live team in Europe. This is Bloomberg.
Welcome back to the European Open. Right now, almost an hour into the session. Equity index is a little bit mixed, but mostly down this morning on a Monday to kick off the week. Joining us now is Christine Aquino, who leads our MLive team here in Europe. And Christine, what do you think of this slight sell-off that we're seeing? Is it just profit-taking after a decent rally?
Yeah, sounds a lot like that, Matt. I mean, it's been a hot couple of weeks for equities, and so no rally really goes in one straight line. We all know this, and so it makes a lot of sense for investors to kind of take stock of what's been going on in markets and looking for the next big catalyst. There are some standouts in the markets, though. More broadly, the euro in particular has been having a good run of late, and the ECB meeting last week only served to juice that rally. So I'd be interested in seeing where that particular rally goes from here, because lots of interesting catalysts there.
Christine, what do we make of the moves in bond markets at the moment, the steepening that we've seen, people talking now about yield curve control, whether the Fed is going to have to start talking about that later on this week?
Yeah, it's really piqued the interest of a lot of market observers, Anna, just because, the prospect of the Fed doing yield curve control was previously unthinkable. It was something that was very experimental even for the Bank of Japan, but now investors are more willing to consider the idea. I would say that the steepening that we've been seeing in yield curves in the U.S. and in general does seem like a bit of a return to normal functioning in bond markets, where you see the longer end steepening, perhaps in response a little bit to what we've seen from the central banks and governments in terms of monetary and fiscal stimulus. And in normal quote unquote times, that would be a perfectly reasonable reaction for the long end to steepen on the back of inflation expectations. Of course, we're not living in normal times by any means, and so it is worth questioning what is driving that long end steepening beyond the usual inflation-driven factors.
All right, Christine, thanks very much for joining us. Christine Aquino there. She leads our MLive team here in Europe. Speaking of right now, Anna, we are seeing equity indexes that are lagging for the most part. We do see a little bit of a mixed trade here with the FTSE MIB and the IBEX 35 just barely treading water. But the DAX is down a little over 100 points right now, and the FTSE is down about 25. It comes, however, after some really decent gains over the last few weeks and months. In some places, as you were saying earlier, for example, the S&P 500 in New York is almost back to unchanged for the year.
Yeah, absolutely. So year to date, unchanged almost for the S&P 500 and for the dollar. The Nasdaq, of course, has already gone through that because to a large degree, the FANGs have benefited from some of the more structural changes perhaps we've seen around the pandemic. European equity markets then under pressure. US futures also wobbling around the flat line right now, so not going anywhere in a hurry. This is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Big Pharma wants to get even bigger. AstraZeneca approaches Gilead for what would be the largest healthcare deal in history. Thousands march around the world against police brutality. New York City curfew ends early after a peaceful night. The Minneapolis City Council takes a step towards abolishing its police force. And payrolls rebound. Unemployment in America declines, but the surprise jobs bounce back doesn't extend to Black Americans. Well, welcome to Bloomberg Surveillance, everyone. I'm Francine Lacqua here in London. A lot going on in the markets, a lot of focus, of course, this week on the protest, not only in the United States, but also in London. A lot of the focus is on that OPEC Plus agreement. So let's get straight to your markets and have a look at what they're doing right now on this Monday morning. European stocks down some 0.7%. A lot of the focus is and will be on this potential deal when it comes to, of course, Gilead and the Big Pharma. This is what I'm also looking at. Crude oil, $40 a barrel. Oil actually extending some of their rise. European stocks are dropping as investors mull how much further to take the global rally in risk assets after we had that better than expected unemployment figure in the U.S. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. New York City is lifting its curfew as protests remained mostly peaceful over the weekend. This as the city prepares for life after the coronavirus lockdown. And in a radical move, Minneapolis City Council has pledged to begin the process of dismantling its police force. Members say they'll consult the community on how to replace it. New Zealand is ending social distancing after eliminating COVID-19. It paves the way to resuming normal life in one of the few countries to have successfully eliminated the pathogen. Strict border controls will remain in place to keep the virus out. Global coronavirus cases have topped 7 million with over 400,000 deaths. The UK is pressing ahead with a 2-week quarantine on international arrivals. That's despite airlines saying the move will devastate tourism and wreck any chance the travel industry can recover over the summer holidays. British Airways, EasyJet and Ryanair are threatening to sue over the policy, which comes into effect today. OPEC and its allies have agreed to extend production curbs by a month, but skepticism the cartel will be able to ensure full compliance is tempering price gains. Despite agreeing to the move, there is doubt some in the group will stick to their pledge. Still, the deal is a victory for Saudi Arabia and Russia, deadlocked in a price war just 2 months ago. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine.
Ritika, thank you so much. Now, 2 drug makers behind the industry's most prominent responses to the COVID-19 pandemic are looking into the possibility of a combined future. The British pharmaceutical group AstraZeneca is said to be interested in a merger with Gilead. Well, joining us now for more on this is Sam Fazeli, head of Bloomberg Intelligence here in Europe and an expert on pharmaceuticals. Sam, good morning to you. When you look at the possibility of combination, first of all, does that make sense?
Good morning, Francine. So, like the recent deals we've had where Bristol Myers bought Celgene and AbbVie went after Allergan, this is a surprise to everybody. But when you step back from that point, and you look at the potential opportunities that a combined company would have, you could come up with an assessment that it does make sense, yes.
Is there a risk that more people want Gilead? First of all, do we have any indication, Sam, that actually Gilead is ready to sell? And are we going to see some kind of bidding war? How valuable is Gilead right now?
Well, honestly, I don't think anyone had viewed Gilead as a target. I think everyone was viewing Gilead as a buyer. So this is part of that surprise. And I don't think anybody expected AstraZeneca to want to do a deal this kind of size. So I don't know if there will be counter bids for Gilead. It isn't a growth story in any way, at least from what consensus is expecting. So it's not really anyone who wants to come from a position of weakness to buy growth. This is like the opposite. It's from a position of strength to buy longer-term stability and potential to invest in R&D if Astra were to do this.
Do we have any indication that this will actually go ahead? I don't know if there are regulatory concerns or it's just a matter of money.
I don't think there are many regulatory issues here. That's one of the other points, is that there is really no real overlap between their businesses. So unless governments and politics get in the way, which again, I can't see why that would be the case, this won't be a deal about synergies, about cutting costs and all that. It's about having, in my view, more firepower for doing more R&D. You might cut a little bit of overlap, but not much. So aside from that, I don't really see what the risks would be. And is Gilead really interested? I mean, who knows? But the report comes from a pretty good bunch of Bloomberg news reporters who I'm assuming have got some very good sources in there.
Sam, thank you so much. Sam Fazeli there from Bloomberg Intelligence. Now, coming up after America's blowout jobs report, investors are now looking for reassurance from Fed Chair Jay Powell. We discuss this week's rate decision next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. The UK is preparing to tighten its takeover laws. That's according to The Times. It reports the government will introduce new legislation to force companies to report attempted takeovers that could pose security risks. The plan comes as Prime Minister Boris Johnson looks for ways to reduce the nation's reliance on Chinese companies, in particular Huawei. British Airways is raising the stakes in talks over job cuts. The union says the airline is threatening to fire all its pilots and hire them back on individual contracts. That's unless an agreement can be reached on new employment terms. The union says the move seriously undermines the talks. Airbnb is joining other vacation rental sites and seeing a surge in summer demand. CEO Brian Chesky says it's clear people want to get away after months stuck at home. International holidays are being replaced by last-minute domestic getaways. Given the unexpected rebound, Airbnb isn't ruling out an IPO this year. And that's your Bloomberg Business Flash. Francine?
Thank you so much, Ritika. Now let's focus on the U.S. stock rally. The S&P has now seen its fastest 50-day advance in 90 years, coming within a whisker of erasing its losses for 2020. The Nasdaq, meanwhile, has already done that, hitting a record high last week. But while the picture in the real economy is anything but rosy, Friday's jobs numbers provided another boost for risk markets. Non-farm payrolls gained 2.5 million in May, trouncing forecasts for another sharp decline. Well, joining us now this morning is Patrick Armstrong. He's Chief Investment Officer at Plurimi. Well, Patrick, we want to talk about the U.S. economy in just a second and what we can expect from the Fed. But first, I'd love to get your thoughts on this big pharma with AstraZeneca eyeing Gilead. Are we going to see a lot more M&A in this space?
Well, interest rates are so low, it does make sense to see consolidation. So when companies can borrow for nothing, if they find any attractive candidates where you can even get marginal returns on capital employed, it does start to make sense. So if you remember a few years back, Pfizer looked at AstraZeneca for tax purposes as well. So that may be playing into it as well, where AstraZeneca may be getting a better tax deals on purchasing Gilead. So I do think it's a function of where interest rates are, and basically asset prices are still somewhat lower than they were in the past too, so you are getting more attractive purchase prices as well.
But so Patrick, would that be across corporates, or are we going to see just in general a lot more M&A activity, or is it specifically for the health sector?
I think it's probably across corporates. There's some companies now that are distressed, and you can pick up very cheaply if you do have a better balance sheet. You've seen this year and year-to-date performance, the companies that have the strongest balance sheets have been the strongest performers, and the companies with the lowest debt ratings have been the weakest performers. So there would be opportunities for strong companies to purchase companies that have been close to failing right now. So I think it won't just be within the healthcare sector. I think it makes a lot of sense for strong companies to be looking to pick up assets quite cheaply still.
Patrick, overall, so there were a lot of questions last week that actually stocks were just, very different to what we were seeing in the real economy, because the real economy was doing pretty badly and stocks went up. Then we had those U.S. jobs numbers and a lot of questions on whether it was, stocks that were right in looking at better fundamentals. Which way is it?
It's a bit of both. I characterize the rally as a liquidity-driven rally. If you look at M2, it's up 18% year over year, and that's never happened ever before. If you look at central bank balance sheets, if you look at interest rate policies, there's masses, trillions of liquidity, and that has to find a home. So people are deploying it in credit, people are looking to equities, and you keep moving further and further up the risk spectrum, and that's driven equities. But it's also the payrolls number was shocking to me. It did. To be honest, I actually had to do a double take for a few seconds to make sure it wasn't missing a negative sign for 2.5 million job losses. And most of it's coming from the temporary redundancies. Basically, companies made people temporarily unemployed and started to rehire them in May, which is an encouraging sign. I think the first few million will be the easy bits, getting rid of the 20 million unemployed that remain. That'll be a bit harder. So the economy is definitely lagging the stock market, and for me, liquidity is the primary driver of that.
So Patrick, meaning that what you're expecting a correction, or you think markets can hold on to these levels?
I don't expect a significant correction. There's bound to be a pullback at some point, but with the Fed doing what they're doing, it's very difficult to find alternatives to equities. So we've kept our equity exposure pretty much flat. Last week I looked hard saying, where can we take profits? Where can we reallocate to? And it's very difficult to find alternatives that are better than equity. So we loved credit in March, but credit spreads have really narrowed markedly as well. You can't put your money in cash. Central banks' policies are designed to punish you if you just stay in cash. So I don't think there's a lot of upside in equities anymore, but I think the central bank policies really diminish that significant downside as well.
So where do you see upside?
It's getting a little bit harder to find where it is. So we still like the quality companies that have lagged over the last month. They're really outperforming year to date, and I think in an economy that's not going to fully recover, we're going to be in a 90% economy where things just don't get as good as they were last year, but they're on a trajectory where they're improving incrementally month on month. But we don't get to the full capacity of economic growth where we got to, because there will be some structural unemployment from this. The temporary workers getting back into jobs, that'll happen, but there are some longer-term jobs that aren't going to be basically created. And for me, I prefer companies with strong balance sheets. I prefer dominant market positions, and I think the cyclical companies that are really rallying the last 4 weeks, as we've seen PMIs improve and as we've seen the reopening of the economy, I think that's where there may be some downside. So I still don't like the auto companies, the cruise lines, travel and leisure. They're really rallying over the last 3 weeks, but I think long term they have a lot of headwinds in front of them.
Patrick, a lot of the focus will, of course, be on what Jay Powell says on Wednesday with that Fed decision. How much more can the Fed do at this point in the economic cycle?
I think it's going to be mostly about signaling about what they will do, what their triggers to change things will be, and they've outlined that pretty clearly, that rates are going to stay at zero even until we get the economy back to full employment, until there's signs of inflation. So I think the Fed will continue to signal we'll let the economy run hot, and that'll provoke risk-taking. That's part of what they're trying to do right now, is make sure people don't just sit idle on capital, and they want that deployed into the economy and into the markets. And it's not going to be real new policy that we're going to get from Powell on Wednesday, but it'll be signaling this is the triggers before we stop letting the economy run hot. And I think that's a long way off, and that'll be a way to provoke the actions he wants.
Where do you see the dollar going? We have a Bloomberg dollar spot index today just dipping a touch, 0.2% lower.
I don't think there's going to be much relative movement in currencies right now. That you've seen a real depreciation in the dollar over the last month as basically risk assets have rallied. The dollar really got a bid in the first quarter of the year as markets sold off and the safe haven status of the dollar. And because I don't think we have a strong leg up in equities right now and a strong leg up in risk-taking, I think it's going to be muted moves. All central banks are doing roughly the same thing right now, where the fiscal response in Europe, the ECB response basically was a little bit slower, and now they've caught up. And it's going to be, I think, fairly muted currency moves right now because all regions are playing the same playbook.
Patrick, thank you so much. Patrick Armstrong there from Plurimi Wealth stays with us. And actually coming up next, we'll talk about Europe. Coming up, Lagarde and the lawmakers, as the president of the ECB speaks today, we'll discuss if the central bank has done enough to resuscitate the region's economy. That's coming up next, and this is Bloomberg.
There has to be justice. There has to be protest. We have to be heard. We have to move forward strategically. We have to move forward smart. We have to move forward tedious, and we have to be together, man. How we doing it?
Talk about how sports is for everybody. We talk about how, sports is where you bring people together. It's everybody's, it's an inclusive thing. But when we talk about our own personal battles outside of sports, there's a lot of people that are silent on issues, and they're important issues. They're issues that have been going on for hundreds of years, and we need that same type of team mentality to be brought to issues outside of our sport.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's talk about Europe. And ECB President Christine Lagarde appears in front of European lawmakers today, just days after the central bank boosted bond buying by more than the market expected. Well, speaking to Bloomberg, Governing Council member Pablo Hernandez de Cos said deflationary risks warranted the decision to ramp up stimulus. Well, still with us, Patrick Armstrong from Plurimi Wealth. Patrick, when you look at some of the things that actually we're looking for in Europe, so we had some pretty discouraging figures out of Germany. How does the European economy stack up with the U.S.?
I think the European economy is obviously struggling more than the U.S. It's a function of the industries in Europe, whereas tech and communication sectors that the U.S. have in the equity market have really been unimpaired. And the banking sector and industrials in Europe have been hit hard just because they're more at risk given the policies on social distancing. I think we're probably now seeing a bottoming of the German economy. You've seen the ECB come in with their PEP expansion. You've seen fiscal stimulus being approved now across the Eurozone. So I think Europe was a little slow in putting these measures in compared to the United States, but they're in place now, and probably we're seeing a bottoming happening. Don't expect a remarkably sharp recovery, but I think we are on the path to recovery now where the policies are in place to promote some growth.
What happens, Patrick, if the ECB wobbles? I mean, a lot of this recovery is so dependent on the bond buying programs from the European Central Bank. What happens if there's a legal challenge or if something doesn't exactly 100% go to plan?
Yeah, so Lagarde mentioned they're pretty much undeterred by the German Constitutional Court ruling, and the legal challenges may be there, but it doesn't seem to be stopping the ECB. I think Lagarde's quickly learned about, she said she didn't target spreads early in her tenure, and last week she was talking about reallocations to the capital key where needed, and she's become, I think, quite savvy. The ECB, I think, is going to fill its role. It's going to continue to buy bonds. If there is a court ruling against it, I'm sure they'll find ways around it and continue to buy the bonds. It's definitely much needed that you've got a deflationary backdrop in all of Europe, and they do have to take measures to promote the economy and try to basically stem off that deflationary risk. So I think Lagarde is very savvy. The policies are in place, and just adding up all the programs in place now, we think they're probably going to get the balance sheet up to over $7 trillion over the next couple of years, which will be about 60% of GDP. So the path they're on right now is very stimulative, and I expect that path to continue for a number of years.
So, Patrick, when you look at Europe, where do you see value? Do you see any value in Italian bonds? Do you see any value, I don't know if it's the euro currency or even something like the Swiss franc, which is a haven?
I prefer Swiss franc in Europe of the currencies. We've bought UBS equity. Basically, it's got a dividend yield of a little over 3% in Swiss franc. We like that as a way to get some exposure to Swiss franc. The euro as a whole has basically weaker growth than most of the developed world, and that'll continue. It's got policies on central bank that's at the same level as most of the rest of the world now, and structurally it's probably undervalued, but I think that's probably for good reason, that just given the weak growth prospects of Europe, it's hard to see a sharp rally in the euro right now. So I'd prefer Swiss franc on a currency basis within Europe.
Patrick, what do you do with Brexit? So there's a feeling when you look at a lot of the discussions that Brexit negotiations may not lead to a deal. What does that mean for UK assets?
It is amazing how that was front and center as the main risk for the UK, and what's happened with the pandemic. It is not quite forgotten, but it's definitely second-tier news right now. And it does look like the UK is taking a stance where it isn't averse to a no deal and not putting in the extension of it. It's a headwind, but I think once you get past the no deal, there will be minor deals. So no all-encompassing deals, but they'll come to deals on different industries and making things function just out of necessity for both regions. So it's something that's a headwind. I'm surprised sterling has really rallied this month going into this, because there doesn't seem any signs of progress on it. But it's interesting at a minimum. I'm surprised sterling is rallying, given all this news of no progress on the Brexit deal.
All right, Patrick, thank you so much. Patrick Armstrong there, Chief Investment Officer at Plurimi Wealth. Now, coming up, we also speak to the WPP founder and S4 Capital Chair, Martin Sorrell. That's coming up next. We'll talk about diversity. We'll, of course, talk about advertising. And we'll talk about what the economy will do in the next couple of weeks, looking at advertising spending, which is usually a good barometer to understand what sectors are going well and those that aren't. In the meantime, German industrial production taking a record hit in April. That is before a gradual easing of lockdown restrictions probably set off an ever so slow recovery. Output in Germany slumping some 17.9% during the month. The markets on the down with the European stocks 600 down some 0.5%. Crude oil in New York 39.88 after OPEC Plus found an agreement to cut production further. This is Bloomberg.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market, averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
The U.S. and Japan duke it out over exchange.
China's slumping onshore bond market is great.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacquet here in London. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Thanks, Francine. New Zealand is ending social distancing after eliminating COVID-19. It paves the way to resuming a normal life in one of the few countries to have successfully eliminated that pathogen. Strict border controls will remain in place to keep the virus out. Global coronavirus cases have topped 7 million with over 400,000 deaths. President Donald Trump is pulling around 9,500 troops out of Germany. And in another sign of disconnect between Washington and Berlin, Chancellor Angela Merkel was caught off guard. It cuts American forces in Germany by around a quarter. The president has criticized the Merkel government for not meeting its defense spending targets. Colin Powell has become the latest notable Republican to express concern about President Donald Trump. He says he'll now be voting for Joe Biden in November instead. The former Secretary of State says the president's threat to use active duty troops against protests shows he's drifted away from the Constitution. And the UK is finalising plans to ease its lockdown. That's as public support for Prime Minister Boris Johnson's response to the outbreak is dropping. 3 polls this weekend showed the gap narrowing between the Conservatives and Labour. Tomorrow, the Prime Minister plans to brief cabinet ministers on the next stage of easing restrictions. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine?
Ritika, thank you so much. Now, how will the coronavirus reshape the advertising industry? Well, S4 Capital, which holds its AGM today, says April's revenue and profit growth was hit by the crisis. The digital advertising firm also says it remains confident that it will deliver double-digit gains in like-for-like revenue for the year overall. Well, joining us this morning is Martin Sorrell. He's the chairman of S4 Capital. Martin, thank you so much for giving Bloomberg a bit of your time. When you look at the advertising space, and when you look at the U.S. economy and what we saw in terms of that jobs number on Friday, how quickly can advertisers recover from the slump?
Well, digital advertising has remained quite strong, Francine. You saw that in the first 4 months of this year, we're up in terms of gross profit, gross margin by 15% like for like and 17% pro forma, and our reported numbers up 82%. That reflected the mergers that we made last year. The answer to your question is, I think digital advertising will be quite robust. Obviously, traditional advertising will come under heavy pressure. You see that from the ad holding groups who are forecasting that their revenues in Q2 would be down by 15 to 20%. Analysts are looking for 20 to 25%. I think a couple of the groups have said 15 to 20, and maybe for the year by about 10 to 15%. So traditional advertising, tremendous pressure. It varies by vertical. If you look at the tech industry, by and large, it's about 53% of our revenues. By and large, that bucket of clients has remained quite resilient. Some shift from Q2 into half two, some postponement, but by and large, very resilient. If you look at healthcare, resilient too. Online gaming and home entertainment, strong. Other areas such as CPG and autos, very mixed. CPG, Procter & Gamble had a record Q1, or it's later into their fiscal, but Q1 calendar. Unilever a little bit more varied because of its food businesses. And then autos were hit quite heavily, and travel and leisure, obviously, are more L-shaped and probably will take at least a couple of years. Even the industry pundits and those who depend for their living on travel and leisure are quite reticent about the speed of the recovery, despite the job numbers that we saw in the US. No rocket ships, in our view, as the president said, but certainly he's right in the sense that there will be some V-shaped categories that we're at pains to find out and follow. So I think digital advertising probably by 2022 will be about 57.5% of the market. And by 24, according to Michael Nathanson, one of the best analysts, probably around 2/3.
And it's great that you're breaking it out in industry by industry, but does it make a difference if you're a European-based company or if a US-based company or an Asian one?
Well, I think we saw the waves, Francine, with coronavirus. Obviously, coronavirus hit China and Asia-Pacific first. It then spread through Western Europe and into the Americas, and of course is still virulent, highly virulent in parts of Latin America. Similarly, the recovery came much more V-shaped in China, but that's with an autocratic regime and a highly disciplined regime, if I can put it like that. Testing and tracking was extremely strong, but we've seen that flow through Asia into Western Europe and again into the Americas as a wave in terms of recovery. But geographically, I think we will see similar patterns, although there will be V's and U's as well. Some countries will recover faster, depending on their regimes and the alacrity with which the regimes embrace lockdowns and tracking and testing, and indeed going further in that, therapies and vaccines. But that's a longer-term project. So I think the pattern will be quite similar. And the trick, if I can put it that way, is to find the V's, both in terms of category and in terms of geography. And we're in 30 countries already. We have 2,550 people. And we're not being frightened to expand by merger, as we call it, not by acquisition.
I was going to ask you.
Every deal that we do. Yes, go ahead.
Well, I was going to ask you, has the pandemic actually created opportunities for S4 Capital to buy anything?
Well, last week, of course, we added a data and analytics company in Latin America. We will shortly add a very similar one in Asia Pacific, and then a platform-based company also in Asia Pacific very shortly too. But these are small because we don't want to prejudice our balance sheet. Our liquidity has been very strong, better than any of the scenarios we planned as we went into our lockdowns, when we were very concerned about the impact or the potential impact across industries and our clients of liquidity constraints. But actually, it's turned out to be quite good. We haven't benefited. We haven't taken any government money. Some companies obviously have taken government money, paid cash bonuses, and in fact, with very low tax rates in the jurisdictions that they borrowed money from. And I think that will cause a significant amount of controversy around those companies in the future. Some of them in our own industry are not close from here, where I'm sitting and you're sitting now. So I think that those are controversial moves, but we've stayed away from that. And of course, we've been focused not only on coronavirus, but also on the recent events in America, where we're making very significant moves in the context of our company, which is small within the industry as yet. I describe us as a peanut. We're probably now more a coconut or a coco de mer, as we put it, or the biggest coconut of its kind. But certainly, we're looking at that with very great interest and keen to make changes.
Martin Searle, we're going to take a short break, and then I really want to ask you about diversity in the advertising space. He's Martin Searle from S4 Capital, and he stays with us. Coming up, companies across the world have voiced their support in the fight against racism, but is the advertising industry doing enough to improve diversity and inclusion? We continue our conversation with Sir Martin Searle next. This is Bloomberg.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil. The Bloomberg Commodity Index.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, my guest this morning says in the wake of the global protests against racism, his company is actively developing diversity and inclusion training programs. Now, it's also setting specific targets for its people across the firm. But is the advertising industry doing enough to improve diversity? Well, still with us, Martin Searle from S4 Capital. Martin, first of all, why has the industry been so bad at diversity?
Well, I don't think it's fair to single out our industry in particular. And of course, we bridge not only the advertising and marketing industry, but the tech industry. In fact, analysts looking at our company probably tag us as being more in the tech industry. And the tech industry itself has a lot to do. So I think unfair to label us as the slower part of the industry. We all have to take responsibility for this. And I do think it's different. You won't remember this, Francine, but I can remember coming out of business school in 1968, which was a year similar in some respects to what we're seeing now. But I think this is different. What we're seeing now is the demonstrations, as President Obama said, much more broadly based. The constituents and the velocity of these demonstrations are extremely strong. And as I say, I think different to 50 years ago. And I think we will get real change out of this. And if you look at our own company, on Friday we instituted a matching fund for our US people. The United States is well over half of our operations, based basically in New York, LA, San Francisco, and Mountain View, although we do have outposts in Seattle and elsewhere. And we started a matching fund. We put in $250,000. Now, that's small in the context of what other companies can do. But as I said, we're small in our industry. It would be equivalent to the ad holding companies putting together a fund of about $5 to $10 million, which I would suggest that they should do in fairly rapid response. So that's one area. The second area is we have a group of people, many groups of people actually in our company now looking carefully at what we should do on racial bias training, on racism itself, and on education and onboarding programs to ensure we do it. And what we're also going to do is start a fellowship program. Not dissimilar to what I did at WPP, although I think that's now been abandoned, which I think is sad at this particular point in time in our industry. But we're going to institute a fellowship program for minority graduates and non-graduates. So to give those who haven't gone to universities and higher education places a chance too. And that's received an extremely strong response from our people. We'll start small, but we'll build, particularly at a time when our industry is cutting its headcount, according to Forrester, about 50,000 people globally in the ad holding companies, and about 50,000 in U.S. agencies alone.
To make sure that this is not just happy talk, to make sure that this is not just empty words, how will you measure it? Do you have metrics? Do you, will people in their reviews have to explain what they've done?
Yeah, just as we've done with gender equality. And unfortunately, I think one of the problems has been we've focused on gender diversity or equality first. So just as we've done in terms of specific targets for numbers, you might call them quotas, we'll have specific targets for diversity of all kinds, bearing in mind proportions of population represented by those ethnic, racial groups. Secondly, we'll have education, and these targets will be built into not just qualitative assessments, but quantitative assessments too. So our people who, on average, on the media side of our business, our mighty hivers, our media people, are about 550 of them. Our content people, what we call monks, are about 2,000. Their average age is 32. The average age of the mighty hivers is about 25. So we have a younger workforce, much more probably committed than other parts of the workforce to getting this done. So this is front and center. We're in 30 countries, a lot in Latin America, a lot in Asia Pacific, some in future it will be even greater in Africa and the Middle East. But what we're seeing is a groundswell of support for measures along these lines. Firstly, funding. Secondly, education and training and target setting. And thirdly, these sort of fellowship or apprenticeship programs, which will be sorely lacking given the state of the industry and the holding companies, for example, reducing their headcount so drastically.
Will you hire more ethnically diverse people that will work for you, Martin? And does that just make business sense? We hear about clients asking before they, once you pitch, before giving you business, that they want to see who will work on their campaigns.
Yes, that has increasingly become the norm. I wouldn't say it's the norm across everywhere, but that has certainly been a feature of presentations and pitches and RFPs, that's requests for proposals, we've seen over the past few years. And that's becoming more and more important in clients' thinking. It's one of the way the clients improve the quality of their supply chain. And they're making sure that their supply chain responds to the objectives, the social objectives that they're building.
Sir Martin, thank you so much for joining us. Martin Sorrell, their chairman of S4 Capital.
Thank you, Francine. Good to see you again. Thank you very much indeed.
Same. Coming up, the George Floyd protests that started in the U.S. have gone global. Protesters in the U.K. topple a statue commemorating a slave trader. Up next, we discuss all of this with Kathleen Burke from University College London. This is Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, another weekend of protests across the world saw some of the largest crowds yet as thousands demonstrated in relative peace. In the U.S., Minneapolis City Council has pledged that it will start taking steps towards dismantling the city's police department. In Britain, thousands of people were demonstrating in cities across the country this weekend. Protesters in Bristol tore down a statue commemorating slave trader Edward Colston and threw it into the harbor. Well, it's believed that Colston trafficked around 80,000 men, women, and children from Africa to the Americas in the 17th century. Joining us now on the phone is Kathleen Burke, Professor Emerita of Modern and Contemporary History at University College London. Professor Burke, thank you for joining us. Will this lead to real change and equal opportunity?
Well, if you're talking about the United States, I think so. It's quite an amazing protest movement, not only because there's much less police violence than have been normal in the 60s, for example, but because it's so multicultural. It's not we whites against you blacks so much. It's we're all in this together. And that's probably what gives people hope that this will actually be a transformational change.
How do we know whether it is transformational change? I mean, it's very difficult to measure. Do we need targets? Who's in charge of, figuring out in 12 months whether we're doing better in terms of ethnic minority representation across the world?
Well, we'll only know by the results in 12 months, of course. I mean, the United States is different in that it's 50 different systems in many respects. Not all states are responding the same, and for the reasons that you know as well as I do. In more united, well, not united, in more centrally governed states, countries such as the UK, there can be a national response because the nature of top-down power. In the United States, at this point, what we're seeing, although one doesn't know for how long, is bottom-up power. And that is bottom-up power that seems almost to be on its way to some success. Again, unlike earlier riots in the United States history.
Kathleen Burke, when you look at the U.S., how will it change the politics come the general election in November?
Well, again, that's going to depend. November is a long way away. I think probably it's going to be the responses of people to Trump or to Biden. Trump is moving, as we all know, in a divisive way to mobilize those whom he believes support him. Biden is Trump is trying to build and indeed extend his coalition, which he's going to have to win. Biden is also trying to build a coalition. But his response, his approach is reconciliation, to bring people together. What we're going to have to see is, do Americans prefer neighborliness to confrontation? I myself, and I'm no better at predicting anyone else, historians can be pretty bad at predicting, is that more Americans do prefer getting along with their neighbors than confrontation, neighborhood to neighborhood. People get hurt that way. They don't get hurt by being neighborly.
Professor, how do the protests actually in the last couple of weeks compare to what we saw in 1968?
Well, 1968, there were several, of course. There were anti-war riots. And what we saw in the Democratic National Convention in a park nearby where there were protesters just sitting around, as it were, there was a police riot. In the race riots, of course, both in 1967, which you may remember had a long, hot summer, which saw 159 riots, and then the ones with Martin Luther King, the response to his assassination in April 1968. And there's a real difference, because what really sparked those, not sparked, but encouraged them, was television. People could see the police response. People could see what was happening, and riots leapt from D.C. and Detroit and New York to cities all over the country. What's different about this, as much as anything, besides the multicultural and besides the television, is social media. Because someone uploaded a video of what actually went on, and because of the nature of Twitter and Facebook, that was a driver that we haven't seen before. In fact, you can mobilize people in a different way, and people who feel the same way can get in touch with each other. There's no national leader. There's probably not even state leaders, probably not local leaders. There's a coming together of people who have seen what's happening, telling each other what's happening, and deciding to do something about it. One problem over here in the last weekend, of course, has been violence at the tail end of indeed large political demonstrations. In the United States, there seems to be, after the initial outbreak of violence for the first couple of days, people determining that it's going to be peaceful. So I suppose, that they'll get more done that way because they can incorporate political leaders, but also because you'll notice that in the ones now, they did tend to go after wealthier areas, not burn up their own neighborhoods. So the riots, however you want to call them, this year in the U.S. are rather different from any that have gone before.
Thank you so much, Kathleen Burke, there, Professor Emerita of Modern and Contemporary History at University College London. European stocks are actually dropping. The dollar is weakening. If you look at the markets across the board, U.S. equity futures are also fluctuating. So investors, after that blowout number in terms of U.S. jobs on Friday, are now reassessing and trying to figure out how long the rally will continue. Bloomberg surveillance continues in the next hour. Tom Keene joins me out of New York. We'll be talking to Hugh Van Steenis of UBS later. This is Bloomberg.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Big Pharma wants to get even bigger. AstraZeneca approaches Gilead for what would be the largest healthcare deal in history. Thousands march around the world against police brutality. New York's city curfew ends early after a peaceful night. The Minneapolis City Council takes a step towards abolishing its police force. And payrolls rebound, unemployment in America declines, but the surprise jobs bounce back doesn't extend to Black Americans. This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, it's another big week looking at inequalities around the world, looking at the protests around the world. We had a really amazing turnout, actually, when it comes to London, but also in Bristol. And then you look at central banks. So Christine Lagarde is in front of the European Parliament today. And then, of course, the Fed is Wednesday.
Look at the Fed on Wednesday, and that'll be interesting, Francine, certainly with the market recovery, which continues this morning. On the political front, all eyes are on the White House, and I don't mean about the fence wrapped around the White House up to the top of Lafayette Park. But Francine, it is a nation that awaits the next step from the president. He was out tweeting it in the vicinity of 12 midnight on General Powell. We'll talk about that a lot today, but I'll tell you, it was an eventful weekend, and it continues right into this Monday.
Thank you, Tom. We'll have a lot more on that, and now we'll get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom, the U.S. city hit the hardest by coronavirus starts to reopen today. In this initial phase, New York City will allow construction, agriculture, manufacturing and wholesale trade to start operating again. Retail stores can offer curbside and in-store pickup. If all goes well, New York could expand the reopening in 2 weeks. More than 17,000 people in the city died from the coronavirus. An aggressive proposal from the Minneapolis City Council. A majority of its members say they support disbanding the city's police department. That comes just as the state launched a civil rights investigation following the death of George Floyd. One city council member says she wants to, quote, end policing as we know it. Saudi Arabia raised oil prices the most in at least 2 decades. That came a day after the OPEC Plus coalition extended its historic output cuts. The biggest Saudi price hike will hit July exports to Asia. Overall, the increases for Saudi crude erase almost all of the discounts the kingdom made during its 1-month price war with Russia. In Japan, the economy shrank less than expected in the first quarter. GDP fell at an annualized rate of 2.2%, but there's a catch. The result was based on a survey that probably overstated the strength of Japanese business investment during the pandemic. First quarter figures may be revised downward later. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Thanks, Ritika. Greatly appreciate that. Equities, bonds, currencies, commodities, and the data is simply a continuation of what we saw on Friday. Not the big surge of Friday, but we'll take it. Let me go to the yield market first with curve steepening. And very clearly, I want to state we're on the 1% watch on the 10-year yield, 0.92%. We're a bit away from that, but we'll take it 1.71% on a 30-year bond. That's correlated to equities, which are risk on, to say the least, up 18 on futures. Dow futures up 185. The VIX doesn't play, 24.84. I would note, Francine, that one of the great worries out there has been Brazil, and the Brazilian real has been strong over the last 2 weeks.
Yeah, Tom, we need to spend a bit more time on Brazil today. Overall, I'm looking at oil actually advancing. Brent crude rising almost to $43 a barrel after this historic output curbs were actually extended. Iron ore jumping after Brazilian mines suspended operations after COVID-19 infections surged. That's another reason to have a look a bit more at Brazil. But in general, European stocks are dropping, the dollar's weakening, and your futures, Tom, are fluctuating a little bit as investors try to figure out how much further to take the global rally in risk assets. We'll have plenty more on your markets, but now what could be the biggest healthcare deal in history. British pharmaceutical group AstraZeneca is said to have contacted rival Gilead about a merger. The two drug makers have been behind the industry's most prominent responses to COVID-19 pandemic. Joining us now, Sam Fazeli. He's Bloomberg Intelligence senior pharmaceutical analyst. Sam, first of all, how much of a surprise was this? I know you were telling me earlier that everybody always thought that Gilead would be the acquirer.
Absolutely, Francine. So it's a surprise from both sides, frankly. I don't think anyone expected AstraZeneca to be looking for a large M&A deal like this, and not just large, the largest, potentially. And certainly Gilead
Gilead was viewed as an acquirer. So, but this is not, it's not surprising that it's a surprise. Every other deal we've had recently in terms of Bristol Myers and Celgene, that was a surprise, and certainly AbbVie and Allergan was also a surprise. So,
what's the likelihood, Sam, that this will go ahead? I don't know if there are regulatory concerns or whether, we'll hear from the boards whether this will turn into, something of an M&A war.
Well, so M&A war, at this sort of size, there aren't that many others out there who can do this. Certainly, it's possible that somebody else with a more flexible balance sheet, such as Pfizer, for example, could step in and offer something in terms of equity and cash. But we need a deal first. So we need an announcement of a deal first so that others can kind of gauge around the parameters of that. But when it comes to it, in terms of how likely it is, I think you've got to realize that there's reasonable overlap on the shareholder list already, if you look at the very top shareholders. Both companies' CEOs know each other. So it's not, and there's no real obvious FTC issues. So if we're going to go down the political path, maybe there's some questions there. And I don't expect this to be a major job-cutting exercise either. So maybe not many hurdles to jump.
Sam Fazili, you've been doing this for decades. As you know, there's always within these mergers, these combinations, a why. What's the why here? What's the so what? Why do they have to affect this transaction?
Yeah, so sometimes the answer is because they can. But let's put that aside, Tom. I think if you think about it from an AstraZeneca perspective, it doesn't need growth. It's got that in spades when you look at it compared to its peers. What it could do with is a quicker solution to alleviating his cash flow issues. It's been really working hard to fund R&D through all kinds of methods that it's been developing, called externalization of assets, etc. So now it has potential with its all-time-ish high share price to go and acquire or merge with a company that gives it potentially the largest R&D budget out there.
Well, no, I get the idea that AstraZeneca is a unique invention of its own, but is it growth for growth's sake? I mean, is there not so much a financial raison d'etre, but is there a reason for this merger given the entire global industry?
Oh, yeah. So I actually don't think that they need to buy growth. They certainly wouldn't be buying growth if they merged with Gilead. Gilead's a much slower growth story than Astra. What they'll get is the ability to potentially spend $9 to $10 billion a year on R&D as a combined group. That's tremendous. That would be second only to Roche. And if you're very good at doing R&D, as Astra seems to have shown us recently, maybe it's better to have more firepower to throw at it than less.
Sam, thank you so much. Sam Fazeli there from Bloomberg Intelligence. Now, as New York City begins to reopen today in the first phase of reopening, construction, agriculture, manufacturing, and wholesale trade can resume operations. Retail stores can also offer in-store and curbside pickup. We'll have plenty more on New York. We'll have plenty more on what the reopening phase actually means for COVID-19 and, of course, what it means for the spread of the disease. Up next, Eric Nielsen, UniCredit Group Chief Economist, joins us. We'll be talking about the Fed. We'll be talking about Europe. This is Bloomberg.
true diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, let's talk about the economy. Let's talk also about the Fed that will be on Wednesday. Let's get straight to Eric Nielsen, UniCredit Group Chief Economist. Eric, last week was all about why there was a rally in stock markets that wasn't being played out in the economy, or at least the fundamentals of the economy. Then we had this amazing jobs report on Friday. And the other line of thought is that maybe the stock market was following some underlying recovery that we had not spotted in the economy yet, apart from the Friday's jobs report. How do you see this playing out? Are we going to see, in certain parts of the economy, a V-shaped recovery?
Yeah, here and there we will see V-shaped, of course, but we are getting closer to it for sure, right? I mean, that said, I personally think the stock market has got ahead of itself, but I've said this for a while and been wrong. But it is the policy measures are phenomenal, both in America and in Europe, and there's not much you can buy, you can say, and so money goes to work, but it feels rich to me.
Eric, what part of the economy do you see actually recovering sooner than maybe we were expecting a couple of weeks ago? First of all, in the U.S.
So I think it depends a little bit on how you think about recovery. I mean, there's a mathematical recovery or big bounce in the sectors and the areas which were hit the hardest by definition if they open up. So naturally, some of the retail starting coming up again, and people start to go out buying, hopefully, but we don't know yet. So there you will see something quite dramatic. You've seen, for example, the trucking index in Germany. This is the index that tracks how many trucks runs around the autobahns, and in May it bounced very, very strongly, right? So you see a very sharp V-shaped recovery there. There are other ones that have been really hard, like the airlines. I think that's going to be a fat U because very few people will fly for a long time, and so it really depends on how we define. I mean, there will be a mathematical quick bounce, but then my point here is that I think we should expect maybe like the Nike logo whoosh kind of coming back, but it takes a long time before we get back to pre-crisis levels.
Eric, good morning. Tom Keene in New York. In all of my reading over the weekend, basically, and JP Morgan I thought was really quite good on this, the job recovery on Friday was about 15% of the recovery of this horrific economy. Is Europe the same?
No, Tom, let me take issue with this first. I mean, first of all, remember, in normal recoveries, the labor market is a lagging indicator. It's never a leading indicator.
Fair.
So therefore, one has to be very careful with that conclusion. The other thing I would say is that there was so much noise in those job numbers in America. I mean, the Bureau of Labor Statistics themselves said there was this miscalculation or error worth 3 percentage points for unemployment. But the other thing is, when you compare to Europe, is that in America, when workers are furloughed, they are reported as unemployed, and for good reasons maybe. But then you call them back, and then suddenly unemployment drops. In Europe, when you're furloughed, you are not reported as unemployed. You are still on the payroll, if you will, of the companies. So I think we have to be really, really careful not to draw any conclusion from labor market data in this recovery.
What's the blended unemployment rate in Europe then? I mean, how do you calculate that? Give me a statistic.
To be honest, I don't know how to calculate it exactly, because if you think that the furloughed people really should be called unemployed, then the number is very high, probably 15%. I'm making this up. I don't know the number because we don't have all the statistics for it.
Sure.
But it's very high. But if you are but you're basically just sent home on paid vacation in a sense and ready to come back in with a minute's notice, right? So my point here is that this crisis, this recession, while it's the deepest we have seen, certainly since the Great Depression, the impact on labor and unemployment, everything else, is completely different from anything we have seen before.
Where do you see, Eric, when you look at the difference between the U.S. and Europe, a lot of the schemes were different. A lot of the help to the companies, but also to the consumer, were different. How do you see the pattern of consumers evolving over the next 12 to 18 months?
So this is a good question, and you're right. The measures have been very, very different. Part of it is, of course, also because the economies are different. In America, you can let people, you can fire people easily, and you can hire them back more easily. While in Europe, it's much more difficult, and therefore it makes sense in Europe to have these schemes where you de facto pay people with the tax money to stay engaged with the company, even though if you have nothing to do, in a sense. But here's my bigger issue, Francine. We know the one thing we know now is in China, when they opened up the economy and started to basically wind down the lockdown, we saw this beautiful big rebound in industrial production, but not in consumer spending, because people are still scared, apparently, from going out. So in value terms, the retail sales in China is still 11% below pre-crisis levels. So all this production rebound went straight into inventories, which means that unless you get the consumers out in China, this recovery is not going to last. It's going to bend off. That's one of the key reasons why the Germans announced last week the 3% cut in the VAT for the rest of the year. Now, whether it's enough is a question, or how much it will do is still remains to be seen. But there's a real question of how you get people back out to spend. You can get people back to work and produce, but if people are not spending because they got nervous, because they want now to spend money on or take money aside for precautionary savings, because they're scared from what happened before, this is going to be a long and difficult road back then.
Is there anything, Eric, that central banks could do that would hurt the economy right now? I don't know whether it's deploying too many tools now and then not having enough in a couple of months where maybe we're seeing a more sustained recovery.
No, so it's an interesting question of what they can do to hurt the economy. This is always a risk. So I have never believed in the idea that central banks need to hold back instruments so they have more firepower. Because by implication, one is then saying they should do whatever we now talk to help prevent a deeper recession, so that we have instruments once that deeper recession comes, right? And so I never liked this idea that you often hear also central bankers say it makes no real good sense to me. So I think that you do what you think is right at this stage. And then the other thing I would say is central banks never run out of firepower. We have seen it again. The only limitations are political, and politics change.
Eric Nielsen will stay with us. He is with UniCredit. We're thrilled that we could have an extended conversation with Mr. Nielsen today. We've got much more coming up. I really want to talk to Hugh Van Steenis on the European banks. What a bounce back, say, for BNP Paribas is one example. Coming up later, Michael Swell, he is with Goldman Sachs, and we'll look at these new higher yields, some of the distinctions that Goldman Sachs sees. Stay with us from London, from New York. This is Bloomberg.
Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance. I'm Rishika Gupta. Let's get the Bloomberg Business Flash. Two drug makers heavily involved in the response to the coronavirus pandemic are considering a merger. Bloomberg has learned that AstraZeneca has made a preliminary approach to Gilead. A deal would be the biggest ever in the sector. AstraZeneca is co-developer of an experimental coronavirus vaccine. Gilead makes the only US-approved treatment. Airbnb is joining vacation rental sites in seeing a surge in summer demand. It's one of the first signs of life for the travel industry, which ground to a halt in March. Airbnb had more nights booked for US listings between May 17th and June 3rd than it did a year ago. Meanwhile, CEO Brian Chesky tells Bloomberg the company hasn't ruled out an IPO this year. And British Airways is battling on two fronts today. It raised the stakes in talks with unions by threatening to fire all 4,300 of its pilots and then rehiring them on individual contracts. BA has also started a legal process to block the UK's self-isolation requirements for arrivals. And that's the Bloomberg Business Flash. Tom, Francine.
Thank you so much, Ritika. This is what the markets are doing. A lot of focus is on whether this rally that we saw last week can actually be sustained. A lot of the focus is also on oil. So dollar declining today. European stocks are declining. Brent crude rising to $43 a barrel after this historic output curbs were extended by OPEC+. And then iron ore jumping after a Brazilian mine suspended operations after COVID-19 infections actually surged. Tom.
Francine, thank you so much. So to frame the markets here, and I'm glad that Francine mentions oil, our Javier Blas out with a terrific essay on OPEC Plus and the dynamics there, the game theory almost that we're seeing out of Saudi Arabia and Russia. And what's extraordinary here has been the sell-side pushback to the uproar over the weekend. Edward Morse at Citigroup writing a blistering note this morning saying, look, oil is about inventory dynamics and not the financial dynamics of the futures market of oil. Really, really heated note by Morris as we see oil lift up, as Francine mentioned, to the 43 level. Futures are higher this morning. It'll be interesting to see how the VIX adapts as we get closer to the opening. There is a sunrise in New York this morning, and it will touch all of this island of Manhattan. And one of the sunrises will be on Herald Square. Of course, this is where Macy's is. It is where the Macy's Thanksgiving Parade ends every year. And it is a Macy's, like so much of New York City, trying to open for business. And on this Monday, New York City making every effort to open up for business. Stay with us worldwide. This is Bloomberg.
Chances are you may have started cooking more during quarantine, which means you've made plenty of trips to the grocery store, either in person or virtually. But brace yourselves, that chicken wing and hamburger patty, it's about to cost you more money. Just 4 meat processing plants account for about 80% of production in the United States. Back in April, President Donald Trump ordered all meat processing plants stay open.
They're going to be very careful. They are. As to who's going into the plant, the quarantine is going to be very strong.
Even as workers fall ill and production output suffers. So where are plant operators in all this? They have to go through lower productivity and higher costs, which means they need to make some major changes. And some plants are already running slower because of social distancing and fewer workers, and some production lines are fully automated. Tetro Das is a professor at the New Jersey Institute of Technology. He gives us the numbers. He says reducing meat processing plants to 1/3 of their capacity and also distributing the adequate protective equipment, this could all boost chicken prices at grocery stores by 25 to 30%. That means if you buy chicken at 99 cents per pound for 5 pounds, now at $5.95, it could cost you up to $6.44 before taxes. That means higher costs for an industry that's been pretty efficient at putting out cheap protein.
Good morning, everyone. Bloomberg Surveillance from London, from New York. Thrilled you're with us. We welcome all of you worldwide. Don't forget our simulcast coming up here in a bit. Lisa Abramowitz, Jonathan Farrow, and myself will drive forward the conversation through the morning. We're thrilled that Martin Schenker, the Chief Content Officer for Bloomberg, can join us with his decades of experience on Washington. It'll be really interesting to see what Marty has to say about the path forward for the president on this Monday and into the week. Right now in Europe, with us, Eric Nielsen of UniCredit, and that is a very good voice to have because the sun does come up in the east for Eric Nielsen. He's one of the great optimists of European economics. I looked carefully, Eric, this morning at the disinflationary and deflationary tendencies of Switzerland, all of Europe, the United States, and Britain. And there's no question the continent of Europe is separate from the others, and that they got a little bit of an inflationary pulse this week, and Europe really didn't. Why is that?
That's a very good and probably the central question, Tom. I mean, it is I think the pause you're talking about right now is more technical than anything else. We have had, the mathematical effects of oil price in the past. We came back down and now up again, so that's going to push it back up again. But the real issue for me is this obsession that people have, in particular in Europe, that the massive fiscal and monetary stimulus will be inflationary, and maybe it will 10 years out. Who knows? But for the next 5 years or so, I just don't see it. And the reason is that in spite of all they do, the output gap will still be there and prevent prices from really pushing higher.
This is really important, folks. The x-axis here, I kid Carl Riccadonna of Bloomberg about this all the time. He's had the courage at Bloomberg Economics, Dr. Nielsen, to go out to 2022, and I hear you going out to 2025. How does an economic system survive with 5 years of depressed real interest rates? There's got to be almost social leakages out that make that system fall apart. How do we get out then to 2025?
Well, you're right. I mean, I think the one thing that comes out of this crisis, not only in Europe but in America, is that we have a lot more public sector debt and a lot more corporate debt and some more household debt. And almost by definition, or we see it all the time, that after sort of peaks of this sort of debt, you're going to get a deleveraging period. And in that period, you have interest rates very low. So I think the idea of interest rates moving higher for a very long time, 5 years or whatever, is very, very low. So we have to learn to live with this as a bank, and we have a big pan-European bank. It's a real challenge. But I would say this, in spite of the cost for the financial system of these very, very low rates, if what we see in Europe today is this incredible change in fiscal policy philosophy, particularly in Berlin, but now driving Europe. If this is sustained, which I think there's a very high chance it is, then that is going to help fuel the economy and thereby give better demand, and that's also good for the financial sector. So the overall policy package today, from a financial sector point of view, is better than we've seen for a very long time.
But Eric, if you look at a country like Italy, is there a concern that because the ECB is there, is standing firm and is helping countries like Italy out, that actually, Italy and other countries won't push the much needed reforms through because you're not seeing that pressure on some of their BTPs?
Yes, Francine, yes, there's always this risk, but to this I would say two things. The first thing is, and I get this question all the time, that the Italian story is only because the ECB is there. Yeah, tell me any country that would be in a good shape if the central bank was not there for them, right? So it is to various degrees, but as we saw last week on the ECB numbers, they've actually not deviated much, almost at all, from the capital keys. So the first thing is, yes, Italy benefits from the ECB like all other Eurozone banks do. So that's clear. I think you're right to worry about the longer-term growth and the reforms that needs to be done in Italy, but also other countries for that matter. But I don't like the idea, and I know you didn't imply this, but some implied, I don't like the idea that monetary policy somehow should be set to force the hands on the elected politicians. This is not democracy then, right? So the central bank is given the environment, including the fiscal policy, and they react, and I think the ECB is doing a very good job at that. But it is in a democracy for the elected politicians to drive, hopefully, an agenda, and they have done some. I mean, one should also be fair to them. But Italy has had for many years a growth problem, and that needs to be addressed.
Is there any chance that a country like Italy will need a bailout out of this, or because the ECB has stood firm on fragmentation and things like that, they won't?
No, so everything is possible in life, right? But I am completely sure that if Italy or any other country in Europe or anywhere needs a bailout of sorts, it's because of insufficient national politics, right? It is not because the Euro system is incomplete, and it is incomplete, but it's a political project, as we have seen, and there is the support for all this, and they would do, quote unquote, whatever it takes. So long as a country, including Italy, is playing along with European politics, there is no such risk, in my opinion. But of course, the political fabric can change, and crazy ideas about an alternative life can emerge, and then you never know, right?
Eric Nielsen, thank you so much. He is with UniCredit. Right now in New York City, with our First Word News, is Ritika Gupta.
Morning, Tom. Francine. New York City Mayor Bill de Blasio is trying to lower expectations as the city begins to reopen. He says if he sees indicators going in the wrong direction, he'll be vocal about it. Construction, agriculture, manufacturing and wholesale trade can resume operation. Retail stores can offer in-store and curbside pickup. President Trump is facing another defection from a notable Republican. Former Secretary of State Colin Powell says he'll vote for Joe Biden. The retired four-star general told CNN that by threatening to use U.S. troops against protesters, the president showed he has drifted away from the Constitution. President Trump's order to pull 9,500 American troops out of Germany has rocked the post-war world order. The move would cut U.S. troop strength in Germany by about 1/4. It's another sign of the disconnect between Washington and Berlin. President Trump has criticized Chancellor Angela Merkel's government for not meeting defense spending targets. And British Prime Minister Boris Johnson is finalising plans to ease the country's lockdown and rebuild the economy. He's also hoping to rebuild support for his government in opinion polls. Johnson will brief his cabinet tomorrow on the next stage of lifting restrictions. Later this month, he'll promise increased spending on roads, hospitals and research. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thank you so much. Now, coming up, Hugh Van Steenis, UBS senior advisor to the chief executive. He was previously, of course, an advisor to the Bank of England governor. We'll talk to him about the UK and negative rates. This is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Bloomberg Surveillance. Good morning, everyone. From London, from New York, Francine Lacroix and Tom Keene. An interesting Monday. Fed Day on Wednesday. We'll have complete coverage for you. It'll be interesting to see. And, of course, one of the things we're looking at this morning is the continued opening or reopening of America. It has been fits and starts among the 50 states. Certainly, it is a benchmark day in Manhattan for that as well. Right now, Hugh Van Steenis with us. He is a good friend from Davos. He is someone that's always thought bigger in various employment around the street in his government service to the United Kingdom. He now works for UBS as a special and senior advisor. Hugh, wonderful to have you with us. You and I went back and forth this weekend on Ken Rogoff's magisterial book, The Curse of Cash, which was my book of the year a few years ago. And in that, Ken Rogoff talks about the courage to go ever greater in negative interest rates. Is the United Kingdom going to do teensy-weensy negative interest rates? Or are they going to have the courage to actually affect the plan, to start a negative rate strategy?
Well, great to join you, Tom and Francine. Look, I loved Ken's book, but I fear that it may not be the right solution to the problems which confront the country. And therefore, I think the odds of negative rates being introduced deeply negative, as Ken likes to put them, is, I think, a long, long way off. I think, we've debated before, the policy is at best weak and is heavily contested. It hasn't been a great source of success in the Eurozone and Japan. I think in particular, one thing which concerns me is what does it mean for the financial system, both here or if it spreads to the States or New Zealand, where it's also been debated, I think is mind-bending for the financial system. And it also requires real courage to then change the regulations for the system to become less brittle. And again, is there the real political cover to make those changes? So I think Ken's thesis, whilst intriguing, is remote. And I think the really important thing is, for Ken, it's about confronting deflation with significantly negative interest rates. To do that, you need to tread very carefully, inch by inch. And that would mean that we're going to have them for a very long while. So I think the market would take flight. And certainly for pension funds, for insurers, this would not be a great day.
You know, I would suggest, Hugh, you and Axel Weber in a room together is a pretty cool thing. I mean, we've seen that at Davos, and I guess we do that at UBS now as well. That's a lot of firepower. What is the opinion on inflation? I mean, granted, we're coming off hyper low nominal in real levels, but can we actually have a concern about higher yields and a new reflation?
Look, I think we all are humbled by the range of possible outcomes here as we're looking at as you said, the economy is unlocking, the recovery in consumer and corporate spending. But, let's be clear, there is going to be a significant set of problems with businesses being in difficulty. So I think the range of outcomes are quite wide. Look, depending on the country, debt to GDP is probably going to be up by 15 to, in some cases, almost 25%, given the range of fiscal measures. That sounds to me, whether we're going to pay for it through very and prolonged low interest rates. I think the odds of a spike in inflation is low. But obviously, the UK has got a number of issues to navigate, including sort of Brexit as we come through this year. So I think it's a possibility, but I think if even though every central banker wants to have a broad toolkit, we're hoping that this is not a tool which I don't think it's the best tool to confront inflation. If there were to be, I think if anything, that would be a higher quality problem to have, because I think traditional central bank medicine, I think, knows what to do with high inflation. What it's really struggling to do is how to confront ultra low inflation.
Hugh, good morning. It's Francine as well. How do you see the UK economy actually developing in the next 12 to 18 months? So we also have this deadline for the UK leaving the EU. We understand that talks aren't going great. What kind of an economy will we have if there's a no-deal Brexit? Will it be much more skewed towards services?
Well, look, I think it's a great question, Francine. And look, we're already confronted with the biggest downturn since the beginning of the 17th century, and so there's clearly a real 1700s, sorry, and I think therefore there's a real concern just about the here and now. And we've been spending a lot of time thinking through the emergency program. So how will, as the economy unlocks, how will the furlough program unravel? I mean, almost 25% of the working population is currently being paid for in some way by the state. The small business lending scheme has also been a key focus, and that's been very helpful. But let's be clear, it's unlikely that all the small businesses are going to be able to pay those back, some of those which may turn to grants. So there's a lot of policy questions which are open. I think that the key challenge of a hard Brexit will sort of add additional concerns. And I think that's in a way why the bank and the markets are weighing up, is there a risk of negative rates as one extra policy tool to confront what is likely to be a very challenged economy. But, we're all hoping for the best in terms of a reopening, even if it ends up being a little bit lagged compared to some of the countries which have had slightly clearer policies.
Yeah, and Hugh, of course, we worry a lot about the UK airlines, given that there's a quarantine when you come back to the UK that kicks off today. Overall, does the Bank of England have a set of tools that are strong enough to basically do the same job that negative rates without going to negative rates?
It's a great question. I mean, I think that, the thesis that we have is that negative rates, have one or two positives, but really the side effects are more pronounced. And importantly, if, you were to go negative, because of the various tripwires in the financial system, you'd want to go there gently and slowly, and therefore you're likely to have them for a very prolonged period of time. That doesn't sound to me, a prolonged period of side effects is troubling. And I thought it was very striking in response to the piece penned to the FT, Vitor Constantia, the former vice president of the ECB, was very supportive that in retrospect, we've already reached this reversal rate where negative rates are doing more harm than good. So I think at this point we expect very low front-end rates, low 5 to 10 year rates. It's actually one very striking thing, and you can see this on the terminal, is how the spike in US rates last week, in fact probably for the last 3 weeks, of both the 10-year and the 30-year, has not been met in the UK. The UK has been an outlier in really not getting that growth recovery. And I think it speaks, Francine, to your challenge that the double whammy of both the pandemic and Brexit is certainly leaving a lot of concern in the marketplace, and hence the UK looks a real outlier at the long end of the curve.
Hugh Vencinas, thank you so much. Greatly appreciate it this morning. He is with UBS and, of course, public service to the United Kingdom with Governor Mark Carney at the Bank of England. We've got much more to come. Adam Posen will join in the 11 o'clock hour with Alex Steele and Guy Johnson. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Friday's U.S. jobs data showed that black unemployment climbing to the highest level since 1984. This comes amid an increasing call to examine the socioeconomic inequality in the U.S. Well, Bloomberg discussed the prevalence of racial inequality with former Xerox chief executive Ursula Burns, the only black woman to ever lead a Fortune 500 company on a long-term basis.
Clearly, just top of my worry list, top of a concern list. But I entered this discussion and this debate during the coronavirus, at the start of the coronavirus, optimistic, interestingly enough. Optimistic about maybe coming out of this disruption time in a better position than we entered. And that meaning that people, companies in particular, paid attention to what we now call these essential workers. We start to understand what an essential worker really is, the guy who delivers food for us, the guys who stock the shelves, the guys who push the patients around, etc. I'm hoping that, knowing that a lot of the Black and brown people in the United States work at the lower end of the socioeconomic employment ladder, I'm hoping that we can use this time, total disruption, pandemic, racial unrest, continued socioeconomic imbalance, to reset the whole conversation about how Black and brown people are fit into the employment ladder, but also how companies view these quote unquote essential workers and how important they are, how we have to pay them, how we have to nurture them, and how we have to move them up the ladders.
We've seen.
I'm hoping it's an opportunity, but I don't know if it will be.
I'm glad you're optimistic. I hope that we can come out of the conversation still optimistic. How optimistic are you about some of the statements that are being made by corporations? I'm interested in particular because do you think they feel authentic across the board as it stands?
I think that many companies, many more than I've ever seen before, so the vast majority that are speaking now, many more than I've seen before, are starting to feel uneasy about the state of America in this space. They are starting to realize that this is fundamentally unsustainable. It's definitely unfair and wrong, and that the tilt is starting to come off. We're starting to go out of balance, and it's really important that the rhetoric in the administration, which is generally negative and definitely demeaning, that has to be offset by some action, real action, funding groups, changing employment practices, being affirmative in how they actually address their employment needs, being affirmative in hiring Black and brown people, being affirmative in progressing them through the companies, being affirmative about how they look at the C-suite and how they look at the board level. Without that passion and that drive, I think that we're going to not make progress. And I think that companies are now starting to realize more and more that not making progress is not sustainable. So they're going to have to do something. And the good news is it's kind of like it all came together at once. This is not enough to make change, but at least if we get enough of a crescendo of voices, maybe we can keep the action going. This is not the first time that a Black man has been killed by a policeman. It's not the first time. It happened before. It happened before that. And I'm hoping this time we just don't let this sacrifice of this human go unrequited, unpaid back, right? It's important that companies start to stand up and say, we have something to do with this. We have something to do with the solutions.
So, Ursula, what makes this seem different to you, that the outcome of this is going to be different and more positive than maybe what it was in the past?
I think that the number of the broad-based coalition that's now starting to speak, please don't get my little optimism as overjoyed optimism. Don't get me wrong. Yeah. I do not believe that what I'm hearing today is going to actually drive change. We're going to have to be involved and stay involved. All of the voices in the street, all of the voices in the news media, all of the voices in corporate America are going to have to stay involved to actually see true change. The only reason why I'm a little bit more optimistic is that people are getting fed up with the current state of play.
An important conversation on Friday, and of course it is a conversation that moves forward into this week as well. The backdrop to all of this is, of course, the attempt out of the pandemic to get back to a better economy. That includes a reopening of America, and again, some states really never closed. That is not true of a very hard-hit New York City, the courage of our medical community. A symbol of that is always Macy's and the idea that Herald Square will open today. Please stay with us. Another hour of Bloomberg Surveillance. Good morning.
San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market, averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the First Word Asia.
U.S. and Japan duke it out over exchange. China's slumping onshore bond market is great.
This morning, do the math, the reality that we have made back a mere 15% of the collapse in jobs. The guess, well, maybe that the turn in the American economy, it may come earlier and more strongly than expected. That according to JP Morgan. And what will the Fed on Wednesday? Maybe it will be steady as she goes. Markets this morning, they price in a more rapid recovery. Futures are bid. The Brazilian real, it strengthened 17% from mid-May gloom. And in Washington, the president has, quote, drifted away from the Constitution. So says General Powell. President Trump, in the midnight hour, tweets the general is, quote, weak and pathetic. Will the president speak to the nation this week? Good morning, everyone. This is Bloomberg Surveillance. I'm Tom Keene in New York, still on the edge of Central Park and remote. We're working on when we'll get back to 3rd Avenue and Lexington. We'll see. Francine Lacroix at Queen Victoria Street with a full discussion of Europe in our past hour. Francine, really one of the great themes here across all of this is the hope of Europe and higher interest rates. What is the thinking on the higher interest rates and what they mean for the United Kingdom and for Europe?
Well, Tom, the thinking on the higher interest rate is basically we need to watch out for inflation. We had some encouraging figures. Today was not one of them. We had some German data that was a bit worse than expected. But overall, economists think that if the ECB stands firm in continuing to buying some of the bonds out there that they said, then the economy could be on a better footing. A couple of things on the UK, Tom, though. We need to look at Brexit. The deadline we keep on hearing from the government will not be extended, so we could see a no-deal Brexit by the end of the year. And then today, the quarantine comes into effect. So the UK is the only country in the EU right now that if you fly back from today, then you have to stay at home for 2 weeks.
Yeah, I'm really glad you bring that up, folks. I really feel remiss in that we've been so focused on the political situation and the drama in America that we've really ignored so much of what's going on across London. And as Francine notes out, the United Kingdom is really quite distinctive now in terms of this pandemic versus the rest of Europe. Right now with our First Word News in New York City, here's Ritika Gupta.
Morning, Tom. Francine. The U.S. city hit hardest by the coronavirus starts to reopen today. In this initial phase, New York City will allow construction, agriculture, manufacturing and wholesale trade to start operating again. Retail stores can offer curbside and in-store pickup. If all goes well, New York could expand the reopening in 2 weeks. More than 17,000 people in the city died from the coronavirus. An aggressive proposal from the Minneapolis City Council. A majority of its members say they support disbanding the city's police department. That comes just as the state launched a civil rights investigation following the death of George Floyd. One city council member says she wants to, quote, end policing as we know it. Saudi Arabia raised its oil prices the most in at least 2 decades. That came a day after the OPEC Plus coalition extended its historic output cuts. The biggest Saudi price hike will hit July exports to Asia. Overall, the increases for Saudi crude erase almost all of the discounts the kingdom made during its 1-month price war with Russia. In Japan, the economy shrank less than expected in the first quarter. GDP fell at an annualized rate of 2.2%. But there's a catch. The result was based on a survey that probably overstated the strength of Japanese business investment during the pandemic. First quarter figures may be revised downwards later. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities, and a further lift to the market off the glory we saw on Friday. Futures up 12, Dow futures up 153. Let me give you those levels right now. 3,200 on SPX and Dow futures 27,229. We see it correlated risk on with lift in the bond market as well. Are we on the 1% watch? 0.92 earlier, 0.91 now. I don't think we're yet to the 1% number. I'd note oil, $43 the barrel. Francine?
Tom, I'm looking at European stocks, and they're pairing some of the declines. They're down some 0.3%. Investors trying to figure out how much further to take this global rally in risk assets. I would point to two pieces of news in commodities. So first of all, Brent crude. I decided to use the London oil instead of WTI. Brent crude rising to $43 a barrel after this historic output curbs were extended by OPEC+, and then iron ore also jumping after a Brazilian mine was suspended, or at least the operations were suspended after COVID-19 infections surged. Tom.
Very good. Among all of the imagery of the weekend and the symbolism, including right outside my window, protests going on down Fifth Avenue here in Manhattan, significant protests in Brooklyn, but across this nation, none were more poignant than in Washington. And of course, many symbolisms there. Certainly taking the headlines yesterday was Senator Romney, the Republican of Utah, protesting as well. All of this has led to a silence across the New York Times, the Washington Post, Bloomberg News, and all the rest about what is the plan forward for the president. Martin Schenker joins us now, our Chief Content Officer, of course, with decades of experience in Washington. Marty, what is the president's plan this morning for the week, or are they going to make it up as they go?
Well, there's reporting around the fact that his campaign people are looking at dreadful poll numbers and are trying to come up with a new formula for giving Trump supporters an argument and those who don't support him an argument to support him. And my guess is it's going to center on the economy and markets.
Okay, that may be fine, Marty, but did you glean over the weekend, and I looked carefully at the president's set of tweets, including the late night tweets last night, folks, I don't see any budging on his part from a, and I don't say this critically, but is a simplistic law and order plan. Is there a White House plan?
There isn't a plan that we know of yet, but we do know that his campaign people are very concerned about his reelection prospects. The law and order, he is trying to cast Joe Biden in the camp of defunding police. We have a story out this morning that suggests that that is something he thinks is working for him. But when you look at the polling, there's an NBC Wall Street Journal poll. It shows 60%, almost 60% of people are very concerned over the death of George Floyd. And so that would suggest that the law and order issue is not necessarily going to work for him. So I would look for a more nuanced message going forward this week.
Marty, are Republicans still sticking with Donald Trump? We had a high number of, or maybe a number of high-profile Republicans actually, going against the president and questioning the Constitution.
Yeah, and ex-generals led by Colin Powell yesterday, as Tom mentioned. But these are establishment Republicans, people like George Bush and Mitt Romney, who Donald Trump doesn't consider to be part of his base anyway. So, but the core group of people in the Senate Republicans are sticking with, are silent, which basically amounts to support for Donald Trump. So I don't think he's under any threat of an insurrection within the GOP at this moment.
Marty Schenker, thank you so much for the update here. And folks, you've got to believe it will be a very fluid Monday. Our Washington team covering not only the protests nationwide, but covering 1600 Pennsylvania Avenue. It will never, ever be the 7th tallest building in Manhattan. It will always be the tallest. The Empire State Building is New York reopens. Stay with us. This is Bloomberg Surveillance. Good morning, everyone. Bloomberg Surveillance, thank you for being with us. Just simply this, risk on continues today. Nothing like what we saw on Friday with that surprise jobs report and the huge lift in the markets, but nevertheless, green on the screen, yields are higher, dollar churning, I'll call it, but it's Monday after a jobs report. I guess it's a pretty good Monday. Francine Lacroix in London, I'm Tom Keene in New York. Joining us now, James Sweeney. He's with Credit Suisse. He is their chief economist and also handling much of the investment strategy side as well, and his management, I should say, of their team of investment strategists. James Sweeney, you have been the most visible person I know pushing back against deflation and disinflation worries, particularly in Europe. You were brilliant on that 5, 6, 7 years ago. Even with all that's going on, should we still not fear deflation?
Well, I think we probably should fear the tail risks to inflation on both sides. I think we should fear inflation volatility and an end to the extremely calm inflation that we've had in practically all developed economies since the late 1990s. I think this is a shock that risks perturbing that underlying macroeconomic and inflation calm that we've had for now. And for the moment, the risks to inflation is surely to the downside.
The risks of inflation to a downside, and of course this will be understood by the Fed on Wednesday. As you wrote for Monday morning, how did you interpret a better than good jobs report?
Well, this was sort of next month's report, according to what we expected. So from with the economy turning back on and with a lot of people returning to work, you're going to see a major pickup in all sorts of indicators, which is just driven by the total numbers of hours worked surging. So we didn't expect this report to start to pick that up on this scale. Because really none of the other labor data recently have suggested this, but you have both the establishment survey and the household survey, the payrolls and the unemployment both confirming this. So it suggests people are getting back to work. That's all. The bigger question really, though, is where will unemployment be maybe 6 months from now if we are mostly back to work? And I think it's still going to be pretty elevated, and that's the problem.
James, what does this all mean for consumers? So if people, are going back to work, are they also going back to spending?
Yeah, I mean, I think we've had this wild increase in personal savings because policy has done a good job disassociating household income from the loss of hours worked and jobs. And this is, of course, through the unemployment, through the unemployment policy, through the $1,200 checks that were sent out. But when people are sitting at home, it's hard to spend money on lots of things, and so people don't. So obviously we will have a very significant increase in consumer spending in the near term in growth rate terms. But the question is, will you have a good level of consumer spending and ultimately a level of GDP? We think it's going to be some time. So you're past the shutdown bottom in the economy, and you're going to now have months of rebound at a pace determined by the rate at which people return to their jobs. But this economy is injured, and things are not going to be fully normal, including consumer spending, for a long time.
James, when you look at, when you say the Friday jobs report was something that you'd be expecting in a month, does it mean that also the equity rally that we saw that seemed, unloved and in certain, ways unjustified was fully justified?
Well, historically, we find that when you have a big drop in industrial activity, the momentum in that industrial activity, when it starts rising, that's when the equity market typically rebounds as well. And that rebound in industrial activity has been underway for a while. I mean, we were forecasting it in February and March to come in May. I think it clearly did come in May. And I think the market behaved as if it anticipated that. The fact that you got lots of good policy news in the same time, and you had some good news on the virus in the U.S. and Europe at the same time, I think are the reasons for the rally. And now the jobs data is just consistent with reopening. So you've had this momentum shift in the virus data, the policy data, and some of the economic data now, including the labor market, but the industrial data even before the labor market data. And I think that's the foundation of this rally. But this is a momentum rebound from an extreme trough associated with shutdown. This is not a return to strength in the economy.
James Sweeney with us with Credit Suisse, and we will continue with Mr. Sweeney, no question about that. Further economics later on Bloomberg Television. Adam Posen in the 11 o'clock hour with the Peterson Institute. Please stay with us with markets elevated. This is Bloomberg.
There has to be justice. There has to be protest. We have to be heard. We have to move forward strategically. We have to move forward smart. We have to move forward tedious, and we have to be together, man. How we doing it?
Talk about how sports is for everybody. We talk about how, sports is where you bring people together. It's everybody's, it's an inclusive thing. But when we talk about our own personal battles outside of sports, there's a lot of people that are silent on issues, and they're important issues. They're issues that have been going on for hundreds of years, and we need that same type of team mentality to be brought to issues outside of our sport.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil. The Bloomberg Commodity Index.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. Two drug makers heavily involved in the response to the coronavirus pandemic are considering a merger. Bloomberg has learned that AstraZeneca has made a preliminary approach to Gilead. A deal would be the biggest ever in the sector. AstraZeneca is co-developer of an experimental coronavirus vaccine. Gilead makes the only US-approved treatment. Airbnb is joining vacation rental sites in seeing a surge in summer demand. It's one of the first signs of life for the travel industry, which ground to a halt in March. Airbnb had more nights booked for US listings between May 17th and June 3rd than it did a year ago. Meanwhile, CEO Brian Chesky tells Bloomberg the company hasn't ruled out an IPO this year. And British Airways is battling on two fronts today. It raised the stakes in talks with unions by threatening to fire all 4,300 of its pilots and then rehiring them on individual contracts. BA has also started a legal process to block the UK's self-isolation requirement for arrivals. And that's the Bloomberg Business Flash. Tom, Francine.
Thank you so much, Ritika. Now, we were talking about that jobs report out of the U.S. on Friday. We were talking about the diversion between what stocks were doing and what we're seeing in the fundamental economy. Let's get straight back to James Sweeney of Credit Suisse. James, what more at this point can the Fed do? They're meeting on Wednesday. Is it just more of what they can say, or can they actually do something?
Well, they could do something. I mean, yield curve control stands as the major policy option. The other one is forward guidance linked to some tangible, progress indicator like inflation or the unemployment rate. So saying that they're not going to hike until you get to, X in the unemployment rate or inflation. I think yield curve control is a very powerful policy and a very big deal if they do it. But I think they have no urgency on that now. And so I expect them to really just sort of discuss the forward guidance question. I guess there's a possibility that they do it now, but I think with what the market's doing and with the improvement in economic momentum, probably not the time. I think the bigger question is really about fiscal policy at this point. Help for states and localities, and unemployment. Do you extend some of the extended unemployment benefits, which expire on July 31st? There's going to be a cliff in household income in August if they don't, and it looks like Congress might be waiting until the last week of July to really consider that in a bipartisan way.
James, where do you see the dollar by year end?
Well, I mean, broadly right now, the dollar is in a little bit of a reversal, a decline, which I think makes sense with the policy measures now in place, with the zero rates in the U.S., with the rebound in the market. So we don't have a particularly strong view on the dollar for the year. So, but I think for the moment, the move is down with this risk on and this momentum improvement. I'm not sure that will last through the year,
James,
though.
What's so interesting in this saga, this pandemic, James Sweeney, is we are in February in Nirvana, and in March we are trying to frame May 1st or May 15th, and then I get through April, we were sort of framing into June. As you just mentioned, I get this complete mystery about August and September, and I like how you frame the pending legislation that drops away in August, etc. What does James Sweeney's September look like?
Well, I think, again, if you go to the economic data, the virus data, and the policy news, you've got your three main factors that are going to frame things for the market. So I would start with the virus in September. I mean, will we see that rebound? Will we see that 1918-style rebound, which is the worst-case scenario? So clearly, anything that happens in the autumn is primarily about whether you've seen that rebound or not. I mean, if we assume that we don't see a major rebound, but that the virus is still around, and we've been studying the virus data carefully, and I think you can say with reasonable conviction that the virus is going to be around, if not in a major outbreak requiring strong lockdowns. And then you're in a sort of halfway house, where you have your rebound in economic momentum, but economic life cannot be normal. It cannot be normal. So I think you have to worry about a slowing economy after September. And I think even, unemployment, let's say unemployment falls to 7, 8, 9%. It may get stuck there,
Well, we got
it may get stuck there. Businesses are going to worry. Sorry. Okay.
Well, we're gonna run out of time. James Sweeney wants to keep going, and we want him to keep going too. But guess what? The clock is in charge. Stay with us. This is Bloomberg.
Los que hayamos adoptado un abuelito, vamos a continuar viéndolos a nuestros abuelitos, ¿no? No podemos dejarlos de verlos. Por el hecho que se termine de solucionar la pandemia, más bien al contrario, habremos tenido un mayor contacto con nuestros abuelitos hasta sus últimos días.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It is an opening around the nation, and particularly for the state of New York, the tri-state area of New York City. It has been a brutal 9, 10, and even 11 weeks. The sunrise will show us, well, a reopening. New York City really making an effort on this money to reopen, and there's nothing that symbolizes that than the heritage of Herald Square and Macy's. Yes, it's the end of the Thanksgiving parade. And yes, Macy's is beleaguered in retail with Amazon and all that. But still, it's a great story and symbol of the reopening of Manhattan. With our first word news in New York City, here's Ritika Gupta.
Thanks, Tom. New York City Mayor Bill de Blasio is trying to lower expectations as the city begins to reopen. He says if he sees indicators going in the wrong direction, he'll be vocal about it. Construction, agriculture, manufacturing and wholesale trade can resume operation. Retail stores can offer in-store and curbside pickup. President Trump is trying to link Joe Biden to activists' call to defund the police. The president's goal appears to be to portray the Democratic presidential candidate as weak on crime. Biden hasn't embraced the defunding demands. Protests over the death of a black man in police custody, George Floyd, have the president on a defensive. President Trump's order to pull 9,500 American troops out of Germany has rocked the post-war world order. The move would cut U.S. troop strength in Germany by about 1/4. It's another sign of the disconnect between Washington and Berlin. President Trump has criticized Chancellor Angela Merkel's government for not meeting defense spending targets. And British Prime Minister Boris Johnson is finalizing plans to ease the country's lockdown and rebuild the economy. He's also hoping to rebuild support for his government in opinion polls. Johnson will brief his cabinet tomorrow on the next stage of lifting restrictions. Later this month, he'll promise increased spending on roads, hospitals, and research. Global news 24 hours a day on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Now, Washington has ramped up its rhetoric towards Beijing over its handling of the virus outbreak and its planned national security law for Hong Kong. President Donald Trump has also announced the U.S. would begin the process of removing some of the city's privileged trade status without detailing specifics. Well, joining us now is one of the greatest thinkers when it comes to trade wars, but much more with a new book, is Michael Pettis, Peking University, Guangxia School of Management professor, Carnegie Tsinghua Center for Global Policy Senior Fellow, and of course, author of this new book. He co-authored the new book called Trade Wars, Our Class Wars. Thank you so much, Michael Pettis, for joining us on Bloomberg Surveillance. I mean, this book could not be more timely. It basically goes to the fact that this rising inequality across the world is distorting not only the global economy, but is threatening international peace. First of all, why did you write the book?
Well, I think there was a lot of misconceptions about trade conflict, the likelihood of trade conflict, what's making it worse. And my co-author and I, Matt Klein, well, we wanted to explain what are really driving these imbalances. And I think the most important point that we want to make is that these conflicts really shouldn't be thought of as conflicts between nations. They're really conflict between economic actors, so that The same economic sector in the deficit countries are benefiting as in the surplus countries, and it's the same groups in both countries that are suffering from the effects of these trade imbalances.
Michael Pettis, we're going to work on the audio. It's just that simple. We're trying to hook this up from Beijing, folks, with Michael Pettis, and we really want to continue with this. Let's do this. Let's take a break here, and we do so with futures up substantially off of the Friday highs, but still nicely elevated. Dow futures established above 27,000. Stay with us. This is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Kidd in New York. We've redone the wires, if you will, and Michael Pettis continues with us. Of course, way long ago, Francine's way too young to remember this, the Manufacturers Hanover Company. Pettis won't even admit to that. And, of course, legendary Bear Stearns, and we're thrilled he's with us, of course, an author on China. Michael, one of your great theories of China, going back many books, is the idea that they're way over investing on infrastructure and not setting up a consumption-centric China. With a pandemic, is that an opportunity to finally get to a consumption-centric China?
Well, it's an opportunity in the sense that if you're having difficulty doing whatever it is you want to do and somebody puts a gun to your head, then perhaps you'll be more incentivized to do it. The problem in China is that China suffers from a really low consumption rate, not because Chinese households are super thrifty, but rather because Chinese workers get paid a very low share of what they produce, much lower than any other country. And as a result, they can only consume a low share. And for that reason, if you want growth in China, you need really high levels of investment, which unfortunately are no longer very productive. COVID-19 has made all of that worse because not only has household income gone further down, thanks to very large unemployment levels, but on top of it, Chinese households, like American households and everybody else, have decided that one of their reactions to the shock of COVID-19 is to save more of their income in case of future problems. And as a result, that really worsens the problem of the low consumption share in China.
What is the action plan for President Xi? I mean, we're distracted by the United States-China relationship. We're distracted by, say, events in the South China Sea. But domestically, there has to be an action plan. What is it?
It's an action plan that was first proposed as far back as March 2007. It's just very hard to pull off. And that is, if you want to reduce your reliance on investment and increase your reliance on consumption, it's really quite simple. Politically difficult, but conceptually simple. You have to transfer income from the non-consuming parts of the economy, which are mostly the local governments and the local elites, towards the consuming part of the economy, which are ordinary households. But I don't need to tell you, these types of wealth transfers are politically very, very difficult. That's why we've been talking about it for at least 13 years, but it's been really difficult to pull off.
Why has it been, Michael Pettis, so difficult to pull off? This is basically the basis of your new book. Is it because the elite just wanted to keep it for themselves? And who are the elite anyway? Are we talking about the people that are more rich than the average, or are we talking about the people that are in charge politically?
It's a combination. It's mostly the sort of income elite, the richest people in China, as well as local governments, which control a lot of assets. If you think about China over the last 40 years, while China was growing very quickly, the household income was growing much less quickly. So somebody else's income, these elites, grew much more quickly. And as a result, they become politically very powerful, politically very important. And that's why it's been so difficult to reverse those transfers. This is a classic developing country problem, by the way.
Will anything change, Michael Pettis, because of protests? And in general, there are a lot more people talking about the huge inequality that can be because of minorities, that can be where you live, that is because of the education. Will this change in the next decade?
Well, I think, honestly, they don't have a choice. One thing about imbalances is that at some point they reverse. And this is true about income inequality in the U.S. too. At some point it must reverse. But there's a limited number of ways it can reverse, some of them quite destructive. The non-destructive way is really a politically driven redistribution of wealth, as we saw, for example, in the 1930s under FDR. And China has to do something similar. But it takes a real radical political transformation to pull that off.
Michael, you're such a China watcher. How do you respond to the massive doubt in the West that President Xi wants to work on a bilateral basis with other nations, not the U.S., but with all of the expansion of China's trade, China's military and all? Is there an actual bilateral dialogue, or is it China for itself?
Well, you know, in my 2013 book, I argued that a reversal of this globalization process was almost inevitable. And one of the consequences would be a rise in geopolitical tensions, in part because every country, and not just China, frankly, we're seeing it in the U.S., we're seeing it in Europe and Japan, everywhere. Every country will respond to the deteriorating economy and the sort of reversal of these globalized relationships in sort of the same way, with a rise in nationalism and a tendency to blame foreigners or blame immigrants for domestic problems. And I think we're seeing that in China, just like we're seeing it everywhere else.
I look, Michael, at China, and I look at your book on trade, and so much of it is a collapse of multilateralism, particularly the WTO. Is it truly dead? Well, I don't think it ever really dies. I think what happens is that
the existing structure develops such deep and unsustainable imbalances that it has to retreat, reform before it starts to grow again. The existing structure of capital and trade flows simply doesn't work. It puts an enormous amount of pressure on certain countries, mainly the U.S., to absorb all of the demand deficiencies in the rest of the world. And you know, when the U.S. was half of global GDP, it could absorb those deficiencies. But today, it's between a quarter and a fifth, so it simply can't continue doing it. That's why I think this system is going to die one way or another. Now, whether it dies because we all get together and sort of propose a new Bretton Woods, or whether it does so unilaterally, that I can't really say. I suspect it's the latter. But one way or the other, there has to be a substantial change in the way global trade and capital flows work.
Michael, how quickly would that change actually come?
Well, probably more quickly than we expect. And I would say the reason could be because of the COVID-19 pandemic. I don't really see COVID-19 as a pivot, as a turning point in world history. I see it as an acceleration of a lot of really bad trends that were already there, including the urgent need for rising debt to keep demand growing, and the rising income inequality, a whole series of things that are quite closely related. And all of those things, I think, have been made much worse by COVID-19. So we've probably done 2 or 3 years in this year, 2 or 3 years of deteriorating fundamentals.
Thank you so much, Michael Pettis there at Peking University and the Carnegie Tsinghua Center, as well as co-author of the new book, Trade Wars, Our Class Wars. Now, coming up next, we look at COVID-19. We speak with Josh Saferstein. He's Johns Hopkins University Vice Dean for Public Health Practice and Community Engagement at the Bloomberg School of Public Health. He's coming up next, and this is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
is Bloomberg Surveillance. I'm Rishka Gupta. Let's get the Bloomberg Business Flash. Apple plans to let customers buy many of its products by monthly installments. Bloomberg's learned that Apple will offer a 12-month interest-free payment plan for iPads, Macs, and several other devices. Customers will have to use the Apple credit card. The company already offers a similar payment plan for iPhones. The CEO of CrossFit has apologized for tweets that led Reebok to end its partnership with the fitness company. Greg Glassman's tweets concerned both the coronavirus and the police brutality protests. Glassman called his tweets a mistake. And children's party venue Chuck E. Cheese reportedly is in talks with lenders to raise money so it can avoid bankruptcy. That's according to the Wall Street Journal. The Journal says the company is also trying to see if it could get a $200 million loan if it decides to reorganize whilst in bankruptcy. Chuck E. Cheese has almost $1 billion in debt. And that's the Bloomberg Business Flash. Francine?
Thank you so much, Ritika. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response. Every day, we'll bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us now is Josh Sharfstein. He is Johns Hopkins University Vice Dean for Public Health Practice and Community Engagement at the Bloomberg School of Public Health. Joshua, thank you for joining us. As we continue to track COVID-19, what is the one thing that's worrying you right now? The lockdowns are being eased. We're seeing protests. You worry about the congregation of a lot of people together, about some of the police tactics.
I have been worried about some of the police tactics and how, particularly if they're arresting a lot of peaceful protesters and putting them inside together in jails. We know that that is a location where the virus has spread quite a lot. More generally, I think that there's a little bit of a sense, and I'm just saying generally that, okay, we're now moving past coronavirus, but we can't move past coronavirus because the virus is still there and still has the same logic that it always had. So whether we're, protesting, which I think people are protesting the right things, it's incredibly important, or whether we're doing other things, whatever it is, we have to have the coronavirus in mind to keep it as safe as possible.
What about schools? Is the reopening of schools something that needs to be done more quickly than we have so far, or less quickly?
Well, we have the fall coming up in the United States when school would normally open. Kids have really suffered not being in school. It's very important that kids not only get, education, but breakfast and lunch that comes with school, the supportive teachers, the social interaction with friends, all that's extremely important. I think it should be much more of a national priority to get ready for school. But school will look a little different this fall, still have to keep the coronavirus in mind. And so there are ways to reduce the risk, like keeping small groups of kids together all day, spacing out the desks a little bit more, extra cleaning. But, we've really got to get on that now for us to be ready in the fall.
Why have we had such a different response from a lot of European economies reopening some of the schools? I'm thinking of France, I'm thinking of the UK compared to the US. Well, most schools won't reopen until September.
I think that typically in the United States we don't have school over the summer, so I think people are going to take the summer to prepare for the fall. Kids are going to lose more ground over the summer, unfortunately. I can't tell you why, what exactly is happening in other countries based on what their school schedules are. I think they're starting relatively slowly in most countries, and they're going to have some experience that hopefully we can learn from here.
What is the one thing that you would learn looking back at what's happened over the last 2 to 3 months?
Well, I think that we really come to appreciate how important this asymptomatic spread is before people get symptoms, that they can really spread the virus on. And that has led to, big shifts in our understanding of how to respond. That's been, hard-won knowledge in a way because a lot of people have gotten sick, particularly in nursing homes. But I think it really tells us that there's a certain scenario we really want to avoid, particularly, large groups of people indoors, people who are vulnerable. We need to figure out ways to use equipment, reduce events, do other things to stay apart from each other that really prevents that kind of spread from happening.
How much do we understand about the virus? I know we understand more than what we did even 3-4 weeks ago, but can it morph? Can this virus become something else come next winter?
I don't think it's going to morph that much, but I think you can have all kinds of dangers with respiratory season and flu happening at the same time. We really don't understand a lot about what the virus does to the body. There's a lot of evidence pouring out about just the impact on so many different systems. A story today about the brain, their blood vessel issues, their blood clot issues. It's a very, difficult and serious illness for a lot of people. And I think that's made it hard. On the other hand, we are learning some more about treatment, and I've been heartened to see some of the studies come out about convalescent serum, the use of antibodies, that, if it's too late, it doesn't work. But earlier in the disease, it appears from several studies that there are real signals of benefit, and there's some bigger studies happening, and that could provide a really, really important way to help people before they get really sick.
I mean, I know there are various reports or various thinking on why it affects people so differently. When will we have a better understanding of who's most at risk?
I think it's going to be a gradual better understanding. I don't think it'll be a particular day because there are all kinds of different angles to look at. Is it, does it relate to people's blood type? Maybe. I mean, there's some signal there that type A has a harder time with the virus. Are there particular genetic, signals, say the receptor that the virus binds to? People are looking at that but haven't seen that quite yet. It may not be that we can find it. In fact, some people think that there's an element of randomness. Did you get a huge dose right at the beginning? Maybe that just gives you a worse course, and all these other little things don't matter. So I think that picture is going to emerge slowly. Hopefully we will have some real treatments without having to figure out all the details of the pathogenesis.
Joshua Sharfstein, thank you so much for joining us, and be sure to check out VRUS Go on the Bloomberg for the latest information. Tune in also every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Now, Saudi Arabia's energy minister, Russia's energy minister, and the OPEC Secretary General, Mohammed Barkindo, are briefing the press virtually on the weekend's OPEC Plus meeting. That's via video call. Oil continuing to rise towards $43 a barrel in London after OPEC and its allies agreed to extend historic output curbs by an extra month. Up next, more Bloomberg surveillance and TV and radio. It's a simulcast with Mike Swell, Goldman Sachs Asset Management, co-head of Global Fixed Income Portfolio Management. This is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
I would find it very difficult to argue that we're going to have a V-shaped recovery. The closest anybody's come to it is China, and it doesn't look like a V to me.
You may want to reduce the suffering because there's a risk that the whole system will come crashing down.
Now is exactly the wrong time for fiscal policymakers to get a case of fiscal rectitude.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From a reopening New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance with equity futures positive. We're live on Bloomberg TV and radio alongside Tom Keene. I'm Jonathan Ferro, together with Lisa Abramowitz. And on this Monday morning, Tom Keene, a market that is laser focused on one thing, reopening this economy.
Well, not only reopening the economy, we will talk about that through all the surveillance today, but sure, John, the symbolism of New York City, so hard hit 5, 6, 7 weeks ago, and yes, really back to open the last couple weeks, John, where you say to yourself, come on, come on, come on. This Monday is the come on where New York City reopens, and with that is that better jobs report, and of course the president talking that up. John, I thought the research over the weekend from Goldman Sachs, JP Morgan, and the others was just outstanding, putting shade and putting nuance on that jobs report of Friday.
Well, let's be clear, Tom, for this market, for the Wall Street community, for the global financial community, Friday never really ended, did it? Went through the weekend into Monday. The equity market continues to rally, and we continue to look ahead this week to a Federal Reserve. I just wonder how that payrolls report changes the Fed's approach to the news conference this week, Tom.
Maybe a little bit of nuance to it, but I really don't think it plays in all that much. I thought it was great. Bruce Kasman had this with Ferroli over at JP Morgan. You come down and the amount up, they calculate it roughly a 15% recovery in the labor economy. I don't think that's enough to have Vice Chairman Clare to turn to Chairman Powell and say, change the plan. I just don't see that, John.
I totally agree with you, Tom. That's one thing to look out for this week. Lisa Abramowitz, we've got to start with New York City reopening, the long process of reopening. And I think for many people looking at the process play out here in the United States, on the economic side, I want to emphasize that, on the economic side specifically, the data's looked okay as we've slowly got that reopening process underway.
And that's, I think, what Wall Street is laser focused on. And I think that you really wisely raised the point, the long road to reopening. Yes, today marks the beginning of phase 1 of the reopening, which will last at least 2 weeks before phase 2 starts. This is curbside pickup and things of that nature. That's the main thing that I'm watching today. Also, though, on the docket, to keep in mind, President Trump is meeting with some law enforcement at 3 p.m. at the White House. Interesting to see whether he makes any comments over the past week's developments. Plus, later in the day, the World Bank releases its semi-annual global economic prospects report. And John, I will say to Tom's point earlier, the question about the jobs data, the question about economists' ability to predict what is going to happen with this economy globally is in laser focus. How much credence do we give some of these projections right now?
Well, this market's really getting ahead of it, isn't it? Tom, just to wrap things up, Lisa mentioning the President of the United States, several reports that we might get an address this week on race and on unity. Yeah. A lot of people waiting to see whether that will actually happen or not.
Well, an extraordinary weekend, and folks, we will go to our Kevin Cirilli here in about 8, 9 minutes, maybe 10 minutes, and that'll be an important conversation. But John, I love what Greg Valliere said in his morning note on the president. He says this is a critical week for the president, and particularly how he frames the competition. Vice President Biden is a Democrat, neutralist, or is it Democrat tilted over to the liberals? That'll be a topic for Mr. Cirilli here in a bit.
We'll head down to Washington in about 15 minutes' time. We've got to start on this market. What a rally we've seen off the bottom over the last couple of months. Mike Swell at Goldman Sachs joins us now. Mike, Friday. What did Friday change for you as you look ahead to the weeks and months ahead through 2020?
I think that Friday was just an example of a continuation of the impact of government policy. So big impact on the fiscal, big impact of monetary policy, that the rally can continue because the level of support from the government has been so significant, creating an enormous amount of cash that is really looking for a reason to get invested. I think that when you look at the employment report and the discussion you've had earlier today about the questions in the number, we're a long ways away from getting American workers back to work in a very meaningful way. So the job situation is going to be one that is going to continue to be an issue for the next 6 months to a year. And so I wouldn't necessarily call victory with regard to the job picture. I think we have a long, long way to go. And I think what you're seeing right now in markets is the impact of significant policy, liquidity, more so than confidence in reopening.
The policy effort has clearly worked. The Federal Reserve's objective was to divorce financial conditions from the real economy. We've done that. I think a lot of people looking at the data, Mike, and trying to work out whether the economic conditions catches up with where financial conditions has taken us. Is that a challenge for the next couple of months or a challenge for the turn of the year?
That is the number 1, 2, and 3 question with regard to how you think about financial markets here. And at Goldman Sachs, what we did last week, we have a daily forum where we get together all different investors. We brought in our multi-asset people, our fundamental equity investors, as well as fixed income, and had kind of a cage match around this topic. And the conclusion that we came to is that, number one, the financial conditions that have been supported by the Fed and by governments through fiscal policy will dominate in the near term. But in the long term, it's going to be earnings and jobs that are going to matter. And I think that it's too early to call victory with regard to where earnings are going to end up. I think a lot of investors are saying that, we're going to jump back in 2021 to the earnings that we saw in 2019. We have a long, long way to go. And I think that there's a lot more repair that has to happen in the economy. We really don't know how companies are going to react to a different state of a global economy when we have an issue, a medical issue that's going to be so significant and change the way that we do business. So our view right now is that for the near term, policy wins, stay long risk assets, but over the longer term, it's going to be all about earnings and jobs.
Michael Swell, I want to go to your work with Goldman Sachs, and before that with Friedman, FBR, as well. With your expertise in mortgage-backed securities, a lot of rents aren't being paid. A lot of commercial real estate of every gradation isn't going to work out. There's all the loans and the fancy derivative instruments off the back of that. Are you troubled at all by a pending real estate crisis in the nation because rents are not being paid?
I would say that the residential picture is going to be 100% correlated to the job picture. So if we expect to continue to get America back to work and we can drive the true unemployment rate below 10%, we're likely not to have a housing market issue, whether on the price issue or whether on the rent issue. And so I think in terms of housing, we don't have oversupply like we had oversupply in 2007, and we don't have too much leverage in the system. We've kind of fixed the very, very high LTV loan situation, the interest-only loan situation. We don't have borrowers that are leveraged as they were before. We're really going to be dependent upon jobs. So I think if we continue to see jobs improve, we don't have a housing market issue. I do think in the commercial real estate market, there's a lot of adjustment that has to occur. There's going to be a decent amount of restructuring of loans. There's going to be some defaults, obviously, on the retail side. But if you look at the commercial real estate market, there's a big debate there if we think that we're going to see a lot of companies move out of major hubs, major cities, and diversify their exposure, having a negative impact on commercial real estate. The other side of that is in a socially distant world, you're finding that companies are actually looking for more square footage to be able to bring workers back in a safe way. So we actually think that the commercial real estate market is one that still has a lot of opportunity. If we see reopening of the economy like the equity market is telling you, you ought to see stabilization in the commercial real estate market. And if you look in the world that we live in, not in the direct commercial real estate market, but in the commercial real estate securities market, we have not seen a significant recovery in pricing there. If we see the economy get back like the equity market is telling you, we think there's going to be a lot of opportunity in some of the mezzanine securities and commercial mortgage-backed securities to be able to earn equity-like returns.
Yeah. Mike, I'm just wondering, you were saying it's a time to stay risk on, and certainly a lot of people have been risk on. If you look at high-yield bonds in the U.S., they've gained 22% since late March, and we've seen $3.5 billion flow into the biggest high-yield bond ETF in the past week alone. Don't fight the Fed, but you can front-run it. Has the Fed already been front-run fully, or are there further opportunities here?
I don't think fully. I still think there's going to be a lot of demand for U.S. credit-related assets. Keep in mind, it's not just front-running the Fed, but we're in a global interest rate environment where there are no interest rates. We're basically zero around the globe. And the U.S. credit market still is a market that offers investors yield. Demand for yield is very, very significant. And I think people will continue to view not only the U.S. Treasury market, but also the U.S. corporate credit market as, in general, a safe haven. So I do think there's more room to run. However, more broadly around the question around risk assets and where we go from here, in the short term, we do think that policy zero rates are going to drive risk assets higher from here, but that's not going to last forever. In the end, it's going to be about earnings. And so in our discussion last week, our cage match around where we go from here and have risk assets gone too far, we definitely came to the conclusion that this is going to be a winners and losers market, both on the equity side and the credit side. And it's time to think a little bit about moving away from just kind of being long beta and really focusing on the types of companies that will be the survivors and will gain market share. And so we do think active management will be a very important part of future returns versus just the beta.
Hey, Mike, we just want to know who wins a cage fight at Goldman Sachs. How does that work out over the weekend when that plays out?
Well, I'm 6'5", 220 pounds, so I'm the biggest person, so I always win. Who wins the cage match? The answer is short term, risk on. Long term, it's going to really rely upon earnings, and that the data that we have so far is irrelevant to the longer term macro picture. Stay tuned. Follow what's going on in China. Follow what's going on in South Korea in terms of reopening and what's going on with the consumer, what's going on with corporate earnings in those countries, because those will be leading indicators for what goes on here.
Mike Swell, fantastic work as always. Always appreciate your time, sir. Mike Swell there of Goldman Sachs. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz, as the long road ahead as we take that first step and reopen New York City in the first phase. Much more still to come from New York City this morning. Good morning for our audience worldwide. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The U.S. city hit hardest by the coronavirus starts to reopen today. In this initial phase, New York City will allow construction, agriculture, manufacturing and wholesale trade to start operating again. Retail stores can offer curbside and in-store pickup. If all goes well, New York could expand the reopening in 2 weeks. More than 17,000 people in the city died from the coronavirus. An aggressive proposal from the Minneapolis City Council. A majority of its members say they support disbanding the city's police department. That comes just as the state launched a civil rights investigation following the death of George Floyd. One city council member says she wants to, quote, end policing as we know it. Lawmakers say disbanding the police force and starting a new one would be a long, complex process. Saudi Arabia raised oil prices the most in at least 2 decades. That came a day after the OPEC Plus coalition extended its historic output cuts. The biggest Saudi price hike will hit July exports to Asia. Overall, the increases for Saudi crude erase almost all of the discounts the kingdom made during its 1-month price war with Russia. Brent crude has more than doubled since late April. It's still down 35% this year. In Japan, the economy shrank less than expected in the first quarter. GDP fell an annualized rate of 2.2%, but there's a catch. The result was based on a survey that probably overstated the strength of Japanese business investment during the pandemic. First quarter figures may be revised downward later. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Numbers are great, and this leads us on to a long period of growth. We'll go back to having the greatest economy anywhere in the world, nothing close, and I think we're going to have a very good upcoming few months.
The President of the United States following the jobs report this past Friday. Good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro. Together with Lisa Abramowitz, we're live on Bloomberg TV and radio. Tom, the risk, as always, with a single data point is that you extrapolate that improvement out too far too quickly. A topic of debate for us through this morning.
What's really interesting, John, to that point is how you correlate any kind of improvement in the job economy over to GDP. JP Morgan made very clear over the weekend, maybe they were wrong, maybe we're going to see a more rapid improvement, but they hedged it about 1, 2, 3, 4, 5 ways to Sunday to get John Say to September.
A remarkable rally, Tom, off the bottom in the last couple of months. The S&P 500, 3-week winning streak coming into this week. Let's get you some price action worldwide with equity futures higher, up 0.6% of the S&P 500. We push higher by 18 points, about 2 hours and change away from the opening bell in New York City. In the bond market, Treasury yields just a little bit higher again. It's been really interesting to see this. 10-year yields now 0.91%, up a basis point. The curve steeper, the 30-year advancing 3 basis points as well. Another theme in the mix over the last couple of weeks has been that weaker dollar story, and that continues with a weaker dollar against the Aussie, just a little bit stronger, Tom, against the euro.
I want to point out, John, oil, Ed Morse with a blistering note from Citigroup about 2 hours ago, making clear he doesn't buy the inventory story, but oil, $42, $43 on Brent, gets your attention. Right now, we must consider Washington, and we have been really thrilled with our Kevin Cirilli, our chief Washington correspondent, who is not only looking at the many sides of the national debate on protests, but also the many parties involved and the different shades of gray in this great national debate. Kevin Cirilli joins us this morning. Kevin, the lead stories are about a refunding, defunding, abandonment of police forces. Gregory Vellier, among others, says this is a gift on a silver platter to the president, who this week can go after the vice president and say, what kind of president would you be? How will the president take this debate and push it towards Vice President Biden?
Tom, we're expecting to hear from President Trump this week in some type of address, whether it be national or at a press conference, where the president addresses race issues in this country. But he's also likely going to discuss the issue of defunding police departments. It comes following over the weekend when Minneapolis City Council voted to defund their police department and to break ties with their police department. But what that would look like is really just a dramatic reshifting, I'm told, about how the city of Minneapolis reallocates funds. Greg's absolutely correct. And when I talk to Republican strategists on down-ballot races, it's not just a gift, mind you, to President Trump, but also to Senate Majority Leader Mitch McConnell, who's trying to keep control of the Republican-controlled Senate. Republicans want to have the debate of defunding police departments. Now, in contrast to that, former Vice President Joe Biden's campaign wants to have the open discussion of making sure that African Americans are also heard. But beyond that, he needs that African American coalition that Obama had to turn out for him if he wants to beat President Trump.
How alone is the president on this Monday?
Well, I think in terms of putting together Republicans, he has not seen a widespread flocking away from Republicans who are currently in office. Now, former Secretary of State Colin Powell over the weekend, the president tweeting out that he takes issue with Colin Powell going to vote for Joe Biden. But in terms of folks who are still in office, the president enjoys popularity in red states.
I'm just wondering, Kevin, shifting gears a little bit from the defunding of the police and the political debate around that, the reopening of the United States and the economy. I'm wondering about the dilemma for Republicans after the jobs report on Friday showed a much better than expected scenario, how much pressure that reduces on their expectation for further fiscal stimulus.
Well, you know, that's a great point. And in terms of more economic stimulus, I think based upon the conversations that I've had at the end of last week with Republican members, they're still anticipating sometime in between, right when they return from recess at the end of July and right before the August recess, so like July 23rd through the first week of August. That would be the window, Lisa, for there to be another economic round of stimulus passed, but also some type of legislation likely, maybe on reworking some police. What
I
they
apologize,
say is
Kevin. Kevin's already down in Washington. Kevin, we're going to leave it right there because of the connection. Thank you very much, sir. Let's talk about this reopening, Tom Keene. Let's get over to Herald Square, 34th Street here in Manhattan. Absolutely unbelievable contrast as we begin the slow process of reopening this economy in New York City, yet still some of the major retail organizations aren't just unable to open their businesses. Some of them are still boarded up, Tom.
Well, they're boarded up. You really nail it, John. It's two different thrusts going on here. Well, three. One of them is the public wants open now. There's no question about that. You can feel it on the streets of New York. You can see it with people, and again, heavily masked. But the other two themes, John, are the boarding up because of the protests and looting, which seems days ago now, the looting definitely. And then the other is just how do you get these stores open fast? I'm going to be fascinated, John, to see where we are Thursday and Friday with this so-called opening of New York.
So, Lisa, this is phase one. Talk to me about what's in phase one, what's phase two, what's phase three, and how quickly do we get there?
Well, it really depends on the data, right? I mean, it's not going to be less than 2 weeks in each phase as the officials try to gauge the data. And honestly, John, I'm looking at the data coming out of Arizona, where the ICU beds are getting filled up and the cases are increasing. California, Florida, the case counts are going up as some of these regions reopen. We are expecting the same thing in New York. There is a question about the protests and how much of a surge there's going to be there. All of these will be factors in the second phase of reopening. The initial one is curbside pickup and construction and some basic functioning. It's not going to be all doors open. I am curious to see how many people show up, though, John.
The bias in this market and the shift we've seen over the last couple of weeks, Tom, has been absolutely remarkable. We all saw those pictures of packed beaches several weeks ago. And I said at the time, your view on those packed beaches is probably closely aligned to your view in this market. It either triggered fears of a second wave of infection, or it triggered encouragement, fueled encouragement about an economy getting back to normal quicker. And it reminded me of that blue dress, gold dress. Do you remember the blue dress, gold dress? Some people saw blue, other people saw gold. I think everyone at the moment is seeing gold. We've seen a massive shift in the last couple of weeks.
It's been a huge shift and, of course, stunning move on Friday. But, Kevin, what's so interesting here is away from all this debate has been some of the pandemic data of the last number of days, particularly in Texas, is a bit distressing. I don't want to oversell that, but it's an issue to me.
Yeah. We'll try and pick up on that theme a little bit later in the program, Tom. Kevin Cirilli will be back with us a little bit later this morning from New York City this morning. Good morning to you all. This is Bloomberg.
San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day sizable moves in the currency market. Averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the First Word Asia.
The U.S. and Japan duke it out over exchange.
China's slumping onshore bond market is great.
From New York City, this is Bloomberg Surveillance. For our audience worldwide, we're live on Bloomberg TV and radio. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz, 2 hours away from the opening bell. Here's your price action. From New York City, with equity futures up 16 points on the S&P 500, we advance by another 0.5%, adding some weight to the gains of last week and the last 3 weeks for that matter as well. In the bond market, big theme going into the Fed this Wednesday. Yields higher, curve steeper, up another basis point on 10s today to 0.9%. Outside of that, in foreign exchange, the dollar weakness. We get some dollar strength against the euro coming back 0.2%, but some weakness elsewhere in G10. And I just want to round things out with a look at crude for you. WTI just slightly negative, $39 a barrel. Brent of 42 coming in 0.6%, even as OPEC Plus agree to extend cuts. But Tom, it's the industry that I want to talk about just for a brief moment as this headline crosses the Bloomberg. It comes from Reuters that BP plans to cut up to 15% of jobs by the end of 2020. Last time I checked, BP had about 70,000 employees. Do the quick maths, that's a little over 10K in terms of job losses, Tom, if they go there. And this speaks to the theme, I think, of the next 6 to 12 months. How do these companies right-size? Get away from the equity market just for a moment. How do they right-size for the world that we have to adjust to in the coming months?
And what's interesting, John, is usually the cuts are 3 or 4%, maybe 5% is a big cut. So to see 1.5 there is a big deal. I think one of the things here, John, is a nationalization or government intrusion into oil. How United Kingdom intrusive is British Petroleum? I've got a concept of Total. I've got a concept of Exxon. Is BP, is it incestuous with the British government, or is it truly separate?
I'll be diplomatic and say it's far less intrusive than what we see in Russia or Saudi Arabia. How's that for a response, Tom?
Well, I guess that works. But I mean, folks, BP is, I think, sort of ephemeral out there. It's had an interesting 10 years as well. So, John, I think that, it'll be interesting to see, as you say, if there's follow-on to this. John, why don't you bring in our next esteemed guest who can esteem for us on the bond market?
Let's bring in Lale Topcholu, shall we, of JOHCM. Lale, fantastic to catch up with you. In the energy space, is this a cyclical rotation or a dash for trash? What have you seen in the market over the last several weeks, and how would you characterize it?
I mean, the energy universe, along with any of the deep cyclicals, both in the equity and the credit markets, are showing the same trends, which is it was beaten down so badly that if you believe in the recovery, these are the next sectors to recover. So there is a little bit of a catch-up that the market is trying to do. And part of it is also these are the sectors that I think people dumped very heavily early on and now just seeing the strong rally. So, from a performance perspective, I suspect people are also feeling the pinch. For us, we talked about it before, energy is a no-go on the credit side. Limited upside, all downside. And it's a continuous cyclical sector that keeps disappointing on the downside.
Lale, when does reality hit and what drives it? We talked to Mike Swallow, former colleague of yours from Goldman Sachs, about 30 minutes ago, and he said there's this real push and pull. The momentum of the moment is the big push going forward. Then there's this big headwind on the horizon, which is, what do the fundamentals look like in 6 to 9 months' time? And I don't think we're thinking about the latter at the moment. We're just focused on the former, aren't we? How do you think that plays out?
I mean, I think both the equity and the credit markets have basically written off 2020. I think what's challenging is what I don't buy is I don't think you can fully divorce fundamentals from the economic reality. And the way I've done this, actually, if you went back and read through all the sell-side research written in 2007, 2008, you will see a similar trend. everybody gets really excited about liquidity. In fact, you will enjoy this in March of 2008 when JP Morgan bought Bear Stearns. Lehman's CEO was on the record in an interview saying Fed action has taken solvency off the table. And we saw that didn't really happen. What happens is when the economy starts catching up, and, you know, we were down 90% in activity. If we recover back and stay at down 50%, that's not a full recovery. And what matters is that's going to form your 21 and 22 estimates.
Lale, you did say in your notes, increasingly, I believe that central banks are here to manage asset prices. If they truly are committed to reducing market volatility, which has translated into managing asset prices higher, why not just go all in risk? Because that's what's worked, and the Fed has shown no willingness to back away from its programs.
It's an excellent question. It can certainly be the case, but that was also the assumption. People went in all in on Lehman, and then it didn't work out. So that's really Russian roulette. And I did listen to your interview with Dudley, and I think the challenge is, if you believe on that, that really creates a huge moral hazard because, you know, products are going to grow aggressively. They're going to become systematic. They're going to form systematic risk to the economy and to the market, and you're going to get a Fed bailout, and that will eventually call question Fed's independence. I'm not sure we're there yet. I have to have a little bit more faith in the institutions than that.
Lale, are bonds fixed income right now? Do you perceive it as a coupon and danger zone, or can you actually find total return? I don't understand how you get total return with yields, whether they're creeping or moving higher, whatever. I believe that means price down. Can you actually make a total return over the next 12 months in this game?
It's more about the carry on the safer side, that's for sure. And to make a total return, you really have to, you know, take a leap of faith and get into some of these beaten down sectors. That's the only other way. The rest of it is just carry. And you know, we have been on the investment grade side, and what we have done is we basically have looked over crossover companies that are getting where the capital structure is split. Part of the leg is in high yield, part of it is in IG. So the IG company will continue to get access to funding, which should pull the spreads for the subordinated part of the capital structure as well. But it's very few opportunities like that.
What do mere mortals do? I mean, we're on a simulcast here nationwide. People are listening. People are watching. They can't do a sophisticated spread off IG and HY. That's bond jargon, folks, like what you hear from Lisa Abramowitz and John Farrow. So if I can't do the IG-HY game, what do I do if I just want to make a coupon?
If you just want to make a coupon, you just stay with the higher quality and do what everybody else has been doing, which is follow the Fed. But again, that's not going to give you substantial returns. What we have done on our portfolio, I call it the 25% club. You know, we basically barbell between cash, credit, defensive equities, and some cyclical equities. Because, you know, to John's earlier question, if the recovery surprises to the upside, you're going to make a lot more money on the cyclicals. And if the economy disappoints, then we have the protection through our cash holdings.
And now
just in
for
terms
a more
of shocks, Lale, I just want to wrap things up with a final question. Thank you very much, Tom Keene. Lale, you mentioned Lehman earlier, and someone said this a couple of months ago to me. Just let's park the V-shaped recovery that we've seen in the market. Put that to one side. Are you saying that what we've seen wasn't Lehman, it was Bear, and there's more shocks to come, perhaps an even bigger one?
What I'm saying is when the economy slows down, it exposes over-levered balance sheets, it exposes fraud, it exposes bad management teams.